Good morning. Good morning, everyone. Okay, so futures are lower. We expect this time of year between August and September to see a more negative return in the markets. What I was doing pre market was looking at what struck me is the election years. Okay, so next year we'll do the presidential cycle again. Okay, so looking at where we are right now. Good morning. Good morning. If you're just joining me, I'm Cousin Vinny. I'm your host today, as always, giving you the play by play. It is Friday the 18th. We got 6 minutes to go. I'm going to go through this really quick. I was a little late this morning because I was compiling a couple of charts. Next year, we'll elect president again. The year prior, I'm going to go through this real quick. This is the current. This is the current pullback from the high, 5.3%. 10% would be a move back to the 200-day. If we go to the previous election cycle, Joe Biden and Trump, during August prior to that year, we pulled back 7%. Okay, so 10% would be the 200-day now. We're a little bit more than 5% currently, with the potential to move at least 7% according to 2019, 2020. The election cycle with Hillary and Donald Trump, you remember that? 2015, we had 11% pullback. Okay. We did a little W bottom. We revisited the lows and we took off to the upside. Remember 1867? I remember Danny Riley talking about that. So that was 11%. Okay. 2015. 2011, 2012, that was what? Obama, his second term with Romney. There was an 18% pullback from the high down to that low in August. 18%. Well, with Evergrande being in the front of the news right now in China, deflation, that's a possibility. 2007, 2008, that was the Bush Obama, right? That was a 12% pullback in August. You see the pattern here. 2003, that was Bush and Al Gore, I believe, right? He got reelected. 2003, 2004, that was a 10%, 11% pullback. And then we dropped again. I guess all the chit stuff that went on. And of course, the first year of the younger Bush term, 10% and 10%. So that gives you an idea. We could see anything between where we are right now, 7% down to 10%, and perhaps even lower, depends. So we have to wait. You see these reversals? So look at the reversals, okay? What we need to see is a reversal near a major moving average or a support level. Previous support here, 2007, 2008, 2011, 2012. I suppose that there was support over here on the left somewhere in the previous year. But we're looking for at least support and a bounce, okay? It'll be obvious when we see a bounce. That's what we're looking for right now. We got 2 minutes to go for the opening bell. 2019, 2020, we came down, we retested, and we took off to the upside. 200 days right below. So that's what we're looking at right now. 2023, 2024, the 200 days right there. The 100 days in here in between around 4,300. So let me just put that on the chart real quick. So that might be a target too. So we're looking for an area. Now, if this makes you upset knowing this information, I find it uplifting because I know generally where we could see an area and we're looking for it on a daily basis. We're in a negative gamma situation. We're put dominated. Mikey's been posting as well. So that's what we have to deal with. We got less than about a minute to go here. Let me just get my charts up. Hope that helped. I hope that helped. Okay. Okay, so my hands are off right now. We'll look for a bounce to reshort. I don't think this is done with. I think we're going to end the week negative. All right, here's the S&P on the weekly time frame. Okay, we're below the 10 EMA. So somewhere along in here, maybe you see a 50% retracement. Did I look at 2019, 1999, 2000? All right, we had a couple of pullbacks. And you know what happened after January of 2000? We pulled back quite a bit. Okay, so let's get ready for the opening bell. First 15 minutes, I'm not doing anything except taking profits off the table where applicable. That would be puts, if you have puts. Hedges, I'll keep the hedges on. Okay, we're lower. So that should give you some reference points to have an idea what we could expect from this point. Okay, 60-minute. All right, so yesterday we saw just about everything was bearish. Everything was longs weren't working. Okay. Okay. If you're expecting a big bounce, I'm not. I don't think anybody's expecting a huge bounce or a reversal here. There'll be some shorts covering. We'll see what happens after shorts cover first few minutes of the trading day. Okay, so let's look at S&P. Gapping down. 4,300, 4,350 is a level we'd like to get back above. Tesla gapping down, or Tesla getting into an interesting area here. My thinking is I'd like to buy some of these big cap, well-known names like Tesla, Google, Amazon, etc., Meta on these pullbacks, but I'm going to wait for the indices. Not much to do today. If you got puts on, taking some profits on your puts. All right, shorts will start covering. Depending on how much they cover, we could bounce a bit more. We're right below 43.50. If you sold any covered calls, look to buy some of those back, most likely a good idea. Okay, Walmart is bouncing after dipping yesterday, so that's interesting. Kohl's is bouncing, TJ Maxx is up $1. So not everything dropping off. TJ Maxx, relative strength. Walmart. That's the other thing. We got the yields issue, we got inflation. All those previous years I just showed you, I remember inflation was so much lower and the Fed wasn't going crazy. I think 2011 was the Greek debt crisis, the culmination of the Greek debt crisis. That's 2011. That's when we had that double pump lower. Okay, this is 2011, 2012. That's when the European Union agreed to debt relief from or for Greece. Remember, they were having all those riots. I mean, that started in 2008, 9, 10, and it came to a head in 2011. That was the August prior to the election year in the US. 18%, and we revisited 12%. So that happened then. I'm watching the S&P. All right, I'll cover those charts again. Watch TJ Maxx here. TJ Maxx on the move. Okay, TJ Maxx. Oh, they're talking about TJ Maxx on CNBC. That's pretty cool. Wow, nice. S&P, I mean CNBC with their obvious headlines. Dow, S&P, NASDAQ tracking for their worst weeks since March. Wow, aren't they on the ball? They are on the ball. Hopefully I don't turn you off by being super critical with CNBC, but it just, I don't know. The information that they give you really isn't that actionable from my perspective. Sometimes you'll get a tidbit, like when halftime report, Josh Brown or somebody will talk about something and the markets are set up right and we get a bounce or whatever, or Joe T or Stephanie Link, Jim Lebenthal. I find over the years being calm about the markets, knowing what's possible, helps me with hedging, understanding what might and could happen. Okay. If you're just joining us this morning, I was talking about the S&P during election years. Next year, we'll elect a president again. Here's 1999, 2000. We know what happened at the end of this chart. Starting the year 2000, this dropped off. 10% pullback, 2003, 2004, 11% pullback, 2007, 2008, Greek debt crisis, 12% pullback, 2011, second Obama term, right? 18%, and then following a 12% after that. 2015, 16, 11% pullback. Knowing what we could see is helpful. 7% in 2019, 2020. And 2018 is when Donald Trump is negotiating the whole China, washing machines and solar panels where they had tariffs against them. And then we started to rise into 2019, and that pullback was only 7%. So is that enough for us? It all depends on what support levels we can find here. The 100 period moving average, it didn't save it, sorry. Simple 100. And let me make this red. Okay, so there you go. Okay, we got the 100 period moving average at 4,300. We got a major gamma level at 4,300. Maybe that's a level where we could see a bounce. Okay, TJ Maxx, a little profit taking into that. People are nervous. I saw a lot of comments in the trading room that made a lot of sense to me. I've been there before. You get people panicking. You can't breathe. You go to work. You got reports to do or projects, and all you can think about is your 401k or whatever. The markets are going to bounce. They will bounce. So just take a deep breath. I know it's probably not a help me saying that, but I've seen enough of these, along with some really bad bear markets. The end of 1987, 2000 dot-com, 2007 financial crisis, 2020 COVID. Institutions are not going to just stop buying stock. That makes no sense. So what we've been doing going into the end of July was taking profits into strength. Remember that comment on that big red candle? I know you remember me saying that was a shot across the bow, right? And what happened 3 days later? We went sideways. We thought maybe this continues. And one of the comments I made was it's a lot easier to trade when you've got a trend. And we'd look for something stupid to happen, like over here, where we lose the moving averages. Okay, even if you miss the first 2% of the pullback, you were aware that this could start to accelerate. And it was the month of August. So you shouldn't be behind the 8 ball if you've been in the room for more than a few weeks. You should have caught the tail end of some of the conversations we were having about preparing for pullback. Okay, so the 100 period moving average is 6.7%. 666. No, I don't want that. 6.72. Okay. You also don't have to do anything. There's a lot of people in the room that are day traders that are comfortable day trading. You heard Mondo and Frano talking yesterday. You get a nice trend down, you have puts, and then you have it reversed. You flip your trade and then wind up, the trend continues to move lower. That happens. All right, we're down almost 6% right now. We're bouncing. So if you're not a day trader, you should be sitting on some cash. Scott, I'm talking to you. You should be sitting on some cash. You might miss a really good entry at the lows, but I'd like to see the majority of stocks starting to move. Okay, let's go take a look at that so we have an understanding of where money flow is headed. I personally think what I'm good at is following the money. And that's what I offer to you. Watching the money flow can often tell us when we should expect a bottom, when we should expect a top. Back in October, a lot of us were trying to figure out if we're going to make a move lower. We had some members forecasting the markets were going to bounce. They actually did. But what really happened in October was the 10-year yield peaked. Okay, it peaked over here on the left. Let me just zoom out a little bit. So we're very focused, laser focused on the 10-year yield. Okay, so we're right at a double top. We hit a double top and we were getting rejected. So if you're buying day trading, if you're day trading calls off the low, I'm going to wait for VWAP, and I'm watching stocks that I can sell covered calls on or sell premium. What's working right now are call credit spreads, where that's a bearish trade. You're looking for selling calls overhead, people that think this market's going to continue to move higher. And you net the gain if the markets move lower. You buy the calls back. Or you could do call credit spreads, which I prefer because I don't want to get caught naked if the markets rip higher, which I don't expect. Or you could sell debit spreads on the put side, which I don't suggest right now because the markets are just too weak and prone to more downside. All right, so the 10-year yield's what we're focused on very acutely. Money flow, if you get used to money flow, following the money, I think you're going to have an edge up on most people that are just winging it with chart patterns. Just remember the past chart patterns, that's past information. That really doesn't tell you much about the future. You can base some ideas on them. Previous price action, a double top in this case. That doesn't really tell us much about what's going to happen in the future. I think you would agree with that. All right, let's take a look. When I talk about money flow, we talk about things like junk bonds. The people that would be in bonds, junk bonds, thinking long, these are risk averse individuals. They will be long the markets when they don't think the market's going to fall off, but they'll start selling when they think the markets are weak. And I told you that if we stayed up here, fine. If we drop below the 50-day or start to lose some of these moving averages, they turned lower now, then you need to start thinking more cautiously, more defensively. Okay, we also wanted to watch IBB, that's the green, IBB and IWM, that's two more risky assets. As long as these are moving lower, you should expect to see lower prices in the markets. I'm watching for a bear flag here. Crude oil is moving higher. That's not helping the economy. With consumers paying higher gas prices, that's not helping. Bitcoin, US dollar, that dropped off. This is a risky asset. Very fickle people. Markets start moving lower. Advanced decline. More stocks declining than advancing. Okay, so that money flow is telling you bearish, giving you a bearish picture. Let's take a look at currencies, the US dollar. This is an end of day chart, but we were looking for a breakout over the last several weeks, last several months. I told you that if we break this downtrend and this starts moving in a bullish pattern, like it is trending, you could expect to see a headwind for U.S. equities. Stocks like Microsoft that trade internationally are going to have that headwind to deal with. Okay, so instead of trying to guess where Microsoft is going to bounce, let's wait for it to bounce. Okay, the weekly. What I'm trying to tell you is you really shouldn't be doing anything right now unless you're thinking day trading. If you're thinking investing, you should be waiting. You may miss a couple of days, you might miss a week after institutions start buying, but it'll be obvious when they start buying. Okay. So take a deep breath, sit back, go play golf, do whatever. We know what the election year cycle is like. We know that we can see a negative return for the month, the latter half of August into September, that third line on this chart graphic into the end of September, we should expect weakness. If we don't get it and we see an obvious bounce, we'll reassess and make some decisions. Microsoft, let's just look at the FANG stocks real quick. All right, so FANG have been leading. We were up over 100% since the November low over here on the left. 100%, actually 102%. We're breaking below levels. Next level is 382 Fibonacci. We got some levels over here. New York FANG. Let's look at the weekly time frame. Okay, so you know what the 50% looks like. 382, 50% would put you back at the 100 period moving average, 200 period moving average, somewhere in this zone. Okay, if you have positions, I have shares in Apple. I don't plan on selling. It's a long-term core position. I'll sell covered calls or call credit spreads. If you have Apple shares, I also have this, which you could trade AAPD. This is a short on Apple. Okay, this is trending. So if you have Apple, you can buy, I don't know, 1,000 shares of this for every 100 shares that you have of Apple, or 500 or 600 shares of this, and hedge your position. You're more neutral at that point. So as this moves higher and Apple's moving lower, you're neutralized as we approach the 200-day moving average. So that's AAPD. That's the Apple one-time bear share. Okay. All right, so I don't see any questions. Let's see what people are thinking here in the markets. Yeah, Microsoft, Money Magic posting in the trading room. Microsoft has the potential to get to 300. Yep. That's probably the 100 period moving average here again. Nope, it's below that. Okay. So 200's at 280. Microsoft. Let me just what did I want to do here? I wanted to do a Fibonacci. I wouldn't be doing anything. It looks like a bear flag to me. 4,300 seems like a likely destination. Seems like a area where we might visit. We were looking for 4,400 to hold. That didn't happen. Mikey's been posting. We've been put dominated for some time now. Okay, when they have big blocks trading inputs. So there's a lot of inverse funds that you can trade with Nvidia, Apple, etc. Google, a little dip and a bounce. Google's been hanging out near recent highs. Yep, 4 out of 5 days, yeah. Oh, I wanted to put a Fibonacci on here. All right, so if the last pivot low near the 50% retracement was at 274 for Microsoft, 274. Why does that look weird? Visually, that looks weird. Okay, 274.19. Close enough. 274. 274.19. If you know how to get stock charts, I've been using stock charts for a long time. I still can't get this Fibonacci to be exact, like putting in numbers. Okay, we're near 618. That would be a 310. And Money Magic's talking about potential to get to 300 using his gamma levels. Okay, let me just add. There's no hurry to do anything. All right, so we're starting to move a bit higher. Let me get Woody up here. Sorry, I forgot to put him on. All right, let's state the obvious. We know the markets are lower. We know we've been lower for a few weeks. CNBC, I guess people tune in, they're clueless. So I guess that's who they're talking to. I like Mike Santoli. I like some of the individual personalities on CNBC, but CNBC producers, I don't know, they just come up with the information that seems it's not actionable from my perspective. I think Mr. Young, if you're listening, I think Mr. Young had it right. You know, they can't say, you know, the market's going to do this or that because, you know, obviously there's um, legal issues to stating a guarantee, sort of. But to talk about things 3 weeks later doesn't really help. All during October through January and the first 2 quarters of the year, what was CNBC talking about? Wapner was talking about the markets are too. The Fed's going to do this. The recession's going to do that. Supply chain, interest rates. None of that really helped on the long side. However, you had some people like Rick Santelli talking about the highs in the 10-year back in October, which led to lower highs and the rally that we've just come off of 3 weeks ago. And he was telling you a few weeks ago that the 10-year is starting to rally. If it continues to rally, that would be a problem for the bulls. We know about it. And we know August is one of the most unkind months of the year. All right, so I'm looking at Microsoft, these pivots over here. I would like to buy some Microsoft once I see institutions. You can see the selling right now. I don't know why. Visually, that just doesn't look on. It's like an Escher. Okay. RSI is near 30. I don't feel a need to be a cowboy and be dead on. I want to wait for institutions to start buying since they control 80, 85, 90% of market action, depending on who you speak to or what your beliefs are. You know that they control the majority. So looks like a bear flag to me, folks. I just am anticipating that we're going to see more downside in many of our favorite stocks, Apple, etc. I'd like to see a bounce so we can sell some covered calls on positions. Okay, Apple, Google, fading back below the 21-day. A lot of stocks being sold. People are taking risk off the table. That makes a lot of sense to me. Even if they're late, they're taking risk off. Won't be doing much today. We got 43.50. We're trading 43.49, 43.50. If we lose 43.50, 43.25, and then 4300, let's go look at some levels here. Okay, you can see 4400 was a pretty big level compared to all the other levels. 4350 is where we are right now. A lot of puts down there. 4300 is below that. In between, we got 4325. So hope for the best, plan for the worst. Right now, I'm planning for the worst. I'm looking at 4325 and potentially 4300. Below 4300, most of we're seeing is puts. Most of the blue is outnumbering the calls over here, the orange. So more put dominated, obviously, but below 4400. That's been discussed over the last few weeks. Right here is 4400. Then 4350, right where we are right now. We lose this, then 4325 and 4300. Okay, TJ Maxx trying to hold on. What's Walmart doing? Walmart, nice bounce. If we regain 4350, your overhead 4375, 4400. All right. So I'd like to see a nice rally into noon, which is the area. If we get a nice bounce, I'd like to sell some covered calls on positions if we get a nice bounce. If we continue to move lower, I don't want to sell covered calls as we're moving lower. That makes no sense. So I need to see some bullish action. All right, if we continue this drop, 43.25 is the next level, 43.25.
Lawmakers urge against export controls working group with China.
Once again, if you just joined us this morning, I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Friday, the 18th. We've had 4 consecutive days lower. We had started off the week, looked like we might bounce on Monday. Kenny was talking about that. We are going into an election year. Talked about that this morning. Okay, as we continue to move lower. If you're thinking puts, 43.25. Okay, so here's the election year going into next year, 2024, elect another president. We have a potential for 6.7, say 7% downside to the 100 period moving average. So 200 days at 10%. I'm comfortable with that, knowing we've gained 32% from the October low, 10% pullback. Prior years, 2019, 2020. August, we had a 7% pullback during the end of the Trump administration. Then 2015, 16, that's the end of Obama, beginning of potential for Hillary and Trump. We had 11% pullback before rallying. The key here is that we rallied into the end of the year. Institutions are not going to stop buying stocks. They're going to find blood in the street and then they're going to buy. That's our task. Right now, our task is to, I don't know, lock yourself in a room if you can't stay away from the computer and you're obsessed with buying on the long side at this particular moment in time. Now, there are going to be some stocks that are going to buck the trend, like TJ Maxx was this morning, but overall, what is energy doing? Energy, healthcare, utilities, staples, those are defensive sectors. They're in play. Energy bouncing. Okay, but try to keep from trading right now. Trading, swing trading. Longs are not working. There's a few sectors that are working, but you would be best served by just walking away. Let's see how the market settled down. 2011, 2012. That was the second Obama term against Romney. 18% pullback. So we know what can happen, what's possible during this time of year. But what happens at the end of the year is what I'm interested in. Okay, after the pullback. Okay, I'm watching for the money flow. Bush Obama election. Last year of Bush's term, we had a 12% pullback during August. His first term, 10%. 1999, 2000, of course, you know what happened after 2000, but we had a 10% pullback. But by the end of the year, the market started moving higher. Okay. And if you look at the yearly, okay, this is pretty informative. You go through a period of consolidation back in the 30s into the 50s. It was about 25 years of going sideways. Then we went on a 15-year trend and then 11-year consolidation during the 60s and 70s. You had during that period into the 80s, you had the savings and loan crisis where thousands of savings and loans went under. Yet the markets continue to move higher for 20 years. We consolidated for 13 years after 2000 .com. We went sideways for 13 years. Then we started trending. We're in a year, I think we're in year 12, right? 1, 2, 3, 4, 5, 6, 7, 8. No, year 11. Okay, so we're 11 years, 15 years, 20 years. Okay, we're somewhere around the average of 16. Okay, so that's a possible. Look at MACD on a yearly time frame. Is that turning up? That's not my opinion. Rate of change is turning up. Okay. Let's look at the monthly. This is a strategy for long-term investors to either be long or short or out of the market. Okay. So when you're above the blue line, let me just make that, make it dashed. Okay. So when you're above the dashed line, you're bullish. When you're below the dashed line, you're out of the markets or have taken some risk off. Okay. The highs, when we drop down below in January, February of 2022, that's a couple of months into the bear market, but you missed about 20%. Missed about 15, 18% on the downside. Okay. Now that we're back above 2023, where are we? We're above that dotted line. Dotted line's moving higher. Price action's up here. We could come back to 4,300, but there's no reason to think that the markets are going to collapse. We got a lower high, yes, but this is a very simple strategy to be on the right side of the investing time frame going forward. Okay. It's been pretty accurate. 2007, 2008, during the financial crisis, you would have missed a 50% downtrend, 50% cut, 50% haircut on your 401k, 2007, 2008 into 2009. 2020, pretty quick move. So this is a really good way of studying money flow and understanding your risk. So as it starts moving lower, you're taking a little bit of risk off, looking for an opportunity to get back in. So if the markets turn in October, November, this line will start moving higher again and we'll test that all-time high. Okay, so that's just something to keep in mind. Yesterday I told you that these advanced decline measures were at 30%, minus 30%. These are levels where we would see a bounce, a reflex bounce. Okay. So doesn't mean we're going to go all the way back up to the recent highs, but I could see a revisit of the 50-day overhead soon. NIMO also giving us extreme readings. Okay. Yesterday we had nearly a minus 100. When we've gotten down here before, without exception, minus 100, minus 128, minus 108. It led to a bounce, a revisit here, and then a follow through. Bounce, revisit, and follow through. So we're looking for a bounce. We have a lot of reasons to believe that we could see a bounce. Okay, so Walmart, watching Walmart. I hope that helps for those of you who are not, you know, haven't been trading very long. Sometimes we just sit and wait for the markets to give us a base and a setup. That's what I'm waiting for right now. All right, here's Walmart. Let's watch Walmart for a few minutes. Markets are holding at a key level, 4350. NASDAQ 100. Visiting the NASDAQ 100. It's not as bad as I thought it would be, actually. We're 60% red, 40% green. We're being led by Ross Stores. That's up 6% on the day. Ross Stores. Okay, so we got a lot of upgrades on Ross Stores. Okay, so that looks really good. Okay, retail. Okay. Okay, Ross Stores.
Maybe you'll hear about that next week in Jackson Hole. It's gonna get wonky.
Okay, what is Target doing? Target, is it participating? Target bounced too. Target too. Walmart, Ross Stores, Target, TJX. What about Costco? Costco. Okay, trying to move here. Costco. What about BJ's Wholesale? BJ's with a bounce. Kohl's, KSS, Kohl's. Okay, so we got Walmart, Ross Stores, Target, TJ Maxx, Kohl's, all showing relative strength. That's it. It's risk off for now. Caution. Waiting for the majority of sectors to show some institutions are buying again. Okay, not just one or two. Energy. We started off the week looking at energy. Okay, energy is bouncing. Let's see. CSX on the move. Rails. All right, CSX, the rails are running. Okay, it's after 10 o'clock, so I'm looking for stocks that are showing relative strength. CSS is one, CSX is one. Union Pacific is another. I believe, Scott, you have a position in Union Pacific, right? Core Holdings. Norfolk Southern. Oh. Norfolk Southern is what? NSC, I believe. NSC, Norfolk Southern. NFC. Norfolk Southern had that rail disaster in Ohio, was it? Okay, that's about 6 months ago, whatever. Anybody live in the vicinity? Know what the updates are? I know they have to. remediate. Norfolk Southern. Okay, so that looks good. Applied Materials had earnings, right? Applied Materials. It's higher. Applied Materials. Okay, let me just look through Ross Store real quick. Bank of America Securities adjusts its price target on Ross Stores to 140 from 135. Telsey Advisory, a tier 2 or tier 3 firm. Tier 1 firms are JP Morgan, Goldman Sachs, Morgan Stanley, etc., Wells Fargo. Tier 2 firms, Truist, some of the smaller banks. Telsey, I think, is a tier 3. But anyway, their price target, 130. TD Cowen, 132. Barclays, 139. Morgan Stanley, 131. All these targets are higher. Guggenheim, 135. Bernstein. Okay, that looks good. Okay, retail is looking pretty good. Let me take a look at XRT, the sector. Okay, bouncing at the 200-day moving average. Okay, here's retail. Okay, retail bouncing. Look at stochastic. Love, love, love this setup. All right, so we got a headwind with the S&P. So you could temper entries, but XRT, if you're thinking about entering some of the retail, my suggestion for myself, I can't tell you what to do, but what I like to do is to scale in. So if I think this is going to bounce because the stochastic is set up really well, MACD isn't there yet, and we had some volume, selling volume down to the 200-day. My strategy is to buy. If I'm going to buy 1,000 shares, I buy 100 shares to start off. If it bounces, great. Gets back above the 50-day next week, I'll probably double my position. I'll have 200 shares. If it continues to follow through and stochastic starts to fire like it did back in late May, then I'll probably double up my position to 400 shares, maybe 500 shares, and then I'll continue to ride it. If we hit a moving average like the 200-day or the 100-day overhead, which we don't have, we hit resistance again at 68, say, maybe I start to look at potentially scaling out of my positions. If it follows through and breaks out above 67, I'll continue to hold. Maybe I'll start selling covered calls. So you can see the strategy builds upon itself as starting with stochastic and RSI. Both of these are turned up. That's what I'm looking for. And I'm looking for the sector darlings to continue to move higher. Okay, like Walmart's bouncing at a key moving average 50-day. Okay, I don't need to tell you that Walmart during the 2007-2008 collapse during a financial crisis, Walmart gained at the same time. Walmart gained 52%, 53%. At the same time, the markets were melting down. Here's the peak, October 9th, 2007. That's the peak in the Dow Industrials, NYSE, S&P 500, et cetera. We went 50% off, 30% off. What was the number? 50%, right? 50%. So you missed most of that. In the meantime, what was Walmart doing? It initially dropped with everything else, but then it went on to a 50% gain some 10 months later. So Walmart is something I'm always watching, even though it doesn't always perform as well as I'd like. Earnings were good. Guidance was good. People took profits. We were at the highs, trading to perfection. The next day, some institutions probably took some profits off. You know, they've had a nice run up. So strategy wise, it makes sense. I mean, they're in Walmart from May, June of last year. They sell up here. That makes perfect sense to me. Wait for it to pull back. But it's bouncing. So it's following the trend. It's respecting the trend. Either it follows it or it doesn't. All right. So I'm not going to have an opinion on whether it does or not. It's bouncing. So that looks good. You also got Kohl's. Okay, that's above relatively new reversal of trend in May. Kohl's is moving higher. Okay, Target has been spending a lot of time down here at the lows. That's still below the 10 EMA. Ross Stores above the 10 EMA. This is not my opinion. It's either above or it's below. 10 EMA is up and to the right. So this looks really good. TJ Maxx, bullish. Okay, the key is getting in at the right time and not chasing. All right, so you had a good entry before earnings, which I don't usually do. I don't usually enter a position. In this case, I do have some TJ Maxx, but I sold covered calls and I had puts just in case. So bottom line, retail looks pretty good. Energy looks pretty good. I did take a break for a few days, but it is trending 921.50 or up and to the right. 50-day will probably cross through the 200-day next week sometime, late next week. 50 crossed up through the 100 period moving average, the magenta color. Okay, so we were going through the top 10 on the NASDAQ 100. Applied Materials is one. Okay, here's Applied Materials. Number 3 is Orly Automotive. It's retail and it's related to car parts, etc. People, I know cars are getting pretty expensive. They have been for some time. CNBC keeps talking about how expensive cars are, new cars, and who can afford a brand new Tesla. Tesla prices have been coming down in China. I don't know what a Model 3 goes for right now. I haven't priced one out recently. But people are also bitching about, I wouldn't have an electric vehicle unless I was just going to use it for around town where I know that I'm not too far from home. I'm not going to take it on a trip somewhere. Orly looks pretty good. Mercado Libre, considered the Amazon of South America. Mercado Libre. I think what I heard it mentioned as Amazon / Craigslist, something like that. I don't know if that's true. Don't get mad at if it is different. I don't know the technical makeup, the structural makeup of the company, but I've heard it is Amazon of South America. Datadog bouncing. Cisco had earnings. Okay, here's the high from earnings over here on the left, 55.78. So we're moving in the right direction. We're not selling off. Cisco, I plan on selling some covered calls. CrowdStrike, CRWD. CRWD, CrowdStrike, bouncing. Zoom, bouncing. And NXPI, semiconductors, bouncing. Okay. Sectors. Junk bonds have a bid, junk bonds, so that's good. We want to see junk bonds with a bid. We want the S&P needs to stay above 43.50. We're currently above 43.50, so that's good. Good news for the bulls. Doji down here, a 3-candle reversal or a Morningstar Doji would be fine by me. That would mean we look for Monday, which makes sense. Coming in on Monday, have a bullish day going into Jackson Hole. Bullish reversal. Makes sense. We could see that. Okay, here we are. down. We hit a low 5.9. Let's just say 6%. With a maximum of 7 or 10% probable. 4,300 is a good level in gamma. So the reversal should be obvious, like over here, we came down to the 50-day. Should see a big bullish day followed by another bullish day. I'm in no hurry. March low. That was the last time NYMO got down below 100 in recent price action. NYMO reached minus 108, I believe, in March. We're at minus 85 right now. So what I'm looking for is an obvious reversal. You get these really nasty looking red candles. We reverse at 3808 and we get several days of upside price action and we follow through. That's what I'm looking for. You could even wait a week. If you're an investor, you're not interested in day trading, that's what I'd be waiting for. That's what I am waiting for, to get back into some T Rowe Price growth. Okay, Ross Stores doing very well. Ross Stores. VWAP is starting to flatten out a little bit right now. Okay, Walmart came back to VWAP. I have Walmart January 165 call. So I was a little disappointed, to say the least, that Walmart to pull back. I was going to buy some puts going into earnings, but I said, nah, it's probably going to beat. It did beat, and guidance was good, but that's the illogical part of the markets. Doesn't always do what you think logically should happen. Okay. Market's still weak. 43.50.
they are going to give new medium-term outlook. So, I mean, they basically are telling analysts they want to give them the weekend to absorb the information and update their models on the 3-year guidance. And also, apparently, this Palo Alto starts their sales kickoff on Sunday, and so they're going to talk to 5,000 people. And so they, I think, wanted to pass the information and the out there so that they can feel that they can talk to those people during the sales time freely. And then the other thing to mention on a scheduling basis is they apparently have a 3-day board meeting this week. So maybe Friday is the only day they can do it. And for all those reasons, maybe people should stop freaking out about that. That's all.
Okay, we need to stay above 43.50. We keep hanging out here, so I imagine there's a lot of puts being monetized. If we don't drop off, when we start to reverse higher, those puts will start to aggressively cover or take profits. That could help us launch to the upside. I hope everyone's having a good day. I know it's, not the best. We'd love to see the markets go up every single day. It's not realistic. I don't think anybody expects that, but, it'd be nice to see the markets go up every day. All right, S&P is just sitting here oscillating around that 43.50 area. 43.50, and they got 43.25 below. 43.50 right there. 43.25 below. Okay, so get back above that dotted red line would be great. Let's see. So retail is a good place to be. Ross Stores, we're up at the highs. Open a new store in Spokane, Washington. Yippee. Ross Stores, let's see. Earnings, Ross Stores. Ross Stores reported fiscal Q2 earnings late Thursday. $1.32 per diluted share, up $1.11 from a $1.11 a year ago. So they beat by 21 cents. Analysts polled by Capital IQ expected $1.16, so they came in at $1.32, beating analysts' estimates by 16 cents. That's a good sign. Sales for the quarter ended July 29th were $4.93 billion. Not bad for, if you've ever been in the Ross store, you know that the merchandise they have, everything is, I think it's like excess inventory from other companies like Target or whatever that have overstock. Some pretty good deals in there, kind of like TJ Maxx. I don't like the store as much as I like TJ Maxx, but it does have some nice values in there. I hate throwing money away on retail. Get off-price brands like you do at Ross Stores and TJ. Ross Stores Q2 comparable sales were up 5%. That's a good sign. Analysts polled were looking for 0.9%, so less than 1%. So they beat by 4%. Fiscal Q. This looks really good. This is a really good report. Very good report. Earnings, growth.
they're expecting Al to pivot away from it. Like now, some people are saying that may not be the case. It may sound quite hawkish. So a little bit of confusion about what Powell's going to do there with some of this stronger data. Finally, we have been obsessed with Treasury yields all week, and I think it's nice to, good idea to point out a recent study that came out that with most stocks, Treasury yields did before the study.
Mortimer, let's buy Ross Stores. Tesla gets down to 200. I'm not going to immediately buy at 200, but I'll be looking at Tesla for potential start to positioning for a new entry. I want to see institutions buying, so that's going to take a couple of days. I don't see it happening today. Maybe early next week, Tesla. So I have my eyeballs on Tesla. I'm looking at companies that are going to be around, that are still growing, that haven't turned into more blue chip companies. I saw Mikey mention Apple as turning into a slower growth company. I would tend to agree with that. I think it was Mikey that mentioned it. It's not the high growth company it used to be, having difficulty with sales, etc. Just heard about that battery settlement that they had to agree to, ruling in favor of the group that was suing them. Batteries that were set so that you had to upgrade your phone because it didn't work, whatever the story was. I don't care. I like Apple. I upgrade my phone every couple of years anyway, so non-issue to me. I mean, each person would get like $65, not enough to buy a new phone. All right, Cisco looking good. Cisco. Bristol Myers was active yesterday. It popped up this morning to, is that yesterday's high? Close to yesterday's high, Bristol Myers pulled back. There's some speculation that the company might get bought by another pharma name. Bristol Myers. We got SoFi on the move here. SoFi starting to move higher. That dipped recently. Okay, SoFi looks like shorts covering. SoFi shorts covering. Yeah, good strategy. Good strategy, Scott. All right, what is U.S. Steel doing? I haven't looked at that in a day or two. U.S. Steel, all right, so that's looking pretty good. U.S. Steel still holding the highs. You would think with the recent bid at 35, it would be up there closer to 35. I think Susie had questioned that as well. It is what it is. I mean, sometimes it would be near the bid. Cleveland Cliffs receives exclusive assignment of right to bid from United Steelworkers. Yeah, I saw that yesterday. It was a weird form I haven't seen before. It was in a form of I forget what it was. Should have kept it yesterday. Maybe it's in one of these articles. Cleveland Cliff receive assignment of right to bid for the U.S. Steel Union. Okay, so that's a big deal. That is a big deal. Okay, so yeah, I agree, Corey. I agree. Okay, we're starting to rally a bit more. Okay, so if you got puts, you probably want to take some puts off. Looks like we're going to rally here. Okay, so as we push higher, what's happening? Puts are monetizing. Traders that have 0-day or options that expire today. This is a pretty small expiration, by the way, compared to June and July. This is a pretty small expiration. If you looked at the Gamma channel this morning, Friday update. Okay, VIX is back down to 1830 and starting to drop off. VIX is starting to drop more. Okay. US Steel looks good.
were applauding as some Navy SEALs make their way toward the podium at the New York Stock Exchange. Markets today in the red. The S&P 500 looking at its longest weekly losing streak since February, down about 0.3% right now. Fidelity Investments Director of Global Macro.
Okay, so um,
Break apart exactly what's going on in the bond market, what yields at these levels are telling us for how restrictive, the bond market is against the economy, what it's going to mean for risk assets as well.
okay, you can see Mikey's been posting this as well. You can see that the blue, we're more put dominated in this expiration. This is the August expiration on the far left. Okay, this is September. September expiration is the next largest. Okay, so what does that all mean? We need to see 4350 hold and buyers come in here. Okay, we're starting to tick higher. U.S. Steel starting to tick a bit higher, pulling away from VWAP.
So what's gone a little bit too much? The stock market had kind of gotten too far ahead of itself relative to the cost of capital, relative to where risk-free rates are. I guess the question is, we're in this zone right now, talking about these invisible kind of factors in the bond math, right? We have the neutral rate. You talk about the term premium.
Okay, let's see. Tick cumulative is trying to turn here, looks like. What is this? That's the 5 minute. Okay, 5 minute. Okay, we're spending the last half an hour or so above the zero line on tick. So more upticks. Futures looking better. All right, if you're looking at the 60-minute TTM histogram, it's turned yellow from red. So that's showing that severity of selling is dissipating. We got two nice volume bars here over the last 2 hours. So shorts covering. Now we just need more puts to monetize so we can get the hell out of this area.
get this indigestion. I think that's kind of what's happening. Yeah, absolutely. And kind of worn away whatever cushion we had there. You're in 4,200, a little below that, gets you towards the 200-day average too. But maybe it all comes together that way. Appreciate the time. I'll talk to you again soon.
I feel like
Mhm.
it's an economic term. It's just a real neutral rate of interest, which is basically up for debate, and it's the rate at which the Federal Reserve puts interest rates that doesn't expand the economy or contract the economy, and there's a lot of debate about that right now and whether it should be higher in this
This is Fridays are generally a very slow day for me anyway. And given where we are presently with the potential for us to roll over one more time or again, only being 6% off the highs, recent highs in July, I'm really not doing much. I don't like to trade Fridays too much. I've been watching the trading room. You guys have some good ideas. Well, you know what? Let me just check here. Okay, so we got people buying here, 43. Looks like buyers are showing up. Some buyers calls. Mhm. How's everybody's Friday? I imagine good. It's pretty slow in the trading room. I imagine most people are either playing golf or no, I was just getting ready to say tennis, but I see Frano just popped up in a comment there. Yeah, definitely. Yeah. The Dark Lord. Yeah. I can't imagine playing it in the humidity. Mhm. U.S. Steel continues to push a bit higher. U.S. Steel. Oh boy. What's Apple doing? I do want to sell some covered calls on Apple, but need to see a pretty significant bounce. All right, we're starting to trend higher into noon. Maybe I'll sell the 180s. I've been selling covered calls almost every day on Apple and buying them back on dips like this morning. December calls are going for $7.85, $7.85. That's the 180 call. December. So if for some reason we broke higher above 180, I'd probably sell the 185s. Those are going for 570. They'd probably be up about 650 if $7.50, probably around 750 if Apple can rally here. I'd be looking to sell maybe the Decembers. And if for some reason the stock starts to reverse and break out of this range, then I would roll those calls up a strike. I don't want to get my shares called away. I have a core position in Apple. All right, so we're starting to move a little bit higher. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Friday. Fridays are generally a pretty slow day. This one's a lot slower than usual, though block trades have populated very quickly today. A lot more blocks than we usually see. It's a OPEX Friday. Generally see liquidity dry up after about 1 o'clock p.m., especially these last couple of weeks of the summer. Our kids start school on Monday. So sleeping past 6 o'clock isn't going to happen anymore. I usually get up around 6:15, 6:30. I know some of you on the West Coast must get up really early. But I'll be getting up at 5 with the kids again, make breakfast or whatever. All right, VIX dropping off again. VIX is dropping. This is look for a rally. VIX is dropping, looking for a rally. Okay, we're not too far off of going green on the day, about 10 handles. Futures are off 950, reversing. Bum, bum. Okay. VIX still dropping off. NYMO is turning from minus 108 to minus 77. Last time we got down this low, market on close yesterday. Last time we were at that level was March, led to the recent rally into July. I'm not under any illusion that we could see more downside before forming a base. Okay, the 10-year dropped pretty dramatically, about 5 basis points from 4.27% down to 4.22%. The dollar is hovering near the lows. VIX is dropping off. If that can continue, we could see a follow through. U.S. steel pushing a bit higher, higher highs, higher lows, VWAP up and to the right. Or S&P trying to push higher. S&P is on a 5-minute buy signal. Let's see if we can fill the gap.
Is the house view within PIMCO that are there a bunch of, is it wide? No, I think we very much agree on this. I think what surprised us is that the economy has been quite strong and the labor market remains quite tight, and I think that's something we're going to watch quite carefully over the months to come.
Do you guys think we've seen the high in yields for the cycle?
My crystal ball is a little broken, but we're very close to a high. And I think the way we think about it is rates are very attractive. What's the exact high in terms of what the 10-year will be? Honestly, we don't know. But over the next 18 months, they should offer excellent value for investors. And I think that's the exciting part when you're sitting where we are in the bond market.
Well, that's what I was going to ask. So you said 18 months. There is this narrative going around that we should all just get used to higher rates, and that the abnormality was what we saw in the last, 15 years with financial crisis.
All right, we're looking for higher lows, higher highs. We printed a higher low. We're printing a higher high right now, looking for a push into the gap. Maybe go green on the day. Tick cumulative is turning up. VIX continues to drift a bit lower. Dollar and the 10-year are starting to bounce, so
How are you thinking about Libby Canfield does great work on policy, and it's been a summer of discussion about political dysfunction, and who knows what the next year is going to bring on that front. But how do you think that plays out in the rate world? Mantra that I've learned a long time ago about the notion. Also have a situation in the banking system where no one quite knows how much capital banks need, and you will see seller of assets.
all right, looks like some mean reversion back towards the 20 EMA on the 60-minute for now. We accelerated lower for the past couple of days. Yesterday, pretty markedly. Seeing more shorts covering now.
Well, that was the good news because we're selling a lot of bonds, right? And there are some questions now about issuance and whether there will be demand from places like China and file those bonds and other investors.
You're right about this, all right? I think there's plenty of demand, and then it's a matter of finding the right price and finding the right opportunity. But I really would not, I would really think about the amount of money that can move very, very quickly at the right price to buy bonds. And I think we'll see that over the months to come. Interesting. Meaning, if there is a decline in yields to come, it could happen quickly. Quite quick. Not a slow degradation quite quickly. And I think the right thing to think about is the expected return of the bond portfolio, which yields something like 6.5 to 7% once you put corporate bonds, once you put mortgages, and it's quite attractive by any historical standard. If you think of a world where stock delivers 5 to 7% over the long run, all of a sudden, fixed income does look quite attractive compared to this, given the fact that it's the lower part of the capital structure.
So what does that mean for your business? Have you seen the inflows?
It's been a good 8 months, and of course, if we're right and we see many more people coming back to fixed income, it'll be quite good for us, and it'll be more importantly good for investors as they will see significant returns on their portfolio. How do you think about those who argue we're in the early innings of a new default cycle? This maturity wall will come eventually for corporates if rates stay in this neighborhood. Is that dangerous? I think you can always see moderate default cycle, and if we have a recession, I'm sure we will see elevated default, maybe more in certain industry. But the reality is that it's hard to imagine, given how strong the economy is, a hard recession. I think the most likely scenario, and that's what Rich was saying last week, is you'll see a couple of quarters of a mild recession that would be technically be a recession, but we may not feel it as much as we felt it, let's say, in other large recession. I'm thinking 1991. I can date myself.
It'll just feel better. So where do you, within fixed income and with these high rates, where do you guys see the most opportunities? Is it in corporate?
They are a lot. The mortgage market looks quite attractive. Some of the investment grade looks really attractive. I think you can look at it and say
VIX still dropping a bit.
the private markets where your
Love to see the dollar roll over here.
looks quite attractive. There's a very big market, which is not in mutual fund, which is a private fund that looks quite attractive. And at some point in time, real estate is going to be also quite attractive. PIMCO has a big real estate arm, and I think we will position ourselves to try to benefit from multifamily and at some point in time commercial real estate. At some point in time, and it's going to be a long cycle. But I think you want to think about this, and you also want to think about real estate lending as a way to leg into this business at the right price and with the right assets. China, are you on the lookout for some kind of Lehman moment? Are we back to watching Evergrande and Country Garden the first thing we do when we wake up? It's very hard to tell. The one thing that I think we see from the data is that China is in deflation and that the economy is quite slow. It's very hard to figure out what's happening to the real estate market when it's weak, how weak it is, and what happened in terms of technical default. We don't know. Is it a risk factor for U.S. assets? Is it China? It is if the Chinese growth is even weaker than what we think it is at some point, then it would slow down the economy quite a bit and be a factor for a recession. And I think that makes sense. And I think if we see that, that may very well be the fact. But it's not the most likely scenario. The thing which is really surprising is I think the economy is doing better than most of us thought 9 months ago. And it's but actually, the basis, the US looks much more attractive than Europe. And I think that the problem with Europe is you need to have a business model in terms of the competitiveness of the Europe. So, in terms of how you compete against Asia on one hand and the US. And of course, the one thing that is affecting Europe is the war in Ukraine and the high commodity prices and how it's all going to unfold with very little progress to speak of over the past 18 months. Of course, the expansion of the United States. It's kind of unfair to compare because they do have that right in their backyard. Although it's ex-Ukraine, we had Larry Fink on a few weeks ago, and one of the points he made was that the U.S. can have these loud, uncomfortable discussions about policy and the future of the country, but we talk it out and something happens, as opposed to Europe where tasks go undone, right? The longer it goes, that's right. And I think also a very fragmented Europe where for 30 years they had a very strong relationship with Germany and France, and this link is becoming much more difficult to maneuver in terms of having a pan-European policy in terms of getting the right goals into the economy.
Do I see months of any more rate hikes there, especially for places like the UK?
You'll see a few more. The UK has its own particular problems. The inflation numbers in the UK look better than what we expected, but we think the economy will be challenged. And as a strange thing to say, we had our first forum at Bingo outside Newport Beach. We're doing it in London in September, so I'm quite excited about what we're going to see there. And we're all going to Europe, and every single event professional is going to see Europe on the ground.
Do they want US assets? Is that what?
No, we want to have a debate and sort of debate about where the economy is going in Europe. But for the first time, we usually have it every quarter before beat. For the first time, we have it in Europe. We're excited about it. That takes me to the last question again. Running out of time, but what's hiring like? Is it aggressive headcount reduction mode, increasing? Neither. It's extremely boring. We flat. But I think the one thing we're incredibly excited about is technology and what artificial intelligence is going to do in terms of productivity and what it will do over the next 5 years to our organization. And it's everything we need to be excited about this. And I think that's something we're investing quite a bit about. We have a partnership with OpenAI, and it will hopefully be better tools to our client, make us maybe better investors, and certainly make us more productive. And I think we should embrace this. There's an enormous amount of public money in terms of what may or may not happen over the next 5 years.
Well, I'm curious what that partnership looks like with OpenAI and bot trading.
They are deeply about trying to analyze a lot of data very quickly and be able to simplify
S&P continues to push into the gap.
the ability to crunch all of these things is actually incredibly powerful. It's the semantic of generative AI and something that makes us better at our job than we would otherwise. And is that about the client interface? Is it about actual trading? Is it about back office productivity? I think all of the above. I think you're absolutely right. All of the above. And I think you see that's one of the things that I think positive about economic growth is I think it's going to make a lot of people like us more productive because of what we do. But it's also the ability, for example, to recall every single conversation sort of be able to see trends in various disparate form of news, whether it's sound, like we're talking right now, video, to written material, exactly. But the whole organization is up to speed on everything that we're talking about. We're trying. There's a lot of room for improvement, and it's a long process. But I think
Okay, so we continue to move higher here. Higher highs, higher lows. Trying to fill the gap. All right, we've got a couple of million share blocks coming through on SPY. Okay, above 433.85. All right, let me see. Let me go to SPY here. SPY. That way it's more. Okay. Okay. Above 435.50, 435.50.
This stream is sponsored by TechStrike. TechStrike allows you to actually hear order flow futures, forex, and stock instruments. Get a free trial at techstrike.com.
A lot of attention being paid to Palo Alto Networks today. According to Answer the Bell on a Friday, many analysts, investors, and the
Looking for a higher low.
stock estimate this year projected to 20%. And then trading today, which caused a lot of chatter. What I can tell you, according to my reporting, is that Palo Alto said in a press release that it was going to update the midterm guidance assessment. So basically wants the analysts to have the weekend to digest the new information and adjust their models on a 3-year basis. The other thing I can tell you is that Palo Alto has a big sales kickoff on Sunday. So maybe you want to see them to talk about
Looking for a higher low.
potential plan on that information
Okay, what are the FANG stocks doing? FANG.
this week. So there is this curious case of why
Okay.
by some of those takeaways. No doubt investors will be paying very close attention to that.
Yeah, this is more conversation than I've heard in a while about China stuff. Let's see what happens later on tonight. Meantime, in the wake of those devastating wildfires in Hawaii, the state's largest power utility did an absolute crush over us today, taking the shares of Hawaii Electric.
Looking for higher lows to print.
Up today, clawing back some of those this morning, facing lawsuits for its alleged role in the fires, accusations of mismanagement, and reports that the company is in talks with restructuring. Joining us with his outlook is Tim Richards, portfolio manager for the Fidelity Utilities Fund. Fidelity is one of the top institutional investors in AEP, and it's good to have you. I guess the headline today was that the company argues restructuring is not the goal. Was that the reason for today's bounce?
Well, yes, first, thank you for having me on. Good afternoon. And I'd like to, as a firm, we'd like to extend our prayers and sympathies to the victims and families of this tragic event, as well as to the residents of Hawaii. And the stock is going to continue to move off for some time, trading on news, and clearly that's a positive indicator. We have to look at what we know and what we don't know. And there's certainly a lot that we don't know. There's the negligence standard in Hawaii is a little bit higher than California, but nonetheless, certainly is causing crisis.
All right, VIX trying to hold this level.
Management can't say with certainty that they can anything. Can be isolated and separated with $459 a share. Yes, management is not interested in Chapter 11 at this point. They believe they have sufficient liquidity over the near term to get through with their maturities near term. But I think one of the important things is to try to understand how they're working with the state. People have wanted great pride in their state. Hawaiian Electric itself has its employees and management great pride in their being part of the community. And to the degree the state can work with the company as they look to restore confidence in this crisis, as well as restore service and rebuild and come up with policy going forward, will be really a primary determinant of the value of the company long term.
Do you think that the bigger problem is the criticism that the company is facing for not turning off the power despite the weather forecasters, warnings for these winds, that the potential liability there? Is that what investors are focused on?
Well, yes.
All right, looks like a short-term top here.
In other states, the jury award for specific corporate religion amounts. We have this uncertainty. We have the credit rating downgrades, and the accusations are going to be there. Allegations until the investigation is complete, and so clearly that's what's causing the crisis of confidence.
Well, we also Tim, like PG&E in California, even though I think it was bound to follow the safety standards, was just saddled with so much liability. So there's been fires that have forced into bankruptcy. So that's that.
Right, and so as a big picture, looking long term, let's use California as a template. Yes, PG&E faced significant liability. The state and policymakers passed legislation, wildfire legislation, set up a wildfire fund, a $20 billion wildfire fund. They set up, a policy where the companies have to file wildfire mitigation plans. We get safety certificates to be part of it to restrict their liability, and they raise the liability standards. Since PG&E, and we are a holder of PG&E as well, has doubled the share price. It's one of the strongest performers year to date, as are the other California companies, Edison International as well. So I think if we can step back and look long term and big picture, utilities are partners in policy making with regulators, government, and the customers. And so, we need to they need to come up with a long-term solution that benefits everyone. So I think bring up.
Yeah, not to mention the broader discussion of what it's going to take to modernize the grid over the next 7 or 8 years. We'll have that discussion, I'm sure, at a different time. Tim, it is a tough story. We appreciate your help today. Thank you.
Okay.
Later this hour, renewed NVIDIA optimism and a fresh street high. Rosenblatt's tech analyst joins us to defend his now $800 price target for the stock.
And speaking of chips, watching AMAT, better than expected outlook. Shares are higher today, much like NVIDIA analysts pointing to AI as a major growth driver. Of course, NVIDIA results coming next week. Stay with us.
agencies in Beijing and Moscow are targeting American private space companies. They issued a new advisory to the companies this morning, saying the attacks could come in the form of hacking computer networks, moles placed inside the companies, and foreign infiltration of the supply chain. White House National Security Advisor Jake Sullivan reaffirmed today the U.S. will approve sending F-16 fighter jets to Ukraine following training. Ukraine has been asking for the jets for more than a year now to help defend Kyiv against the Russian invasion. It is unclear when the transfer will take place. Some daring runners pushed their bodies to the extreme in the world's coolest marathon this week. Competitors took off from the North Pole starting line in near freezing 35-degree temperatures. American Melissa Cullender crossed the finish line first in the women's division. Sarah. Okay, Silvana, thank you. Silvana. Now, after the break, Advisors Capital Management's Joanne Feeney is going bargain hunting. She's going to give us a few names in the retail and restaurant space she thinks can outperform from here. When we come right back, Dow up about 6 points. Halfway through the hour, let's dig into the broader market. Our next guest sees rates staying higher for longer, finds value in the housing rebound with top picks like Lennar and Home Depot, and bullish on cost-friendly brands like TJX and McDonald's. Joining us now is Joanne Feeney, portfolio manager for Advisors Capital Management, $6.2 billion under management. Joanne, it's good to have you. How are you guys positioning broadly for the second half in terms of exposure after a strong first half and now some levels here in August?
Yeah, hey, Sarah, it really depends on the client.
Sorry, I had you guys on mute. I've been talking here. Looking for a higher low and a push.
A dividend yield well above market average. We have several strategies to help them through. But as you pointed out, one area that we are excited by is the bargain hunting consumer, whether that's a Target or a TJ Maxx. Those are good opportunities. Or McDonald's, because they also bargain hunt. They're going out to eat, especially in this environment with inflation, coming down, but having taken a pretty big chunk out of the purchasing power of the average, particularly mid-end and low-end consumer.
TJX is widely appreciated, especially after this week. Target, maybe less so, even though it had a decent earnings, a lot of bearish sentiment around market share losses and what happened during Pride Month. Why do you think it's good value?
Yeah, I mean, clearly they had some missteps in managing through culture sensitivities in the market. You know, that was hopefully something they learned from and won't be repeated. But more fundamentally, when you look at the offerings that Target has for consumers, the quality of the product, the attractive price levels, the variety of products in the stores, you know, it's just a solid retail play right now when the consumers' budgets are being squeezed. And what we've seen so far is that while real disposable income have risen for the past several months for the U.S. consumer on average, it's mostly because people have been getting jobs, more labor participation. The average consumer is still struggling to a great deal, so they do want to go and Target. I think, you know, Target offers a lot, and also they have a pretty strong back-to-school opportunity ahead.
I wonder when you say they're being squeezed, how that fits with what we're seeing in household balance sheets. I mean, you're seeing this uptick in delinquencies, but low by historical standards, and clearly excess savings still exist. Although I guess is part of your thesis that goes to zero at some point, and then behavior really changes.
Yeah, so Carl, there's two ways to really look at the consumer. One is the individual household, and the second one is the aggregate situation of the U.S. economy. At the aggregate level, more people have become employed. So aggregate purchasing power has risen. More people employed, even though inflation has been high, and wages have just recently only begun to keep up with that inflation. The average household has struggled. They've been squeezed on purchasing power. But in aggregate, more people are employed, so the aggregate spending opportunity and you know, potential is still pretty strong. You know, now we've got folks going back to school. That's an opportunity for retailers like Target. And we have yet to face, you know, higher student loan repayments coming, relatively small in aggregate. But again, for some households, particularly in the middle class, that's going to squeeze their ability to spend on discretionary items. So that's why we continue to like to bargain under opportunities, Target, TJ Maxx, and then again on the restaurant side, something like McDonald's. And by the way, all of those opportunities include a bit of a deal for our clients that are in retirement. They're trying to live off their portfolios in the midst of, you know, what still remains a pretty uncertain environment from a macro perspective.
Right. I wonder if you're looking for names that are pretty much North America exposed, or if China or international exposure is a liability at this point.
Yeah, it's really mixed, right? You don't want to pick a country and say, well, that's the country to go to. What we do in our international strategies is look for particular opportunities all over the world and you know, so go investigate them and select them and try to control for country broad risks. In the balance strategy, which I help we do go for some international stocks. For example, a Walmart day making offers an opportunity to own a stock of a company that's gaining share, where you know there's a lot of opportunity to offer better prices for the next shopper, and that company that's still awesome.
All right. Well, thank you for joining us for some of the strategies that you're working on for clients. Joanne, appreciate it.
Some new reports providing more details about the timeline for this Instacart IPO after slashing its internal valuation by more than 2/3. Is that a name you want to own? We'll talk about that afterward.
We're also watching Estee Lauder today. Off the session lows after guidance in flight. Recovery in the travel retail business in Asia is a concern. The stock was hit pretty hard into earnings, further slammed on guidance, and now it's back down 1.6%. We'll be right back.
Okay, we continue to fade from that high, just shy of 43.70.
country's largest online grocery delivery platform, reportedly planning the September IPO, and could publicly file those plans as soon as next week in a highly anticipated boost to the market. That's the focus of today's Tech Check. And Deirdre Bosa is back. Hey, Dee.
Carl, this has been a long time in the works. We've been playing this game of will they or won't they IPO for years, but we may be one step closer again. What stuck out to me in this latest report is that the company could file publicly for an IPO, and that would be different from last time when it filed confidentially and then later pulled that filing. The key difference here is that a public filing would disclose finances, operations, key stakes, essentially make the business case for public consumption more than a decade after this app was launched and become a household name. Public markets, however, they have not been kind to gig economy companies. Uber, Lyft, DoorDash, they're all trading below their IPO price and losing money on an annual basis. Instacart, however, may be different. While others have struggled to achieve consistent...
Looking for a higher low now?
Instacart has reportedly already achieved the milestone of GAAP net income in a quarter. The key main line is advertising business. And while Uber and DoorDash, they are now just moving into the space in a significant way, Instacart has actually been in advertising for years. It's a higher margin business. And really take a look at this screen right now. It has built its leadership around the advertising unit with some big wins and losses along the way. Fiji Simo, she was one of the highest ranking female Facebook executives, and she took over for founder of Corva Meta in 2021. She pulled over some other high-ranking Facebook ad executives like Asha Sharma to be COO and Carolyn Everson to be president. There was also Seth Dillard, a former Amazon ad chief who was in charge of overall revenue. Everson and down there, they would end up leaving, but the company also managed to gain a Wall Street friendly face in Nick Giovanni, who became CFO after years at Goldman Sachs, leading tech companies through that IPO process.
Nice higher low printing.
Instacart, they got the team, may even have the profitability in place to finally tap public markets. Certainly pressure has been building internally from employees who haven't been able to cash in on its rise. Remember, this is one of the oldest unicorns out there, more than 10 years. But the big question that remains is, are the markets and investors ready? Leave out the Magnificent Seven, most of tech is still below 2021 peaks. Instacart has slashed its own valuation a number of times. And really the key here is, will those numbers that we're going to see in that IPO prospectus that could happen as soon as the next few weeks, will that back up what has been hinted that this is a different kind of gig company, largely resting on that advertising and enterprise promise? I'm curious, Deirdre, if what growth looks like for Instacart right now, because they're in this awkward moment where people think that COVID was as good as it gets for online grocery, and not just Instacart, but everyone's doing online grocery, and now
Trying to print a higher high now.
right, how sticky is that habit? I mean, I know that I still order my groceries online, but that's key, right? I live in San Francisco. A lot of folks here order their groceries. How many sort of Americans still are ordering post-pandemic? So it did see incredible growth, at least reportedly throughout the pandemic.
We got a couple of more blocks.
Now, we can look to Uber Eats and DoorDash as maybe a hint, and we see that their food delivery businesses have held up pretty well, but they're moving into grocery. So how much of that market have they taken from an Instacart? And, you know, you could argue that Instacart missed its window. These numbers would have looked a lot better during the pandemic when we saw DoorDash and Airbnb go public. So now it has to contend with sort of the pandemic being over and people getting back to normal. So that's what many are curious to see. Me definitely.
Yeah, that was a crazy time. We'll see what this does to the market when that happens. Dee, thanks. Deirdre Bosa tonight. Instacart.
The other thing is what's happening with market share, because Kroger and Target.
All right, we got a couple more 1 million share blocks on SPY 435.35. We're above that level, so we're bullish above 435.35. Really need to get above 34.35.50. All right, nice, nice bounce so far. Looking for a higher high.
NVIDIA has been finally feeling the heat this past month despite this year's massive drop. But this week, the street has been banging the table, saying NVIDIA has started to climb heading into next Wednesday's earnings. Barclays calls it the best idea. Deutsche says AI demand will stay at these frenzied levels. Morgan Stanley reiterates top pick. And then there's Rosenblatt grabbing our attention this week amid a slew of price target hikes, going to a street high 800, implying more than 80% upside. The analyst behind that call told us this morning, Rosenblatt's Hans Mosesman. Definitely got our attention, Hans. I guess not just the target, but sort of how you're looking at valuation on a stair step in earnings over the next couple of years, right?
Yeah, so what happens here is that they probably unconstrained have the opportunity of earning the next calendar year as much as $20. The following year could be mid to high 20s. The issue is that they're constrained, and they're probably going to be constrained for the next year and a half.
What's your sense right now about what's getting pulled forward and whether or not they are, from a demand standpoint, actually stealing from the future?
No, we have too many data points that are supporting that this is real demand, and it's across a broad range of AI players and ASIC players. We have a conference next week called the Age of AI. We have a bunch of privates coming in. They're seeing the same thing. AMD is seeing the same thing. This is
All right, looking for a higher high. If the bulls are going to do this, we're going to push above 43.68. Keep seeing blocks coming through. 435.35 on SPY. We got 1, 2, 3 of those at 1 million shares each. Above 436 definitely would be bullish. We're right at 435.80 right now.
Well, we have a fundamental view of the cycle. This is the mother of all cycles. And this is secular. This company has an earnings power that is amazing. In the next 4 or 5 years, half of their business is going to be software subscriptions and royalties. And so the valuation, we're not even aggressive on valuation. We're using a 40 times multiple. But the issue is that you have to look at unconstrained demand, and that is probably 50% above what people are modeling. So if you're using what's consensus numbers, you come up with $500 or $600 price targets. But why even bother with these multiples? I think that this is the real deal. This has been our single best idea for the past several years.
Hans, 2 questions. One is, would you expect there to be a bit of a sell the news dynamic after the print next week? And how much attention?
All right, so we're about to produce a higher high now.
Targets. Was the 800 done with the knowledge of what the prior street high was?
Well, we may have been the prior high street. I think we're getting there's no reason why, people spread over the $1 trillion market cap. There's no reason why over the next 6 years,
Okay, here we go. Nice rally underway. Nice rally. All right, shorts covering bigly as we move through 43.50. Now they're accelerating. More and more puts will monetize. CNBC. Rah, NVIDIA. Nice move on NVIDIA. Nice. TJ Maxx up a buck. TJ.
and everything. And so it's leading to significant additions to content for all kinds of applications. A car, 20% of the bill of materials in a car is going to be semiconductors over the next 5 years, and 3 or 4% of it is
All right, we're about to take another high into the gap. TTM forming yellow bars on the 60-minute TTM. All right, so we're pushing, making a new high up against the supply zone again. It looks like 4370, 4368 up to 4370. Some supply up here. We gapped down. We closed near this level last night. We are trying to go green on the day. Got another $3 to go, $2.90. We're starting to head towards gap fill. TTM yellow bars building on the 60-minute as we launch higher. If you're thinking about calls, I'd wait for a little dip. I wouldn't buy this pop right here. Wait for the next dip like we had 10 minutes ago, back down to 43.58. Look for that dip to buy, not the high. These S&PW big cap options, if you buy at the high and it pulls back, you'll see your position liquidate very quickly. It's pretty interesting to watch. Does look like we have this buy signal follow through. If we're looking at the 5-minute, we've got 2 buy signals, 1 sell. If we go to the 15-minute, we're still on a buy signal. 15 minutes still on a buy signal. Since the early morning, right around 10:30, when we went on a buy signal, that was right at 43.45. All right, we're up over 13 handles, 23 handles from there. We're filling the gap. We're about to go green. S&P gap fill soon. $1. 50 cents. All right, let's do this.
Well, Carl, Pebble Beach is a window into the money and the mood of the wealthy. And right now, there are signs of caution. Total sales expected to be around $420 million this year. That's about 10% below last year. Classic car prices are down 7% this year, year to date so far. That's the first time that's happened in a while. And experts say that the big collectors here this weekend are ready to bid, at least so far.
The biggest collectors in the world are here to either reshuffle their collection or think about buying. And so far, the demand is much stronger than expected.
The question is a lot of supply, guys. There are over 150 cars up for sale for more than $1 million. Part of the challenge is we're seeing a big generational shift in classic cars where the baby boomers and older collectors, they are selling their entire collections. And this new wave of collectors, they like the newer 80s and 90s cars. So this car here, this Buick, 1947 Buick, we're seeing is priced at around $70,000. So that's created some dislocations in the market. We'll see where it all shakes out. The most expensive car this weekend is a Ferrari. And tonight we will have an exclusive interview with the CEO of Ferrari, Benedetto Vigna. We talked with him a lot about what's happening in China, what's happening with the high-end consumer in the U.S., and of course EVs. And yes, Sarah, a lot on Formula One. Guys.
They're asking why they're number 4 and not number 1, even though they've got some 2 great drivers. Robert, on the classic cars, I wonder how important it is for those valuations as it relates to new cars. Is it like sneakers where the most valuable old school names mean that that's what's cool right now?
That's part of it. The other part of it is new cars were so hard to buy during the pandemic, as were used cars, that all of that started to spill over into the classic car market, and it raised the values for everything. And now we're seeing new cars easier to get, coming down in price. That may be one reason why we're seeing a little bit of a letdown in price in classic cars, because all cars are easier to get right now.
All right, good point. Robert, thank you. Robert Frank from Pebble Beach. So big news on Starboard and a new steak this morning. Something Jeff Smith, remember, hinted at when he was on this show about a month ago. Remember this?
I do think there are good opportunities in the restaurant space. I'm not ready to talk about it, but we do think there are really good opportunities. we do think there are really good opportunities in the restaurant space.
Well, turns out he does, because we just learned that that's Bloomin' Brands. Starboard disclosing a 9.9% stake in the company this morning. Stock's up nearly 40% on the year, but long-term has underperformed. Bloomin' Brands telling CNBC, quote, "We are committed to driving shareholder value and take all viewpoints of stockholders into consideration." What I've learned here about the stake and the conversations is that they're very friendly, and Starboard looks forward to a pretty open dialogue with management, and that Starboard thinks that the stock is undervalued, and they've got a lot of experience operationally with restaurants and turning them around. Darden is a prime example, and there's a lot of comps there because it's a conglomerate. They had Olive Garden. This one's Outback.
Yeah, friendliness is the hallmark of this actor's era.
So far.
Have a great weekend. Let's get to the judge on this Friday.
Well, thanks so much. Welcome to the Halftime Report. I'm Scott Walker, front and center this hour. Another tough week for stocks, and there's questions about just how far this correction might go. The investment committee debating your best moves in this still unsettled market. And joining me for the hour today, our investment committee, Carrie Firestone, Steve Weiss, Josh Brown, and Brian Belsky. BMO is Brian Belsky here on set 2. Happy to have him. Check the markets. Dow's positive, highs of the day, 65 points thereabouts. S&P is now green as well.
Okay, we're fluctuating. We're right at going green on the day.
That's kind of the way it's been for the last couple of weeks, Josh. You've got some technical difficulties, as we would say. Dow, S&P, NASDAQ all below their 50-day moving averages yesterday. You've got sort of momentum is dried up. Third negative week in a row. Russell's not doing well. So you can sort of pick the area of the market you want to pick on, because there's a lot of places to look at.
So I've been in the camp that this is seasonal and is what you should expect in the month of August. And I have a million charts that back that up, and I'm not ready to move away from that argument.
I would agree with Josh 100%. It's seasonal.
I do not think that this is about all of a sudden there's going to be this renewed push for a ton of new rate hikes. And in fact, most people, you ask them what's going on in the market this month, why did August suck so much? They'll tell you, oh, well, the odds the rate increase are substantially higher. No, they actually aren't. Actually, it's a 90% chance of no hike and a 10% chance of a 25 basis point hike, and that would be okay. I don't think that is a huge difference. Now, we do have some positioning stuff going on, and a lot of the macro people will tell you, look at yields all over the world. They're higher. Okay, it's a steepening. It's what you should have. If GDP now forecasts are to be believed, we're going to have another quarter of strong growth. Why wouldn't we have more steepening? So for me, that's enough. One area of concern, and I'd love to get Belsky's take, maybe 7.25 is too high for 30-year mortgages. Like maybe that's where things get real. And the sell-off in home builders yesterday was probably the proximate cause for that was probably that mortgage number. Maybe that's where I have the most concern. How much higher can that go before something gets hurt? But other than that, I'm just not seeing what other people are seeing, and I think this is a textbook August doldrum kind of pullback.
Yeah, Brian, the correction thus far, S&P is down about 5.5%. I thought Goldman's Tony Pasquarello sort of set the scene well in his most recent note where he says, quote, liquidity is ebbing, price action skittish, and tactical nerves are suddenly a bit frayed. That pretty much sums it up.
I love ebbing, right? Josh and I were talking beforehand, and you go back and look at my career, and August is always something going on. And remember, last year was very, very volatile heading into September. And so we're not surprised to see this weekend. We've been talking, this weakness, we've been talking about this for quite some time. And you talk about the home builders, Josh. I mean, I think people forget that home builders actually were one of the best performing industries after tech. So this could simply be some profit taking, number one. But number two, that 7% number on mortgages does freak some people out. But remember, also from a supply standpoint, you got a lot of supply coming in the home builders. So I think that's an area that you want to start with these types of reactions on stocks that have been outperforming, Scott. You want to try to make a list of some of these things to bottom fish a little bit in September.
So you bumped your target on the S&P up on June 5th. Yeah, right, from 4,300 to 4,550. At what point do you start getting a little nervous about 4,550, just given the unsettled nature of where we're at, and also seasonally, as you said, you know, September, October could be a little tough.
September, October could be a little tough. I'm actually more worried that 45.50 might be too low because I think the way earnings are coming in, Scott. So the way that earnings are tracking, I think there's a very good shot that we make it to our bull case of 230, and I think that could ultimately buoy stocks higher in October, November, December. Remember, September, we're more back to normal than we have in the last few years. And September's conference season. We're going out and visiting companies. We're talking to companies. This has been the bottoms-up stock picking type market this year. And this is all about fundamental stock picking. So I do think we're going to see some sort of a rebound and really strong fourth quarter, which would actually get us closer to the 50-50.
But you know what's not back to normal, it's sort of back to abnormal, is China. Right? And that's this overhang that we're trying to assess. You know, the recovery was sluggish, and now it looks like a deceleration in growth there. And, you know, where the market was able to brush that off for a while, seems like it's having a harder time doing so now.
I think from a growth perspective, that's why I think Josh is spot on with respect to the potential for further rate increases. If China is actually going to be really slowing like everybody thinks it is, then the Fed may have to think the opposite direction, number one. Number two, remember, emerging markets in China did very well last year. So this could also be part of the unwind on that side. But there's no doubt that there's massive fundamental and macro issues in China that we should avoid.
Yeah, so Gary, you know, Michael Hartnett over at Bank of America sort of sees this swoon, if you will, through the summer. Maybe you go to 4,200 late summer. But there are others who say, okay, you know, I think Brian is channeling this point of view as well, that even if you have some selling here and some profit taking in tech, that you get through the fall and it could be a little ugly like it typically is. And then you have a ramp, though. And you have a ramp into the end of the year that can still get you to some nice targets.
Well, that would be quite a swoon if we go to 4,200, and we're not thinking that's going to happen. I suspect that people will start to take the opportunity with some of the tech names that they've missed to begin to nibble. It's interesting that it's
Yeah, I would agree. Some of you are already thinking about nibbling, like acceleration, looking at Tesla. Tesla's starting to turn.
So far today is that we're seeing a settling down and people are coming in and buying. So obviously people are watching, investors are watching what's happening with these names that have led the market. And in general, as Brian pointed out, earnings were decent. They were better than feared. And if GDP is really in the 4 to 5% range or even higher, we're going to start to see that in earnings. You know, we're a consumer economy. If consumers are spending, which we
All right, I'm going to make some lunch for the kids. Give me 10, 15 minutes. Probably not that long. I will be right back. I'll be monitoring on my cell.
So I think that settling down right now is a good idea. It is healthy. It was what we needed to see with the mega cap names, and that's what we're experiencing. But we can start also to see why.
We're actually going through it, right? I mean, we all know that story. By the way, we've been talking a lot, Weiss, about, you know, the inability of the market to find its footing, so to speak, as long as interest rates continue to go up. You know, rates have been backing up. Now today, at least they're backing off. Apple's been going down pretty consistently. Fire's coming in though. It was red, now it's green. And it's no surprise that as those phenomenon happen, it's enabled the market to turn a corner, at least as we come on the air here and get back into positive territory. What do you think about that?
Yeah, I think today is tied to yields. So that had been the story. So while I agree with Josh that the base case remains the same, which that the Fed's done, inflation's under control, and the economy is strong, and there'll be no landing, soft landing. That's the base case. But there have been some nicks in that story recently. And the nicks are, will there be China contagion into the U.S.? Are rates too high? And will they stay higher for longer, which has been my base case? And then, is there going to be some softening? Is is what the Fed has done over the last year and change finally trickling into the economy, as well as you see student loans and savings? Savings have been completely depleted if you look at some of the data that's coming out. So those are the nicks in the armor. That's exacerbated by high volatility rather, and low volume in the seasonal period. So look, I think the market's okay, but I think it's a great opportunity to trade the market in certain instances. Today being a perfect example. Meta was down, $9 or so I took the opportunity to buy a trading position in addition to the position that I had. As you may recall, I shaped it about a month ago. So you get opportunities to trade if trading is part of your expertise. If it's not, you're best off just buying and holding. But the other thing that's really hit home, and when you take a look at Apple, I think it's a prime example, is that people realized, hey, valuations were excessive, that the move in the market was multiple expansion, and by the way, some of these stocks did not deserve it. Apple, in my view, being one of those. So, look, I think at this point there'll be more realistic in valuations going forward than just a pure momentum market. This is going to take some work to figure out.
PEs, mega cap PEs have come in, obviously, as the stocks this month, for example, Apple down 11.5%, Microsoft 6.5%, Alphabet 4.5%, Meta 12.5%, Nvidia 9.5%. Josh, you have to believe that there's so much optimism around those names that it wasn't going to take much more for buyers to come in. It's not like the stories have really changed. There's so much hype and optimism around AI and the positioning that these select companies have within that universe and where we think all that's going. Buyers were going to come in. It's just, are you going to get enough buyers to come in to reverse some of that steeper selling in names like Apple, which, some have suggested could eventually trade back down into the 150 number.
Yeah, so number one, we're talking about stocks that are up between 50 and 80% off their lows from less than a year ago, last October. If you froze the market right now and you told everyone, sorry, we're closed until December 31st, nobody in those stocks would be unhappy with their year-end 2023 performance. What's more interesting to me is if we're really going to get the rotation. And, I was all on board with, okay, let's look at small and mid now. We had a really big run in the first half. Now let's pivot. And I wanted that to work for a lot of reasons. And it was working. You had this furious 15% rally for small caps, which had done nothing up until May. You had a lot of participation. I was with Eric Balchunas last night talking about ETF flows. All of the money was going into mid caps, or equal weight ETFs, which is really interesting. But then look at August. The small names are doing worse. The Russell 2000 is down 8% month to date. The S&P is only down 5%. So that narrative might hold true for the rest of the year, or it might already be over. And I'd love to hear what your take is on that. Can you look at other stocks besides the S&P 50?
Well, Josh's point, you're looking at small names and you see attractive valuation. But that doesn't mean that attractive valuation means good buy now. Right. So let's talk about the rotation and the back to normal, owning all these other types of asset classes from Smith to Value to Garth and all of this. So what we looked at this week was the 4 major pillars. So relative performance versus the big caps, relative earnings growth, relative valuation, and relative operating performance. And from all 4 of those, especially performance, obviously, because they got killed in valuation,
valuation, we're seeing multi-decade lows. So that tells us that, especially on the back end, on the operating performance of these names, small mid cap in terms of return on equity and free cash flow, they're amazing names. And so we do believe that you want to have exposure there. And clearly, August was all about long duration assets being penalized, tech and small cap. So we think actually this is an amazing opportunity to do your bottom fishing and your work on a fundamental basis with mid cap world and really start to add to that type of allocation.
I think we're going to get to Josh's, questions about a rotation, whether you're actually going to see it. You really think we're going to get it? And if so, why would you? Why
Well,
would you?
I think everything's going to go back to normal. So why would the investment cycle go back to normal? So you had shock in 2022, you have awe in 2023 because we feel a little bit better. But as
What's everything going back to normal? What does that mean?
Well, we're going back to work. We are starting to see the trends of normalized earnings growth, normalized valuation, normalized interest
We're
rates.
still negative earnings growth, though. Let's not paint a
I'm talking over the next 3 to 5 years.
Well, okay, that's a much longer
Yeah,
time.
over the next 3 to 5 years. As you're an investor, we need to shake things out, and we're positioning for that. Steve said we're higher for longer. Yeah, that's great. Of course, we're higher for longer. Higher for longer, and interest rates are going to be higher than
But
zero.
see, everybody, look, but anybody would come on and say, well, if your time horizon is 3 to 5 years, it's a good time to buy stocks because they traditionally go up over 3 to 5 years.
Right.
That doesn't help people that much. I
But
don't
you
think.
have to go through the.
I would argue that helps people more than what's going to happen for the rest of the month of August.
Well, who cares about the rest of the month of August? We can talk about the rest of the year. I think it's potentially more relevant than thinking, well, just blanket advice. Well, 3 to 5 years is great. Earnings are going to be much better 3 to 5 years from now than they are today.
Wait till you see it 10 years from now.
It's a process, though, right? It's a process. You can't have one of these periods, Scott, where you have massive outperformance of growth for 10 to 12 years and no representation from value or no representation from small mid cap. Remember, the best thing about America in terms of the growth is about small mid companies, not just the consumer, it's small mid companies. We think it's a burgeoning asset class that actually is massively under-owned, and from a contrarian basis, now the fundamentals are telling you to buy this. That's why we're so excited.
Less China exposure.
Correct.
Is the positive. If you equal weight a portfolio, so 16, 17 times earnings, much less than market cap weight. The negative is historically more interest rate sensitive. So is that going to be a risk to the rotation, to the value trade?
I want to get
Do these companies have to roll debt?
But he asked the question, Kerry. Josh does. What's your answer to that?
Will it make a difference because of interest rates? Well, of course, on the small cap, mid cap, they can move a lot. But this market, you're looking at two companies, Apple and Microsoft. They are worth about the same as the bottom of 300 names of the S&P 500. I mean, think about that. So, of course, those stocks move. I hope they move. What matters overall right now is, what those big guys, girls are doing, because 15% weight in two stocks, that's what you got in 300 names in the S&P. So we really all have to be concerned about how the market trades now.
Why small, mid, or mega? What's the best way to go right now?
It's really bottoms up, but here's what I'd say. If you look at what's happening in the lending market, credit is much, much tighter for small and mid-sized companies than the large cap companies. And they need to keep borrowing. And if the economy does hit that rough spot, and look, the economy's not evenly advancing. We see that, through reports actually, and you're right, Scott, earnings were down again this quarter. So we're in an earnings recession, let's be clear about that. That impacts the small companies much more so than larger companies who don't need to finance, particularly the ones that you highlight. They're cash cows. So they can still borrow if they need, they don't need to below market rates, because who doesn't want them as a credit? But in terms of just any lending survey, any data coming out of the Fed shows that credit is getting very, very tight there. And even if credit weren't tight, what does it do to your margins? Sure. When you see money go from 3% to 7% and higher, during the past year.
What if I made the argument, though, to you, the time to be negative earnings was 6 months ago? Not today, because you have to at some point make the argument that they troughed and that the negative earnings growth that we've seen is going to rebound, which is the projection for, the earliest part, and once you get into more significantly into 2024.
earnings will rebound at some point. I'm not that optimistic right now. And the reason being is that rates are going to stay high. So what's going to be the catalyst for earnings to have a significant pickup, right? Particularly as you've depleted the household savings that you have there, particularly as you see credit card delinquencies slightly moving up, particularly as you see household debt increasing. What will be the catalyst?
The other issue, I don't know. I just feel like if the economy is going to be much stronger than people think, there's your catalyst for an improving earnings picture. I don't necessarily think you need
Inflation moderating.
that hurts margins a bit, obviously.
Inflation moderating is
I'd say inflation
is
is
a
helped earnings,
potential
actually.
contributor to earnings troughing
Yes,
and then turning higher.
Yes, inflation has helped earnings. That's part of.
No. Let's all stop. Inflation has helped revenue. Earnings can improve if we get to a situation where we're not just relying on pass-throughs of costs, but we actually have a situation where companies can breathe again. And if the labor market gets a little bit less tight, I would argue that that's a potential source of earnings improvement.
I want to turn our attention to in the final. Hang on, Weiss. I want to move on because I only have a few minutes left in this segment. I want to turn the attention to Nvidia. Just because what's been happening with Megacap and the meltdown that we've seen, and I mentioned the stock this month is down 9.5%. We've been talking about it a lot, and for good reason because, Josh, you're the expert on this one, and the pressure's got to be real high. Just it'd be high enough anyway after the dramatic stock move that we've had, but now with the pullback, now with questions about Megacap tech, man, that bar is going to be real high next week for Nvidia.
I agree, and you got street high targets now with 4 digits.
Almost every day you're getting a new target.
Listen, there's a lot of enthusiasm for the stock. It's well-founded enthusiasm based on the fundamentals. The only real the debate is not is Nvidia going to kick ass this decade. The debate is, are you overpaying for that right now? And I can see where you could win that debate just very simply. This is one of the most expensive stocks ever in the S&P 500 right now. Actually, it is the most expensive. It's 40 times trailing 12-month sales. How many stocks have gotten to a valuation like that and have rewarded their shareholders 3 and 5 years out? Not a lot. The thing is, historically, gives you nothing on a 12-month look ahead. And you've had a lot of really expensive stocks continue to get more expensive or to excel. The most bullish thing I can say on Nvidia is, yes, the price is higher this year, but the fundamentals have made a quantum leap forward. And if they execute, then the price will be justified. I can't tell you this is a cheap, great opportunity. Jump in it right now. I wish I could. It's just not the reality.
But maybe you feel better. I guess I'm asking you a question. No, I'm asking you in terms of, at least you haven't gotten a continued ramp up into the earnings. You've gotten the pullback.
Dude, so the stock was $120 a share like 16 months ago. I mean, yeah, it's great that it didn't go up another 30% this quarter, but the pressure is definitely, I agree with your original premise. This is tough. You want to be in it. Look, the data center opportunity, $250 billion. They had 6% of it. They're probably going to have like 30% of it. That's the opportunity here. That's why everyone's so excited. You're just not getting that all in one quarter.
Yeah.
So that's the risk here.
You own it too? Yeah. We own it in 2 or 3 portfolios.
You're as concerned as I am that it's made the move?
No, because this is stock trading environment. Two best in brand names in terms of semiconductors, AMD and Nvidia, and I think they're going to continue to run the ship. The issue is that what you were talking about is maybe investors are going to buy the news instead of selling the news. That's where Scott is kind of going on that, right? So what we've seen is
No.
I'm not going on that. I'm just saying that the dynamic feels like it's maybe a little better going into with a pullback rather than a further ramp.
Correct.
For a stock that's already up 200% year to date.
Correct. You have more risk of selling
Selling
it.
how much is the pullback even though? It's not a substantial pullback.
No, I said it's down 12%
Yeah.
from its 52-week high. It's not even down 10% fully over the month that we witnessed the pullback, Brian.
Yeah. So, I think it's, again, one of those names that they're a very short list of names that you want to start bottom fishing heading into September.
Maybe it's the most critical. I know we keep hyping Apple up because it's the size of the market cap makes obvious sense, but maybe Nvidia is the most important
This is
stock
trillion.
in this market
This-
right now?
First of all, it's $1 trillion. Second of all, I think a large part of the NASDAQ rally that we had this spring and into summer was predicated on the AI story. It like came out of nowhere and it enabled us to all stop talking about the Fed and CPI. So NVIDIA has to deliver because a lot of other large cap stocks that have had big run-ups this year are reliant on that AI story being intact. The infrastructure, the build, the demand, like that has to stay good for a lot of other stocks, not just NVIDIA. Arguably, it's more systemic than Apple.
We're going to take a quick break. When we come back, we're going to discuss a bullish call on one stock trading at 6-year lows today. Josh called it a value trap earlier this week. The debate on that trade is coming up next. We're back on the half in just 2 minutes. We're back on the half. Let's get to our call of the day now. It's Mizuho sticking with its buy rating on PayPal. Say the stock has more than 50% upside. Earlier this week, though, Josh said he wouldn't touch it.
I think PayPal is a huge value trap. There are a lot of people that come on our show that talk about this as being cheap. I think Apple and Google Pay options are just absolutely draining their mode. It's at a 6-year low today. I still wouldn't buy it.
Kerry, you own it. So what do you think about the call? 50% upside and what Josh had to say the other day.
And for like the last year.
In fairness, yes. In fairness.
Yeah.
Okay, yeah.
Yeah, exactly. So this is the opposite of Meta, of course. I mean, Meta is a stock that was down a similar amount. I mean, I think PayPal was down 80% from the peak, and Meta was down 70-something%. And everyone said they've got nothing left. That no one cares about Instagram. It's all going to be TikTok. And many people on the show came on and said, forget Meta. It's done. They changed the name, and it's a disaster forever. PayPal has the dominant market share in payments. I understand that this is not been a great stock. It's been a horrible, horrible stock. It trades at 10, 11, or 12 times earnings. That's not the point. It's in the penalty box because it's not performing. They now have a new CEO. Anyone who's owned it and who hasn't bought more, me means their position is very small. So we're hoping that something happens, that Outskirts can do something to make this stock
What do you want them to do?
perform, that revenues start to look better. What we want to see them beat the numbers. Making the numbers isn't good enough. They've been making the numbers, maybe beating them, and then they essentially take down guidance. They've got to start raising guidance. We have to start seeing revenue growth, and that's not been happening.
Revenue
So I'd
growth
say
is
it's in the penalty box for
7%.
us.
Revenue growth is now 7%. It's been falling every
That's
quarter
terrible.
for the last 3 years. When it goes negative, are you going to be concerned with we want them to beat the number, or are you going to be more concerned with maybe there's a structural issue here?
Yeah, there could be, and we won't own it then. And it's not a stock we're proud of. We have many names that have done great this year, and unfortunately, this has been it's down 15% in a market that's up more than 15%. So
It's actually
who would want to own it? I mean, it's
Weiss, it's
Just
really
this year.
stunning. I mean, if I'm not mistaken, this market cap of PayPal, within the last couple of years, I think, was more than Bank of America.
300 billion.
Well,
It's 60. So it's one of the worst.
Oh, Weiss, you back?
You got it.
I'm here. I didn't go anywhere. Look, the issue with. Am I good?
Yeah, you're good. Go ahead.
Okay. The issue with PayPal, and you have to be aware, and in the private markets know this, is that there are no shortage of PALs that have raised significant capital that don't make any money, that are going right after PayPal. So PayPal started out with almost the entire share. Now their share is down to about 54%, or I believe trending lower. So it's become very, very competitive. It's a very tough space, and frankly, I just wouldn't be there. I agree with Josh. I mean, fintech is ubiquitous. Payment applications, ubiquitous. There's always a better mousetrap on something like this. So I would stay away from it.
Look, you can't short it because anything down 80%, the sentiment is so bad that it wouldn't take much of a glimmer of hope for this stock to rally like 10% in one day. So this is not a call like, oh, I think it's going to zero. I'm just saying there are a lot of stocks you could buy. This one is fighting with Apple and Google and every fintech that Steve Weiss just mentioned, and Gravity, and it's going to be very difficult. The new CEO is a good move. I don't think it would have happened absent the activists, but the activists,
By the way, it's gone.
they left. They left it at a 6-year low. So and now this is the last thing I want to say on this. And I think this is important. Now you have a company that effectively had this deal with eBay where they were the built-in cash register of record for that entire ecosystem. That sunsetted a long time ago. The two companies split up. And other than the pandemic, when everyone had to buy everything online overnight, outside of that, they never really found their thing that only they could do and no one else could do. The guy that's the new CEO seems promising, but understand, he's a guy that acquires things. He was into it, and he bought MailChimp, and it was a very expensive, I think, good acquisition. Does PayPal have the patience of its shareholders to start doing acquisitions right now? I don't know.
Gary, last word quickly to you. You sound as though you're going to be patient with this name rather than just sell it and move on and take the L.
We're going to give them a chance. I don't think we're going to be patient for long. We've been patient already, and the clock is ticking.
Yeah. All right, let's get the headlines now with Leslie Picker. Hey, Les.
Hey, Scott, a historic summit underway at Camp David with the leaders of Japan and South Korea. President Biden began the meeting by saying, quote, "Our countries are stronger together, and the world is safer as we stand together." The leaders have committed to a new pledge to consult with each other if there is a security crisis in the Pacific. The agreement comes as the countries look to tighten security and economic ties amid increasing concerns of aggression from North Korea and China. Former President Donald Trump is seeking to delay his federal election interference trial. Trump's attorneys asked for a trial start date in April 2026, more than 2 years after prosecutors are looking to get the trial started. Cruise and Waymo's robo-taxi app saw a surge in downloads after being approved to expand operations in San Francisco. The companies are able to start charging for driverless rides in the city with no limit on the number of robo-taxis on the road. Downloads were up nearly 70% for Waymo and nearly 80% for Cruise in the 5 days following approval.
I was not one of those download Scott, but I do trust RoboTaxis more than my own driving skills. So I see a market there.
All right. Leslie, thank you. Leslie Picker. Coming up, our chart of the day. Palo Alto's plunge ahead of a rare Friday evening earnings report. Christina Partsinevelos joins the committee next with what to watch for. Halftime is back. Just after this. We are back. Shares of Palo Alto moving slightly lower today as it gears up for a rare Friday afternoon earnings release. That decision to report on a Friday in the summer after the close is raising a lot of eyebrows. Christina Partsinevelos joins us now with more. Good to see you. Dan Ives, by the way, who loves this stock and he covers it. Now, he put out a note yesterday. He said that it was
Biggest dinosaur. I have it actually. I'm going to mention that. I have a full.
today he told us, he said it's simply because they did it on the Friday night, fears of a horror show.
Oh, wow.
Fears of a
That's
horror
even
show.
worse. He's getting even more.
Well, it says the bark's likely to be worse than the bite, but still, one of the worst IR moves ever, according to Dan Ives. By the way, it's going to be on closing bell, but nonetheless, I digress.
Yeah. The company actually, since they announced that on August 2nd, the stock has actually dropped 18%. Why? To your point, Dan Ives' point, speculation that the company could be hiding something bad since maybe attention tends to dissipate on Friday afternoon. Guidance, though, is a concern. Competitors Fortinet say customer billings will grow about 10% year over year in December 2024 quarter. That's down from 18% in the June quarter, down from 30% in the March quarter. And earnings are also soft for Fortinet, which is why the street may be fearing the worst for Palo Alto. In the Palo Alto's press release, though, they did say they would provide full year 2024 guidance and update medium-term goals throughout fiscal 2026. So I was just chatting with Sarah about this earlier. Maybe they're being considerate to analysts to allow them to update their models in time. And according to her, she said that there's a sales meeting this weekend as well. So perhaps they're just being nice and free marketing, right? We're talking about it. We're hyping it up.
every single news outlet, business news outlet has mentioned these.
You know why investing is so hard? This was a $255 stock in June, record high. And now it's like the world is coming to an end.
Okay, I'm back. We're looking for a higher low, higher high. I'm eating lunch. I'm here with you, not going anywhere.
That's not the only reason. Microsoft
Look for another higher high. I move above 43.75. Next level of resistance, 43.75.
So that really started to decline. And let's not forget that the pop in the stock was largely attributed at the time to inclusion in the S&P. So there are other factors here. The momentum died, reversed, but Microsoft is a real threat. And then, as we just heard, you've seen some enterprise slowing in terms of not just them turned on a dime.
You got the stock. Yeah, we own it. You think this is
You have 3 hours to get out.
much ado about nothing?
Or what? So run, can we put a clock on the screen, please, a countdown?
No, it's tough to say. I mean, they may be playing all of us too. I mean, it could be, but no, we own the stock. We believe in the product and the vision of the company long term. Again, this is one of these things where this is a name that's going to probably fall into your lap. You want to buy more after the dust clears. CrowdStrike's the name you like. Why?
Well, they don't report on Fridays. Let's start with that. They don't pull that nonsense. No, I think I like the roadmap. The Falcon is their flagship, and they were talking about AI years before it became a buzzword on Wall Street, because what they're really trying to do is, as one of their customers on the network has an incursion, in real time, the system is updating all of their customers' shielding, so that it's not just let's deal with one break, one hack, one breach. Let's deal with this network wide. And all of the best publicly traded businesses, especially NASDAQ companies, are these type of network effect companies. So if you think about it from that standpoint, the more Fortune 500 and large government organizations use CrowdStrike, actually, the stronger its protection gets, because the whole network is gaining from that intelligence in real time. So I like that story. I think it makes sense. The fundamentals have been great. A lot of growth here, and I think for the foreseeable future, they're going to have that area of the market and do really well. So
I guess we're going to see you in overtime then on this summer Friday.
I have a flight. I was hoping I wouldn't have to cover it, but I guess
Thanks a lot, Palo Alto.
Yeah. Happy hour breaks going out
No
the
change,
window.
please. Bump it a little later. I'll see you on Cozy Dawson. All right, Christina Partinellos. Up next, Mike Santoli with his midday word. We're back after this.
So far, so good. I felt like we were a bit extended yesterday, but there's the capacity to move lower. That's always playing on my mind this time of year, seasonality wise. If you missed the conversation this morning, we're going into an election year. And currently we are right around 6%. We just bounced. We were down 5.9% at the low today, starting to bounce back into this pattern. I fully expect that when we get back to the 50-day, we're going to get rejected. Okay, so there's that. Going into an election year next year, we tend to see August weakness anyway, seasonality wise, but looking at what happens after the election, or into the next year rather, after the campaigning is done and everything, August tends to be seasonally weak, but we trend higher into the rest of the year. That was 2019-20 Trump Biden. 2015, 16 Hillary and Trump. We had an 11% pullback. The following year into 2016, the markets rallied. 2011, 2012, that's the second year of Obama. Romney ran against. We were down 18.5%, made a bounce, a new low, and then followed through end of year into January of 2012. So you can see the pattern. The pattern, we got the seasonality in August. We tend to have the pullback. Here in 2007, 2008, that was the last term of, what was it, Bush and Obama coming in, 12% pullback. 2003, 2004, last year of, or the term with Bush, pulled back during August and again in October, but finished the year higher and fully what I expect to happen this year. We have the weakness in August, October, November, December, and rally into January. That's what I'm expecting to happen. Okay, 1999, 2000, 2003, 2004. You can see the August dip. 2007, 2008. Obama comes into office after this campaign, 2007, 2008. August, 12%. 2011, 2012. August, 18.5%. 15, 16. Pull back. That was Hillary and Trump, 11%. 19, 20. Biden, Trump. We had a 7% pullback during the Trump years. And where we are currently.
With us 6 to 7 o'clock.
Palo Alto may be a significant part of the
See what happens. We're going to have something fresh to work with.
What do you make of that, by the way? Just this Friday night earnings.
Look, I think it's probably
so
just a one-off circumstantial thing for company-specific reasons. I was saying earlier, there was a time you didn't know when companies were going to report exactly. It's not like now everything is stage managed. I also remember a couple of companies used to report during the trading hours. National Semi, they would just throw a tape bomb out there.
Yeah.
Nobody complained.
They only do it now if it's a mistake.
Yeah, exactly. Yes.
All right, you'll be.
Then you got to file the 8K really fast.
Yes, exactly. All right, guys. Well, break a leg tonight.
All right, thanks a lot.
Look forward to that. As Mike and Josh, they'll be 6 o'clock taking stock. Up next, some committee moves in tech. We hit those after the break.
Okay, it's 12:46 on the East Coast. It is Friday the 18th. I'm just having lunch. I'm sitting here watching the markets with you. Not expecting a whole lot. 43.75 is the next level resistance. If we can manage another higher high, we just had a higher low print. Now we're looking for a higher high. We just keep grinding along a rising 20 EMA on the 2 and 5 minute charts. Looking for more upside. So we're trying to stay green. We're fluctuating right here, trying to get back to green on the day, about 40 cents off. So I'll be with you shortly, just finishing up lunch.
business qualifies.
Heard one of our committee members was making a few moves today. He's Bill Baruch, some fresh buys in tech, which is why he is joining us now. It's good to see you. So you bought more Apple, right? You trimmed it late July. Why now? Taking advantage of this pullback, I suspect.
Yeah, thanks for having me on, Judge. 10% from where we sold it. It's moving down pretty good into, I like to look at the broader market right now, too, as a measured downside from where we've seen here the sell-off. You talked about PayPal earlier in the segment, and, we know who's eating PayPal's lunch is Apple. They're eating into that Apple Wallet right now. I think their diversification of revenue streams is getting a little unnoticed, and then spreading into emerging market economies is definitely something, too.
Another A is on your list. You sold Adobe on July 27th, but now you bought it back.
Yeah, we're actually buying it back roughly where we sold it. This stock has held up extremely well through all this volatility. We're doing a couple of marketing projects with outsourced marketing companies, and everybody's using Figma. I like where Adobe's positioned across the place, space and creativity. But momentum behind this name has done really well too.
And lastly, a name that Josh knows very well, and he can opine on it after I bring it up. Oracle, the new buy. Why?
Yeah, Oracle's a new stock we haven't owned, and it's done tremendous this year. They're arguably one of the top earnings beats this year. Done well since that June report. Have held really well out above there. I'm trying to find the companies that have done really well at earnings this year. Maybe not Apple so much, but and I think that the momentum will be there. I'm looking again that measured downside when this rate of change in the bond market stops. I think that we're going to see tech be able to start moving higher. I want to own the leadership.
Josh, Oracle?
I like the stock. I sold it right around here. It's not a stock that I've taken off my radar. Like I continue to follow it. I probably get more interested on the next breakout. I think it's in for some consolidation. This is a stock that's made a huge move. It went from being one of the cheapest large deserved because they've been executing. But I probably want to buy this with more of a technical catalyst. But I do think Bill will make money here.
Yeah, up 40+% year to date. Brian Belsky.
Huge balance sheet, great cash flow monster. We've owned it in our value portfolio for 5 years and non-tactical for the last 12 or 18 months. It's got the best database in the world in terms of information, so of course it's going to be a great AI play.
All right. Hey, Bill, appreciate it very much. Appreciate you
having me
keeping us up on what's going on. We'll talk to you soon. That's Bill Baruch joining us for these new moves. Coming up, we'll give you the setup for next week. A handful of names that you need to know about are reporting results. There's some of them right there. Obviously, NVIDIA is the headliner. It's got Lowe's and Macy's and some others as well. We're back after this.
This stream is sponsored by To The Tick. Daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
Free consultation. Another big week coming up for earnings. Autodesk is on our list, and it's on yours too, Carrie.
So we think that Autodesk will have a decent quarter. This has been a stock that's been in the doghouse for a while. They make software provided for building, for all types of materials, industrial use. And it's time that the stock starts to turn around. It's really built a base. So numbers are starting to come in better. This quarter will be up quarter. By next year, they should be in the double digits for both sales and earnings. And so, we think the number's going to be reasonably good. But it's about the guidance. It's going to be really about the guidance.
It always
and if they
is.
see
It
that
always
there's an
is.
improvement. Yeah.
Okay.
Of course.
Brian, Medtronic and Lowe's.
A couple great value names. Medtronic has been an area that is stock that's really focusing on their organic growth. Lowe's has been a great stock in terms of delivering earnings and dividends. The names that we've owned for a long time.
Weiss, Dick's Sporting Goods. That's next week as well, right? Tuesday.
It is. Look, the stock's been a phenomenal stock. It's probably one of the best active retail stocks there is. But 150 is sort of my price target. It's about 10, 11 times earnings now. That sounds cheap relative to the market, but it's really not that cheap. So I can't really tell you if I'm going to be there when they report or not because I'm so close to the price target.
Josh, and you
But I have no
mentioned,
reason to believe they won't have a good quarter.
okay. Josh, you mentioned at the top, Toll Brothers. You mentioned sort of your concerns around housing. What's your view of housing stocks right here? Just given where mortgage rates are, these stocks had that really big run. Now what?
I think that we asked all year. I don't understand why isn't 5% mortgages hurting these home builders. Then we asked it at 5.5, then 6, then 6.5. Apparently, the magic number is 7.25 on a. I don't know why, but that was the point at which the Bulls took profits or the Bears came in or some combination. I think these stocks will catch themselves before this correction really becomes something more major, only because of the supply-demand dynamics and the demography at play. None of that changes no matter what you do with mortgage rates. So I'd be more looking to buy these stocks on weakness than take profits at this point.
All right, quick break. Final trades are next.
All right, 4370, 4375, that area is showing resistance for now. Still hoping for higher highs and higher lows. NIMO is at minus 71. It closed at minus 108 yesterday. Okay. You guys are crazy.
At night. Closing bell, 3 o'clock Eastern. Brent Talkington will be with me today, along with Dan Greenhouse. And as I mentioned before, Dan Ives. I'm going to count you down to that Palo Alto release in overtime. Also taking stock. One more reminder. Josh and Mike, 6 o'clock Eastern tonight. You don't want to miss that. And let's do final trades. Gary Firestone.
I'm going to give you a line. Align Technologies, it makes the clear liner, braces, had a great move at the beginning of the year, and it's really been treading water, building a base. We think people are starting to spend money on goods, and definitely braces are not a service. They're good.
Mr. Freeze, I.E. Weiss.
Dr. Freeze to you. Baba, look, the worse things get in China, the more likely they come with the big bazooka. And I think that's exactly what's going to happen.
All right, so we got rejected at 43.70.
All right, good stuff. Thank
So,
you for that.
Baba.
Brian Belsky.
Raymond James, one of the last standing regional brokerage firms, a great place for a lot of the wirehouse brokers to go to, and down 10% year to date. I think it's a great bottom fishing candidate.
Good to see you. Thanks for being here. What do you got?
You know what didn't pull back in August? Energy, IEO at a 52-week high.
All right, good stuff. Good luck tonight at 6. Look forward to seeing you then. The exchange is now.
Thank you, Scott. Hi, and welcome to The Exchange. I'm Kelly Evans, and here's what's ahead this hour. Just as important as the jump in bond yields this week is the question of why this is happening. For good reasons like better economic growth, or for bad ones like too much supply and central banks losing control. We'll look at what's been driving these moves and where you can find the best value right now. Plus some major earnings drama. Yes, shares of Palo Alto have dropped 17% since their unorthodox decision to hold their earnings call today, on Friday, after the market closed. Dan Ives warns it's a PR disaster, but our analyst calls it a super fun summer Friday. He's not worried. He has a buy on the stock. He sees 30% upside from here. He joins us to make his case. And one big-name investor drastically upped his stake in one high-profile stock, but our guest is not following his lead and says you shouldn't either. A special 3 fails and a buy 13F edition is coming your way. First, though, let's start with these markets, and we kind of have a turnaround depending on where you look, John.
It's been a momentum shift. Now, it hasn't been dramatic, but it's still, we're maybe near the highs of the session right now, Kelly. To that point, I want to give you an idea of where the range is right now, because the Dow Industrials are up 23 points, just about flat on the session. It may not seem like a lot. The S&P 500 is down 6 points, or about 0.2% at 43.63. But here's the thing. At the lows of the session, we were down 35 points. We were actually up 2 at the highs. So we're kind of a little bit more towards that upper end of the trading range so far today, trying at least to recover a little bit from those steeper losses that we saw yesterday in the S&P and the NASDAQ specifically. The NASDAQ composite, speaking of, 13,262, down 53 points, or about 0.5%. That's the current state of play from the macro perspective. One place to keep a close eye on amid that bond carnage that we've seen on the Treasury side of things, pushing prices down and yields higher over the last week, is what's been happening to many of the regional banks. Remember the ones during the crisis earlier this year? We had some problems with mark-to-market accounts.
We're watching the 15-minute S&P. Still on a buy signal. We are dipping a little bit.
Prices for bonds, they're having that similar kind of effect on some of these regional lenders right now. Zions Bancorp, one of the bigger laggards in the S&P over the last week, down 10%. Comerica, similar percentage decline, and same with Truist Financial. So watch that regional bank trade roll out. Just something to keep a close eye on with rates. And then one other place that's been an underperformer over the last week has been in shares of Tesla, which is down another 2% after a drop yesterday alongside the broader market. $215 a share right now. We're on a 6-day losing streak that is seeing us now drop from the highs earlier this year, roughly 28% below those levels. So again, keep an eye on Tesla amid a new round of price cuts for electric vehicles in China,
competitors may be losing some ground there. The entire EV market, Morgan Stanley's Adam Jonas says there could be an interesting development here with regard to what the dynamic is, Kelly, for supply and demand for EVs in China. Price wars may be looming. Tesla shares, watch those. I'll set things back over.
Oh, very interesting. Tom, thanks very much. Well, investors are facing a big chicken or the egg question in the bond market, asking whether the recent surge in yields is growth-driven or more a reflection of massive treasury supply. The 10-year yield.
All right, just watching the 15-minute on S&P. Still on a buy signal. We're dipping a little bit. Higher highs, higher lows.
So should we expect yields to stay high now or not? And what exactly is moving the bond market? Steve Leisman joins us now. Hi, Steve.
Hey, Kelly, yeah, the recent sharp increase in bond yields, most people take it to the Fitch downgrade on August 1 and huge amounts of supply coming from the Treasury. But I've spoken to several top fixed income managers. There's a lot more at play here. It's not clear the move is over yet as well. Any more potential pressure could be coming.
Today's market, consumer staples, utilities, materials, real estate, energy, industrials, and a little bit of cyclicals are seeing some action. Healthcare, kind of mixed. Communications and technology mixed as well with NVIDIA. Charging back up. It's about to go green. It is green, right? So things are improving. This looked worse this morning. Looked worse this morning. Higher lows, higher highs on the 15.
Rick Weeder from BlackRock says it's just hard to go in and buy the long end of the Treasury with all that risk, and the short end is paying 5% and higher. When it's more clear, he says, that the Fed is closer to easing, there will be a greater demand for duration from these early times. Yet, all that said, one big-time bond investor I spoke with said, a 425 10-year, it makes fundamental sense. You figure a 225 your 250 inflation rate, a 2% real yield. It's only high if you're under the mistaken impression we're going back to those 2 or 3% 10-year yields of the QE and zero lower bound world. And Kelly, he says, we're well beyond.
Right, that's what a lot of people think. Steve, stay with us. My next guest says those rising bond yields are increasing the likelihood of a recession, possibly as soon as the fourth quarter. But she warns the worst thing the Fed can do is stimulate further. Let's bring in Nancy Lazard, Chief Global Economist at Piper Sandler. Great to have you here, Nancy. Welcome.
Hi, thanks for asking.
So we're kind of like, I don't want to jump ahead, but I do like that little teasing. So talk first of all about what is the risk from higher bond yields here? Because right now everyone seems to think, oh, the economy can clearly handle it. You know, Atlanta Fed says GDP is going to be, 13% this quarter or whatever the number is now.
Yeah, it's pretty high. I just think that you have a curse of the leading indicators. It's not just bond yields. The Fed has obviously tightened very aggressively, and bond yields are increasing. You have the biggest increase in the 10-year yield on a 3-year basis since the early 1980s. So we've had a very, very significant increase in yields. But because the economy hasn't hit a wall yet, there's a general perception that therefore it won't slow. But we do a lot of modeling. We just look at a lot of data, and our bottom line is the lagged effects of both the Fed raising rates dramatically and mortgage rates, Treasury yields now also increasing significantly again. They will further slow economic activity. Oh, that's a key point. We have already seen a slowdown in the economy. Why has the PMI dropped clearly below 50? Why have employment gains slowed? Why has GDP slowed? Because the lag effects of the Fed tightening cycle is starting to creep into the economy, and our work tells us the bullseye will be the fourth quarter and or into the first quarter of 2024. But for now, we're sticking with the fourth quarter as far as when the recession will start. And we have to add to that, banks are tightening lending standards very aggressively. It always works, but again, the currents of the leading indicators is the view that it hasn't happened to the economy yet, and therefore it won't.
As opposed to therefore, well, not that you're in the business of giving investment advice, Nancy, but under your quite plausible scenario here, you think, well, this doesn't feel like a scenario day by day in which yields would be pushing to new highs. So what do you think that's all about?
Well, Steve, I was surprised you didn't mention some of these huge wage increases that we've been seeing out of many of the unions that we're getting from the airlines. Starting back actually with the rail workers last fall, the airline industry that were on the cusp of potential very, very tough negotiations with the UAW. They're asking for 40% increase over 4 years, 10%. I started in the business when you were finally obviously killing inflation in the early 1980s. I've never seen a wage increases as much as we've seen. And there's like a contagion. Federal Express pilots rejecting a 30% pay increase over 4 years because of the UAL and American Airlines wage settlement. So I think sticky inflation is not appreciated as also another reason why bond yields move higher. And now mortgage rates are fully over 7%, and housing have another tumble.
It's almost like we should start having you guys predict the misery index, because under Nancy's forecast, we have both rising unemployment and rising inflation, which is not a very pretty scenario. And so there's at least 3 or 4 plausible different paths people can lay out here. And I'm just curious, her points about wages are well taken. The wage data obviously is probably the most closely followed data set as people try to figure out what the long-term inflation pace will settle out to be.
Yeah, I mean, Nancy's idea here, I'm sorry, Nancy's idea here is the scenario that really incorporates the idea of lags to the economy, which is that we haven't seen the effects yet. I will say there's another side to this which has suggested that the lags in the economy are lessened now than they used to be, and we've seen a lot of it already. There are guys on the Fed who believe that, guys like Governor Chris Waller, who say it's in the market, it's in the economy already. I will sort of counter that and side a little bit more with Nancy, which is that as these rates rise and pervade the economy, it feels more and more like there's less place to hide. It was one thing when you had like a 6 or a 7% mortgage rate, or a 5 or 6% mortgage rate. Now that there's you can't call up another bank and find a somewhat lower rate someplace. That seems to be more pervasive right now. I have no doubt that there are drags, but I will say on the other side of that, I would say we've had very low unemployment, and there will be an effect on the unemployment rate. I just don't think that in this world where there's such a premium on labor, which is what's driving those wage gains, that you're going to see tremendous increases in unemployment and recession.
Nancy?
It's not unusual. I went back and looked at the data. We have a lot of models, but I went back and looked at the unemployment rate. And on average, it takes roughly 2 years for the beginning of a Fed tightening cycle to an unemployment rate actually increases. We are not yet out of the woods when it comes to potentially an increase in the unemployment rate. We think it starts in the fourth quarter. It's already stabilized. We think it starts in the fourth quarter. And quite frankly, these wage increases are going to put even more and more pressure on profit margins, and that snowballs into even weaker employment. So we're not out of the woods. You have to go back and look carefully, which we did. And also, corporate revenues, let's talk nominal revenues, have already slowed. Real revenues, a lot of these revenues are being bolstered by price increases. Just look at the staples industry. As the Fed is successful in squeezing out inflation, revenues are starting to deteriorate, and it takes roughly a year after revenues to deteriorate for companies to go, I really have to take cost-cutting measures and start to reduce employment.
The only thing I'd say in the coda there, Nancy, is everything you're laying out to me sounds like a world in which inflation is going down. I just don't see how it's. We might get 40% wage negotiations now, but there's no way in a year or two we're going to face the same thing, and that as things soften like you're describing.
I agree. The word I'm using is sticky. We don't think inflation. We don't think core CPI accelerates from here. We think it's sticky, and it's sticky because of these wage increases. But I agree with you 1,000%. We think we need a recession, i.e., we need an increase in the unemployment rate to really see a sustained shift down in inflation. And our forecast is we're going to get it, but it will be painful for those companies that have depended upon these price increases to bolster their revenues.
60% odds by Q4, 70% by the first half. Real quick, final word, Steve?
Yeah, I just add that if you read what Powell said last year and read what's in the minutes last year, Jackson Hole, and read what was just in the minutes this week, the Fed itself believes that you need a period of below trend growth in order to vanquish inflation. We certainly haven't got that. We're not headed there this quarter. Just to correct you, Kevin, it was 5%.
I thought it was like 7. I thought I saw 6 something. I don't know.
Did they ratchet
Maybe
up
not.
again,
That's
maybe I
probably
missed
how
the
it
reason.
felt to me. I think
but-
I'm just projecting how it felt.
As you know from my work, this far out, it is overly optimistic by around 2%. But in any event, this is one of the big questions where I'll be asking next week with Jackson Hole is how satisfied is the Fed with an economy that for the last 4 quarters since they last joined at Jackson Hole, with an economy that's running at or above potential?
Great
Will
point.
that be enough to bring down?
Right. If they sort of adhere to their own projection of what needs to happen, we're not there. 5.8 is what they have for Q3. The Atlanta Fed.
All right, so we're still on a 15-minute buy signal,
Great to have you on, man.
drifting down towards a sell, a little bit lower, 43.62 will give us a sell on the 15. So many of you are looking for more a test to the lows again. Okay, it's very probable.
Fundamentals look worse and worse. Earlier this week, the country stopped releasing youth unemployment figures, announced a second rate cut in 3 months. Meantime, Chinese property giant Evergrande filing for Chapter 15 bankruptcy protection in a U.S. court last night as the property sector remains a primary concern. But my next guest says, take a deep breath, exhale. The concerns are all a bit overstated. More, let's bring in Nicholas Lardy, senior fellow at the Peterson Institute for International Economics. All right, Nicholas, welcome. And give me some context here. What's your reaction when you see things like China heading into a possible Lehman moment here?
Well, I think it's a bit overdone. They had, 6.3% growth in the second quarter. And I think the economy is doing reasonably well. They have some difficulties coming out of the COVID recession, but there are a lot of positives here. Imports are growing much more strongly than they were a year ago, which suggests underlying demand is bigger than a lot of people are saying. People are talking about deflation, but if you strip out food prices, consumer price inflation in July was actually up at a substantially higher rate. So a lot of the things that people are pointing to could develop, but I think at the moment it's premature to think that a Lehman moment is around the corner.
Yeah.
The bankrupt property company, they started defaulting on their bonds 2 years ago. This is old news. It's nothing new. We've had a significant property correction for more than 2 years now. It has slowed down the economy, but I don't think it's going to collapse financially.
Let me show. I always feel like the currency is a little bit of an objective judge or arbiter of this situation, and certainly in countries like Russia and Argentina, that's been especially true lately. But if we can show China's currency chart over maybe the past 15 years or so, what we're seeing today does look like an important move towards that trend. So there is 7.3. So we're not quite back to where we were in the mid-2000s. Obviously, that was a different story, but we're starting to break out of this recent range. And again, flip this around. It means it's weakening. They have to intervene there. They seem to be stepping up. If everything's better and fine, and as you're describing, wouldn't the currency be a little bit more calm right now?
Well, I think we need to get away from looking at the rate against the dollar. If you look against a basket of currencies, the RMB has not changed very much. So is this RMB weakness or is it dollar strength? I think it's mostly dollar strength, not RMB weakness. It's not, their Chinese currency is not weakening on a trade-weighted basis.
So then if it's not weakening on a trade-weighted basis, is the argument that you're making that in 6 months' time we're going to look at this and say the deflation wasn't as bad as we feared, the imports were better than expected?
All right, we're drifting a bit lower. We're about to trigger a sell signal. A little bit lower, we're going to trigger a sell signal. Looking for wicks and a higher low. We haven't received one yet, so had a nice run up to 44.70 and change off the low, so you guys should be pretty happy with that, I would imagine.
China is sticking to the plan that they adopted back in 2017, and that was to try to slow the growth of debt. They became convinced that, as debt to GDP, corporate and private.
Fridays tend to be a little bit more laid back, less liquidity in the evening session. We're pulling back a bit more.
Since then, some of it's less lending to property, which has led to the property correction. But I think they have taken substantial steps to reduce financial risk in the system overall.
Finally, then, because it does relate back to some of the major holdings people have in companies like Alibaba and others, do you think the government's crackdown on those firms is largely over? And what do you think their plans are in terms of supporting either tacitly or explicitly their growth and their sort of earnings hopes for the next couple of years?
Well, I think they have in place now a more regularized, normalized regulatory environment. That was the original goal, although it was implemented in a very clumsy manner that had very high costs for Alibaba and other companies like them. But we're now seeing
All right, we're pennies away from a sell signal right here, folks. Watch this. Could pull back to VWAP. Let's see what the 30-minute looks like. 30 minutes not going to be on a sell yet. Okay, we went on a sell signal just now on the 15-minute. Just went on a 15-minute sell signal. For those of you that have been trading it from 4370, 4370 supply overhead.
Glass half full. We needed that, I think, on this Friday. Appreciate your time today.
Okay, thank you, Kelly.
Check back in soon. Coming up, the case for T-bill and chill. Why buy stocks when you can get 5% risk-free? Our next guest says that's the number one question he's getting from clients. We'll tell you how he's advising them and how rare it is for stocks to actually beat T-bills. Plus, would you bet against Buffett, Burry, or Tepper? Our trader has 3 bold calls based on their latest filings, and the names he's selling might surprise you. We've got that contrarian take coming up. And as we head to break, here's a quick check on the markets. Dow is fluttering between gains and losses, down 8 right now. S&P's down 9 to 43.60. The Nasdaq's down 0.5%. The Russell, which had reached its 200-day, is now positive, and the 10-year note backing off 430 below 424 at the moment. We're back after this.
This is The Exchange on CNBC.
Okay, we're still above a bullish VWAP. VWAP up and to the right. So I'd rather a bounce above VWAP than VWAP be overhead. We bounce back up and we just got rejected. That said, we filled the gap. We got resistance 4370-ish, looks like. Still potential for a bounce. However, as we ease into the last couple of hours of the trading day, bulls need to step up. After 2 o'clock, we look for institutions to tell us what they are thinking. That usually happens better signals between Tuesday and Thursday, Tuesday, Wednesday, Thursday, middle of the week. Generally look for a 2 o'clock hour. If institutions buy at the lows or if they continue to sell. We're in a negative gamma environment, very put heavy. So we could see acceleration again to the downside. A lot of moving parts. I choose to stay out of it. We had a nice rally up to 43.70 from 43.45 when we got a buy signal earlier this morning at 10:30. Okay, so you got a nice 30-point move there. Don't go back and try to do it again. As Mondo was saying yesterday, if you got a good trade, just stay out instead of trying to flip the trade and go in the other direction. It's tough. It's tough. It's very tough. Yeah, exactly. Exactly, Paulo. Yeah, I day trade. A lot of times I'll day trade Mondays and Fridays. I'm looking for better setups between Tuesday and Thursday, the meat of the week. This week, Tuesday was a down bar. Wednesday, Thursday followed into today, obviously. So if you're just joining us today, just tuned in, don't forget this time of year, seasonally, we tend to be weak. Also, or in addition to that, seasonality this year in August, we have an election year next year. And this is what tends to happen seasonally in August. And then we're looking for higher prices into November, December. This is 2023. This is 2019. 2019, 2020. Looking for stock charts to get up to snuff. Okay. There's 2019, 2020. Okay, we had a 7% pullback in August during the Trump administration going into the Biden administration. The next year, 2015, 2016, we had an 11% pullback during this time of year, but we finished higher from the low. 2011, 12, that was the last year for Obama, right? 18% pullback. 2007, 2008, first year of Obama in 2008. This period prior to, during an election year, we had a 12% pullback during the last part of 2007, but we finished a bit higher. 2003, 4, same thing. August, we had a 10% pullback. So that's what we're anticipating for now. Okay, pullback. We're on a sell signal now, 15-minute. It's very possible we come down and test the low and then bounce back towards VWAP. It's also possible that we take out the low. 43.50 is a major level. That's right there, 43.50.
And they recommend the best way to do that is using index funds. The final thing is they studied 17,000 U.S. stocks. There aren't 17,000 U.S. stocks in the market right now. There's less than 5,000. Most will go away. They fail over the 30-year period or they're bought out. So the S&P looks like it goes up 10% a year. It does on average, including dividend, but it's a biased index because they keep the winners in and they throw the losers out. And the market capitalization means the winners have more, the bigger winners have more influence over the smaller companies that are in there. So yes, the stock market indexes tend to go up, but the average stock actually has a very tough time.
That's fascinating. I didn't expect Tencent to be on that top 5 list either. That was an interesting one. All right, Ben, so all of this said, people are, and I think most people intuitively know stocks beat bonds, but for the first time they're thinking, well, 5% risk-free in bonds ain't bad. So what are you hearing and what are you recommending?
Hi, so yeah, thanks for having me on the show. So for sure, cash at 5% is better competition with stocks than it was when cash was at 0%. That said, over the long term, stocks do outperform less risky assets. So I co-manage a portfolio called the Investment Income Builder. It's a portfolio that's returned 9.5% over the last 20 years, of which 5% is income, and another 4.5 or 5% comes from growth over time.
We're right at VWAP now. Seeing a wick. Seeing a wick. Let's go to the 5-minute. We're right on top of VWAP. Stochastic RSI oversold. Could stay oversold. Looking for a bounce now. Looking for a bounce in the S&P.
You might miss the whole thing. Like it's time in the bigger risk is kind of missing it and being on the sidelines. What about people who are like, I more or less am fully invested or I'm comfortable where I'm invested, but I'm not sure about sort of adding to that position. Or why not have, a position in treasury? I think a lot of people too are thinking that the market might weaken. You yourself sound like you think the recession is only delayed, not canceled. So some of this cash is just being opportunistic.
I think that's right. I think you want to have a barbell portfolio, so you want to have some cash and some less risky assets.
Okay, nice bounce of VWAP so far, higher low.
But you also always want to have some exposure to those assets that can grow over time. So
30-minute chart is still on a buy.
Active portfolio managers, active bond managers, we actually think that we can outperform the market over time. So as Bob was
43.70 is a level.
Have zero return over time, and most of the return comes from a relatively select few. So as active managers,
4370 right along here, 4372 or so, 4371.
What does it mean for the market, Bob? I'm just pulling up some of the stats I've been collecting. For instance, money market assets hit a record of $5.6 trillion. This is from ICI last week. So is that, Bob, considered a bullish sign for the market because that's all on the sidelines, maybe waiting for an opportunity, or are we seeing
Nice bounce.
market that we haven't had in 15 or maybe 30 years?
Both things you said are correct.
Good trading in the room. I'm watching.
Potentially bullish, but yes, and I think it's wonderful that bonds are finally
Watching what you guys are doing and not doing, which is even better.
money for 10 years below 1% is crazy. That's what was an anomaly. What we're in now is more normal. If you look at the historical trend at a 10-year yield, it's much more common to be in the 4 to 6% range than it ever was to be in the 1% range. Same with mortgage rates. Nobody's happy with mortgages at 7%, but it was 3% mortgages. That's the anomaly. They never were 3% before. That's extremely unusual. Where we're in now is more normal. So I think it's wonderful that bonds are providing some competition. It's not great for stocks. The equity risk premium for owning stock is terrible right now. That's one of the reasons the market might be having a little problem right now. But I'm
Okay, watching Walmart to get back above VWAP.
getting 4% on her
Google on a buy signal. It's below VWAP, so I'm not really that interested in Google today. Maybe next week when these options roll off, these weekly options. NVIDIA making higher lows, looking for another higher high. AMD on a buy signal. Just went on a buy signal. Let's see if it can follow through. It needs to get above 105.50. AMD, Netflix on a buy. It's in a descending channel, so it's probably going to stay in the descending channel. It needs to get above 406.80. 406.80, Netflix. It's trading 30% of its ATR, 70% of its daily range.
There's some geopolitical risks there, but this is an important company in the world. They have free cash flow, they have growth, the valuation is attractive. We think it's just going to be a much bigger company over the next 5 to 10 years. It's going to grow a lot faster than that 5% cash flow.
All right, and there's a couple of the other, Charles Schwab for the brave ones, CME Group, Orange, a broad mix there. Thank you both very much for your time today, Ben Kirby and our very own Bob Pisani. And don't miss a CNBC special, Taking Stock, tonight at 6 p.m. with Mike Santoli and Josh Brown. We've been promised a debate, so I'm looking forward to it. Still ahead here on the show, Palo Alto is set to become the first S&P company in nearly 3 years to report results on a Friday afternoon. It has investors a little skittish. The shares are down 18% since that release date was announced. So what's the street expecting, and how much does the timing really matter for reports? The answers from one analyst ahead here on the Exchange.
Okay, so we got a bounce at VWAP for now. Technically, it's a lower high. Looking at yesterday's price action and earlier, we made a high right around 12.10, a slightly lower high at 12.50, and now a lower high. So yes, we're above VWAP. Don't feel much in the way of volume. We had a few blocks come through. 436.37. Those blocks were 436.37. Those blocks on the SPY were at the offer. So somebody reaching up and buying at the high, maybe shorts at 436.37. Let's look at SPY. 436.37. 436.37. Right in here. Looks like a short or many shorts. About a dozen offers right here at 435.91, 436.37. Right in this area, looks like they were shorting back to VWAP. Not big size, 250,000 shares. It helps if you got Street Smart Edge, you can add the block trade indicator I keep referring to. Just go to Launch Tools. You'll see it there under Launch Tools. If you have a screen open, and you can see the Launch Tools tab over on the right, top right. just click on that and you should be able to add, and the second column down, second row down, block trades is the first one next to CNBC TV. Okay, so click on that. You can add the block tool and then click on the actions button and select what blocks you want to find. If you want all blocks, I generally look at blocks over 50%, 50,000 shares. So I'll select the 50,000 share and the S&P 500 usually and the NASDAQ. I'm only looking at maybe 200 stocks, looking at the blocks. So add that tool if you have Schwab.
Assaulting and resisting officers during the attack. The sentencing hearings are set for the end of August. Residents in the capital of Canada's Northwest Territories rushed to evacuate their homes as wildfires in the region moved closer to the city. Strong northern winds have officials worried that the flames could be pushed toward the only highway leading away from the fire. 10 planes left the capital Thursday, and the region's Department of Municipal and Community Affairs is aiming for 22 more flights departing today. And a Canadian minister is demanding that Meta lift its ban on Canadian news from its platforms to allow people access to information about the wildfires. The company started blocking news on Facebook and Instagram after the country passed a law requiring internet giants to pay news outlets for content. And this transport minister said the ban is unacceptable. Kelly, back to you.
Those crazy Canadians.
Including this name that happens to be David Tepper's top holding. If you know it, tweet me at KellyCNBC. See if you can guess what our trader's doing with it.
I thought David Tepper was buying. No, it wasn't Tepper. It was what's his name? Buying Oracle. What is Oracle doing? Let's see what Oracle looks like. Oracle. Yeah, Oracle looks okay. 60 minutes, been moving sideways. Daily. Oracle's been in a consolidation since the first week of June after earnings. Oracle went sideways. It's trading at 115. There's no hurry. If you do have a position in Oracle, consider selling some covered calls at maybe the 125 strike 3 months out. So maybe October. Let's see what the October calls go for right now. October. Yeah, they're $4. The 120s are $4 out of the money. If you have an average around 115, you're going to still make the profit between here and 120, and you can net $4.70 average for each option. For FER, for each option. The 120 strike. Now, if you don't mind giving up another couple of bucks, you could sell the 125s. I would probably wait on both of these until we get back up towards the highs, maybe. Then sell the 125s, I guess. That would be better. Those would probably be about $4, $5 then. So I'm definitely watching Oracle. It's been in a range. So the idea is it moves back up to 120. It doesn't break out, sell the 120 or 125 call for $4 or $5. Let it pull back in, buy it back for $2 or less, and just keep repeating the process. It takes about 5 days, it looks like, to get back, 5 or 6 days to get back to the top of this range around 120, 121 on Oracle. Here's Oracle. All right, so we're making a lower high right now on the SPY S&P. Okay, so Oracle. If I had, I don't have shares. I don't think I have your shares. Kids might have shares. For AI. No, I don't have any shares of Oracle. If I had shares of Oracle and my average is right around 115, I'd be looking for it to move back up to say 118. Maybe I'd sell the 120s or the 125s for about $5 or $6. make the net difference between 120 and 150, $5 on the shares. If I get called away, I just buy them back. You get to keep the call premium.
It's great to have you. We're going to start, and good job everyone who guessed this. It wasn't too hard of a mystery chart. We're going to start with NVIDIA. Is the trade still Teflon? Appaloosa's David Tepper made it his top holding last quarter, increasing his stake nearly sevenfold.
And Morgan Stanley has that's its top buy as well. NVIDIA.
Why are you bailing here?
No, I mean, for a few reasons. Even if you look at the math and you look at the valuation, if we presume this is going to be a $325, $350 million market in less than 10 years, and NVIDIA controls it all, you're still around, this price. You're in 95th percentile of valuation going forward, right? So, and I'm looking at the 95th percentile based on NVIDIA being an apex predator. But it's not just the valuations, because we know they're going to bring it.
All right, we got a lower high. We're turning back down. Okay. So I'm looking at Oracle here. Okay. Sideways range. It's trading at 52, near 52-week highs. So there's that as well. Holding the 10 EMA. Okay. So S&P, we got a lower high coming back to VWAP again. 30 minutes still on a buy, but the 5-minute and 15-minute are on sell signals. Actually, we just got a little buy coming back to a sell signal again. Can we get a higher low? If we get a higher low, that would be good.
Next one might not be quite so controversial, Lee, but let's talk about it anyway. Expedia, which big short investor Michael Burry just added to his portfolio last quarter. It's been down 19% after earnings 2 weeks ago. It's the worst day since the pandemic lows in March 2020. This one, why are you not a fan?
Well, listen, I love Michael Burry. We all love him. I'm a value player at heart. And so all this tells us that officially, now that Burry's involved, it's not a tech company, it's a travel agency.
Kohl's having a good day. Kohl's.
They had everything, all this new wins underneath their sails. But they've got this thing called the One Key Initiative. If you really kind of dig down in this thing, what they're trying to do is they're trying to...
Antoine, come here. I want to show you something.
Very different brands, Verbo, Expedia, all this stuff. And they're going to offer a 1% discount to try to get that brand loyalty. Here's the issue.
Okay, this is the index. All right, the S&P. All right, what do you see? Yeah, that's why you're not buying right now. Okay.
Good thing I sold.
Yeah, good thing you sold. Yeah, you sold up higher, much higher. So you want to wait for this to bounce the next few trading days, like next week. Once it does, we'll take a look at whatever it is you're looking to buy. Okay. But as long as this is below the 20 EMA, this is 60-minute time frame. You want to stay away from the market or be short. Okay. All right, so that's why we're not doing anything, okay? So next time you ask me about buying, just ask me, what's the S&P 60-minute chart look like, okay? All right. Cool. Just showing him this chart. Counter trend trades, yeah, that works. Extreme oscillators, extremes. Hopefully one day. He wants to be a pilot, like Navy. Wants to go to Naval Academy, be an officer.
So when Cuban has his passion project of revolutionizing, parts of benefit management business, he really means he aims to destroy it. And he just drew first blood in California.
Wants to be an officer, so he also likes to trade. He wants to invest. He's going to do ROTC again next year. Okay, so 60-minute looks good. So we were just talking to him about this. As long as we stay below that 20 EMA, mean reversion, day trades, yeah, that's okay. When you get buy signals, okay, like this morning, it's okay. We've got this mean reversion back towards the 20 EMA. That looks good. However, we only want to take mean reversion trades at the moment because the risk is that we could see this lower high situation turn into a lower low and roll over. There's a possibility with 1-to-1 up down volume, this turns out to be a doji. I'm hoping that that's the case or better. A hammer, tick cumulative. Let me look at the 60-minute. Okay. So if I'm telling my son not to invest, members that are investor time frame shouldn't be doing it as well. All right. So you're waiting for the S&P, to give us a good entry base. We want to see a base somewhere near support. Okay. So here is, okay. There's the 100 period moving average just below. So just like the 50-day, we thought we'd test the 50-day. We waited, didn't hold. We dropped some more. Now we're going to wait for the 100 period. At some point, they're going to come in and start buying, okay, like they did over here. And we'll see 2 or 3, 4 or 5 candles reversing. The volume will pick up. We're not there yet. So if you buy right now, you run the risk of this being much lower on Monday. Okay, so there's no need. There's no need. The object is to lose as little as possible and get the best entry and wait for institutions to tell you that they are interested. Here's that 100 period moving average. Over here, the last time, March was the last time NYMO was minus 108. Market on close, 108. NYMO was minus 108. Okay, let's go look at NYMO. March was the last time it was minus 108. Okay, so here's your NYMO. Wait for these signals. Okay, here's your minus 108 at the close yesterday. That red in the background. NYSE is still turned down, but the last time we got below this dashed red line over here led to current rally. Now, we did have a little pullback to start the year. March, April, May. March, we rallied higher into April. We turned in April and May, and then we went higher. So that's one extreme as well. Plus, we've got advanced decline percent at the minus 30 level. Look what they're doing. You see that? VMV, you posted this earlier. Notice how we're turning right at minus 30%. All of these are turning. Okay, we're making a higher low. Looks like we're going to make a higher high right now in the evening session. Okay, so that's another indication that we could see more shorts covering for now, just shorts covering and some new money coming in, early traders. When we see bonds need to pull back, right? So bonds need to pull back. Okay, there's your high over here in October. That led to the current cyclical bull market that we're currently in. Okay, we hit that level and we got rejected. That's a double top. Okay, let's look at the weekly. Okay, that's a double top. Do we pull back? I don't know yet. Nobody knows what direction the market's going to go. Mikey said it pretty well this morning. If you think you can predict where the markets are going, like our friend Ali, he got, fortunate for him, he got it right in October. We made that high in the 10-year yield and we pulled back. The 10-year pulled back. The market's rallied. Do we respect this double top and pull back in? It's yet to be seen. But if it does, next week between advanced decline percent, NYMO, and a few other things that we're watching, this will give us a tailwind. We need to see the dollar also pulling back, the dollar, okay? So the dollar has been breaking a downtrend. Here, let's look at the weekly. Here's the dollar on the weekly time frame. All right, so if this was a stock, you'd be looking to go long here, okay? Okay, you're breaking above the majority of these pivots, right? So if the dollar continues to move higher, that's going to affect stocks like Microsoft. Okay, so you want to delay your interest in Microsoft until the dollar can pull back in. What's the dollar doing right now? Let's go take a look. Survey says the dollar is at 103.34. Dollar is 103.34. 103.34. Nope. Let's go currencies. Watch money flow. Money flow is going to set you free. Okay. So here we are above the trend line. This is an end of day chart. So at the end of the day, this will update. And right now we're trading at 103.34. So back inside of yesterday's wick. Okay. So if this starts to turn back down from the 200 day, okay, the magenta colored line, this is the 200 day right there. So if this gets rejected and pulls back below the 21 day, the blue line comes back to the 50 day, that would be a tailwind for equity bulls next week. We got Jackson Hole next week. Okay, so we got a whole lot of things that could work in our favor. We just got to see it first. Okay. A lot of people like to jump ahead of the train. And if the train's not turning or reversing direction, you're going to get run over. You can only get run over so many times. So wait for clear direction from institutions. They'll tell you. Looks like it already. When I look at the advanced decline percent, this is telling me that there's some activity going on here. Okay, so this is turning. Minus 30% turns. Classic cars. This guy on CNBC, nice cars. Nice cars. For those of you who are into classic cars. MGTC, Jaguars, Mercedes, Roadrunners, Camaro SS, Chevelle SS. Oh, Reggie Jackson there. That's cool. Ferrari. Wow, that's some nice cars.
And guys, if you look at the most expensive car that's expected to sell this weekend, it is a Ferrari over at Bonham, scheduled to sell for about $40 million. That's a 1967 race car. A lot of eyes on
Nice.
like this one.
$40 million for a Ferrari race car.
Pandemic and afterwards, prices nearly 40-50%. This Speedster from 1956, Kelly, expected to sell for $350,000. And tonight, we're going to look at a different brand, Ferrari. We're going to have an exclusive interview with the CEO of Ferrari, Benedetto Vigna.
Very nice. Okay, so I'm watching Kohl's here bouncing. Kohl's is having a good day. Got earnings next week, Kohl's.
One of the greatest stocks, one of the greatest spin-outs. I mean, it's just been incredible. It's up there with LVMH, and everyone wants to emulate their model. Make one less car than the market needs. Robert Frank stuff looks beautiful out there. Thanks for your long day for you, Robert Frank. Still ahead, PR disaster or what to do about nothing. We'll look at Palo Alto's rare move to report on a Friday afternoon. That's coming up in a couple of hours. We'll talk about it next.
Okay, Kohl's, I believe, reports on the 23rd. That's Wednesday. Let me just double check here. Kohl's, KSS. That's probably going to do well. Maybe. Let's see, KSS Kohl's. Looks like August 23rd. Let me just double check on Thinkorswim. Hope everyone's having a good day. It's a drag. It's a drag. Getting old. All right, the dollar rolling over. Dollar rolling over. VIX rolling over. We might get a nice little rally here. Dollar and the VIX rolling over. Dollar and the VIX. Dollar. bullish. What a drag it is getting old. Wow, 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 wow. All right, so tick cumulative market muscle. The cycles look like they're trying to turn. We're doing it on 1-to-1 up down volume, so it's not like huge amount of blocks or trading volume. We've got the 60-minute ES is about to go from a yellow histogram to cyan. Okay, it's about to cross the 0 line probably in the next hour, probably into the 3 o'clock hour. Maybe we see cyan. The last time we tried to get above on a 60-minute, we got rejected and we started producing red bars. Again, if you're watching your TTM, you'll see what I'm talking about. Go to ES, put your ES symbol in, and then check your histogram bar on the 60-minute time frame. You'll see what I'm talking about. We're technically on a buy, have been on the 60-minute since midday. Let's see. What does that say there? I can't read that. It's too damn small. It says since 8 o'clock this morning, 60-minute futures have been on a buy signal. Okay, so let's see what the histogram bar does. Tick cumulative is still dropping, so that needs to cross over. 1-to-1 up down volume. Advanced decline percent turning at minus 30%. That's a good sign. We could wiggle down here. Wiggle. We could wiggle down here. Looking for that to follow through though. Could have been a hell of a lot worse. We're trying to get back to green on the day. We could have closed down at 4,300 today. That's still possible. So if you're an investor, especially if you're a new investor with a 401k, you just started working this year out of college, or maybe you're a little bit older and you've been working for a few years, what I'm waiting for, I can't speak to you because I'm not a FINRA registered advisor, but I can tell you what I'm doing. And that's nothing. I'm doing nothing with my 401k as far as long only funds. I'm not doing anything until I see a base. Okay. We are not producing a base right now. Okay. So here's S&P. Okay. So we're down to the 236 Fibonacci. That's from the October low up to the recent high. We're at 236 right there. You see it? 236. This band right here, 50% retracement. We're just past the 50% retracement from this pivot right here, that arrow. That's the low. Up to the high is 50%. So this is said to be confluence. This is an area where Fibonacci levels match up. Doesn't mean we stop there, but a lot of people will be watching it. 618 just happens to line up with the 200 period. No, that's the 100 period. The 100 period moving average right there. And the 200 period's down here at 4,100, 4,125. I mean, all of this is possible. You know what it looks like compared to previous presidential, next year presidential cycles. I showed you that earlier this morning. Okay, at the low today, we were off almost 6%, probably 6%. 6%. Let's just round it up to 6. Okay, I don't need this anymore. That's pretty obvious. We broke that trend, right? Okay, let me turn. Okay, so I'm not doing anything until we see a base on my 401k. This is what I'm looking at here.
All right. Well, I'm assuming the analyst community is not a fan of Friday afternoon earnings calls.
There's nothing I'd rather be doing tonight on a Friday in August than doing earnings.
All right, maybe they'll start a trend. Joseph, thanks for your time today. We appreciate it. Joseph Gallo with Jefferies. weekend. He has it by 30% upside for Palo Alto. Jim Cramer will be speaking with Palo Alto CEO Nikesh Arora, who you just heard mentioned, on Monday at 6 p.m. on Mad Money.
Okay, let me turn price labels off.
That does it for the exchange.
Okay, so there you go. We're 6% at the low today. We were 6% off the high. Is that enough for institutions? Well, we see the advanced decline percent turning higher. I'm going to beat this to death before the end of the day. So just get tired of it already. I'm going to beat this to death. Advanced decline percent. Okay, these this indicator was created by the late Marty Zweig, very well-known investor. Okay, minus 30%. You start looking for bases. Start looking for reasons to buy. Okay, so we're minus 30% on all of these indicators. Okay, S&P 500 hit minus 30%. So did the mid caps, small caps, and the NASDAQ. NASDAQ overshot it and reversed. Okay, so that's one thing we're watching for. That's fine, but I want to see a base. So it's going to take a couple of days before I can see buying here enough. Now, what I'm thinking is going to happen, this is just me speculating. I'm speculating that we're going to bounce right back up to the 50-day, get rejected. Institutions will sell some more, will roll over, maybe even visit the 200-day. Hopefully that doesn't happen. But we got plenty of time left between now and the end of September. You know what I'm looking at? August 16th through September 30th, the third line down in this data point. Okay, so anything can happen between those 6 weeks, really 2 months, August and September. All right, so I'm thinking maybe we bounce here. We get back to the 50-day. The 921 are crossing down through it. So this is changing trend. We bounce back to the 50-day, get rejected, roll back over again. Again, hopefully that doesn't happen, but that's what I'm planning for. So what are you going to do if we get down there and we start the base? Well, I'll start looking at TRBCX. That'll be my first area where I'll be starting to look for putting some money to work back into TRBCX. I'm also watching SPHD, which is a lot of these value stocks. A lot of value stocks that I'm looking that pay dividends. Okay. So SPHD. Okay, we're having a good day for the most part. We're bouncing. So I'd like to see this move a bit higher, but I'd like to buy some. This offers a dividend probably next week. They'll probably award a dividend. I have it rolled into more shares. So I might buy more shares for that dividend. Higher low. We had gotten as close as 2.5% from the all-time highs. That dash line is January 22 highs. Okay. We got very close. I thought we were going to get back there. Higher low. 921 day, same thing. Move back up to the 50-day, perhaps get rejected. It's no hurry. Got the rest of our lives to be investing. Once we see good setups, I'll let you know what I think is a good setup next week. Many of you have your own ideas. I'll tell you what I'm doing next week. Let's see. I sold a lot of covered calls today. I sold some covered calls on Kohl's. I sold some covered calls on JP Morgan. I sold some covered calls on Apple. I sold some covered calls on Kaba and Unity Software. Sold covered calls. And Sarepta. I sold some covered calls on Sarepta, which has been moving higher lately. Sarepta. Okay, Sarepta is $3 off the high. Over the last week, Sarepta went from $101 per share up to $115, so we made 14 bucks there. I sold some covered calls into the highs. Could have bought those back, but I didn't. All right, so S&P is looking a little better. Looking a little better here. Okay, so we're on a buy signal again. On a buy signal again. SPX.
Doesn't that suggest that the Fed will have to do more, will have to raise longer, raise more, keep them higher longer? Something I think you've said they don't need to do.
Yeah, I think if it's a 3% inflation world, they don't have to do more because you have 200 basis points, 250 basis points of real interest rate built into that, which is a relatively restrictive policy. And it's interesting, Tyler, if we go back, a decade, right, where we spent 12 years.
All right, here's the S&P 500 5-minute chart. Okay, we're on a buy signal right now. Okay, so once we get up here to 43.70, 43.71 again, look for resistance. If we don't, we could have an end of day run. You might want to scalp. Calls are cheap. Next week will tell you what we're doing. If we get a couple of days on a bounce, I'll probably buy some TRBCX, so you might want to jot that down. I might buy some RGA FX. I might buy some SPHD on Monday, Tuesday. SPHD. And I might buy some KBD. KBWD, sorry, KBWD. That's a financial ETF. Looking for a bounce. We got a bounce today. Those are investments. There's KBWD. You can see what we're doing here. Looking for these banks. High yield, high dividend yield financial ETF. Okay, you can see right here. There's 41 financial stocks in there, sector specific. Dividend yield 7.37%. It's a little more risky. It's a 5 on a 1 to 5. 3 being the median, 1 being least risky, 5 being most risky. I have a smaller position in this, but financials, I like insurance, I like the banks, the big banks, regional banks, money center banks, rather. Okay, so TLT is on the move, Brian. Thank you. Okay, let me see. Yeah, yields pulling. Yeah, the 10-year double top. TNX double top. TLT. Makes sense. Yeah, good one. I like that, Brian. I like it. Good idea.
Some of this could reverse itself very, very quickly. Rates would come down. The benefits after an event would redound to the United States. We'd get lower rates. The Fed would stop raising, and we'd have some concerns about some sort of.
Okay, above VWAP. Thank you, Corey. I love the teamwork in the trading room. You may not realize it, but your fellow members looking at what you're posting is very helpful. I might not be focused on something you post, and it turns out to be a good trade. I'll look at it. A lot of times I'll see it too. I'll join you. Paolo's looking for a dump. Okay. Novissimo, you have to understand, Paolo is from California. You know, those California people don't know what to say. Just kidding. Just kidding. I like California. I just don't like the politics and I don't like the crime. I don't know what they did to the my memories of California are, you know, Beach Boys. Beach Boys, happy music, um, the Doobie Brothers, taking it to the street, Santana, you know, before, I don't know, last 20 years has changed quite a bit. I think you guys from California would agree. Lots changed. I just have late 1970s, early 80s memories of California. Last time I was there was 2004 with my oldest daughter. Northern California. I thought Palo's from San Jose. You guys call that Northern California? I thought we'd call it Mid California. Mid to Southern California. Okay, so we got rejected again near this area. We need to get through 4370. We got a lower high producing. 1-to-1 up down volume. Not a bad day for the bulls. Bears had it early in the morning on the gap down. We still have potential for more downside next week, so don't be depressed if we come in and we're lower next week. Make sure you have some hedges on if you think we're going to be lower. Yeah, it's just south of San Francisco. I know the area. Yeah. I built a store in San Jose. So, Corey, do you know the way to San Jose? Do you know? Do you know the way to San Jose?
It's not just the regional, but you know, I don't want Goldman to take a tally of its own hit to book value or anything like that, Leslie. But I don't think the big banks would escape some of this, even though they have you know higher net interest margins and things like that. So it's
San Jose is cut in half by the expressway, right?
I don't know. I guess it's just not as acute a problem as it was a couple of months ago.
Which side's the best side? The east side of the expressway is the best, right? On San Jose, the west side's a little funky. Yeah, they offer their earnings are after the bell on Friday. That's kind of weird. All right, so we got rejected. We got some pretty decent down bars here. Coming back to VWAP. VWAP is flattening out. Dividing lines, Bakersfield, yeah.
What's the takeaway here? The takeaway to me is this: banks have seen their capital dented because of higher interest rates, and there may be more government regulation boosting capital reserves here. The two of those things taken together are not good news for
because the higher the capital buffers you need to have, and the more, you know, because if you have a dent to capital, you need to find another way to raise that capital. Right. That comes from, of course, loan making.
Yeah, I visited Tracy, California, just for the hell of it.
You don't want to see, you know, your ability to be lending.
We did a road trip, my oldest daughter and I. We started off in San Francisco. We took 2 weeks to get down to San Diego and Point Loma. Then we flew back to New Jersey. A lot of fun. We stopped in Ventura, Monterey, a couple of the, Black's Beach we stopped at, La Jolla, Huntington, the Oranges. Yeah, they do. That's crazy. 2.5 hour drive. They don't have a bullet train that goes. That's wild. Been to Walnut Creek. That's a nice area. I had friends that lived in Walnut Creek that moved from New Jersey to Walnut Creek. They lived there for a couple of years, worked in Oakland. Yeah, I like options better when the markets are trending, Frano. I agree with you. I mean, just look at the 5-minute chart on the screen. How many times we went on a buy and a sell signal? You know, if you go to the 15-minute, and you can manage these changes of trend. Okay, we had one buy signal. We were briefly on a sell, so there's still a possibility that we move a bit higher. But yeah, we're going to starting to flatten out now. Still off 5 handles on the S&P. I think John put it well yesterday. He was saying that he wants to sell covered calls, but he's all about capital preservation right now, which is probably the most important thing since the top in July, at the end of July. The number one thing I've been thinking about, the reason why I've, beat this idea to death that you need to pay attention. This time of year, seasonality, we could get anywhere from, we've had 18% pullbacks in August with a election year next year. We've had 11% pullbacks in the last year of Trump's administration into the election. There was a 7% pullback. Okay, so anywhere from where we are right now, 7%, 10%, 18% is in the cards. It's possible. So capital preservation, that's number one right now. You don't have to trade every day, nor should you really. You get one good trade a day. You trade Netflix options for 10 points and you make $4 or $5 on the options, you're done for the day. Problem is we're junkies and we just want to pile one trade on top of another. I have an excuse to be here. But even I don't trade all day long. I'll take some trades. Today and yesterday, all I was doing was selling covered calls. Looking for a lot of these stocks to bounce, especially, Ross Stores, Target, TJ Maxx. Let's see what TJ is doing right now. TJ Maxx.
But that party seems to be coming to an end, or at least over the past couple of weeks it has. Out of the so-called Magnificent Seven, 5 stocks are down more than 10% from their annual highs.
TJ Maxx is hanging out.
Down more than 30%, and with bond yields reaching multi-year highs.
About $2 above its gap up level yesterday, day before. So TJ looks pretty good. TJ is hanging out at the highs. TJ Maxx. I'll probably be taking some, selling some covered calls on TJ. Maybe next week. So there's earnings yesterday, this week. TJ Maxx.
Tesla, Nvidia, and Meta, just massive increases in sentiment. It almost sounds kind of childish, but the bigger they are, the harder they fall. So we've really seen a lot of compression back in terms of sentiment falling for those three. We've seen sort of a follow-on effect for some of the others, but I really think it's that sentiment driver.
Okay, there's TJ Maxx.
You can also see a reversal. Looking in terms of what investors
Target.
these are generally good companies, and you can pick your
Target trying to get back above that 138 level and then start heading towards the 200-day. The dotted gold line is the 200-day. The 100-day is right there at 141. So I'm looking for a Target to get back up. Walmart, Bounced today. A little bit of profit taking. Still hanging out at the 50-day.
The math becomes pretty tough if they don't participate at all, or especially if they just keep going down. But a few observations. One of them is you talked about the declines, peak to trough from these stocks. The overall S&P is down 5%. So clearly, it's not going down dollar for dollar.
And yet we're talking about correction here.
Well,
I mean,
yeah.
some people are, and this is not by any stretch a correction. I mean, it may be for those stocks that are going down 10%.
That's right. I mean, it's not yet broadly speaking in any appreciable way. Now, I'll say the NASDAQ 100, which essentially dominated by these seven stocks, was a 36 percentage point advantage year to date 1 month ago over the equal weighted S&P 500. Now it's 28 percentage points. In other words, it's given back 6 percentage points of outperformance that had built up into mid-July to now. So has that changed the overall leadership complexion of the market, or is it just really that's how where more of the air was underneath these stocks? We hit August. The overall market was a little bit stretched. We are definitely dealing with at least one
Boeing starting to bounce.
bond yields. But
Cisco, another company beating on earnings, trying to push higher. I'll probably sell some covered calls on this one too. There's no hurry. I'll probably sell them next week. Cisco.
Covering half our shorts today, expecting a short-term bounce next week, doubling Meta position, buying Apple, and so forth. So, Mike Bailey, how important are stabilizing rates to the next leg of this movie?
I think it's pretty relevant. I mean, if you look at really the overall market correction and the metrics and seven, kind of take down
U.S. Steel been grinding
rising rates. So I think
sideways today.
critical to the conversation. If you get something unexpected out of Jackson Hole next week,
Off the highs of the session.
moving north, that could be a challenge for the broader market in general and some of these big tech companies, which are pretty rate sensitive at this time. Our guess is we're not going to see that significant move up in rates from here. We saw a little bit of give back even from yesterday, but Fed's kind of a black box. So we're gonna have to wait and see.
All right. All right. Looking for a higher high. We need to get through 437, 43.71, 71, and then 75.
I'll just point out that they kind of detached coming into this year. If you looked at the Treasury market versus NASDAQ 100, obviously it matters, but it's not, to me, the one thing that matters, especially when you're talking about the super profitable large companies like the Apple and Microsoft.
I would say from observation, it feels to me like it matters minute by minute more than it matters month by month.
That's exactly
If
right.
that makes any sense.
No, you're right. We're locked into a point where the main swing factor in whether I'm going to take more or less risk in stocks and in big growth stocks is, are yields going to become unhinged to the upside?
Right.
And so that's why you do get that tactical relationship. But if you go over a longer period of time, I mean, I looked at the last few times the NASDAQ 100 traded at like 25 times earnings, where we are, and the 10-year yield was anywhere from the current level to 1.5% to 5%. And then if you want to go back to the late 90s, then all the math doesn't work.
Yeah. No, it's true.
All right, Mike Santoli, Mike Bailey, thank you very much. And you can get more of Mike Santoli's market thoughts tonight at 6 p.m. on Taking Stock. Mike and Josh Brown will discuss all the issues facing the markets. And it says right here they're going to have fun doing it.
Looks like we were having fun in
Look at that
moment
fun
anyway.
there. That is two guys having fun.
We'll see. Well, tell me what Josh is going to be wrong about, and I'll tell you what we're going to do.
What you're going to be right about. Coming up next on Power Lunch, some headwinds for wind turbines, not turbines. The offshore wind industry is navigating uncharted waters, inflationary pressures, and rising rates pushing up overall costs. Details are next, and further ahead, college tuition costs are growing well beyond what many families can afford. It's driving many Americans further into debt. We've got the details when Power Lunch returns.
All right, let me take a look at Microsoft. We got some people buying Microsoft. Okay. So hopefully it's scaling in, right? Scott? Okay, so we've just been chopping around for the last 30 minutes.
Welcome back to Power Lunch, everybody. Time now for our ETF tracker this week.
Still on a buy.
Funds, despite the rising yields and the concerns about China, gold is down about 1% this week. And the gold ETFs seeing net outflows of $373 million over the past week. This according to our partners at Track Insight. Gold miner funds from iShares, Sprott, and Van Eck all down 6% this week. More information available on the FT Wilshire ETF Hub if you want to go more into those gold ETFs. Kelly.
All right, pretty much every business and every industry has been grappling with the impact of inflation, but with the off-wind industry, it's one of several issues as it tries to meet ambitious production targets. Pippa Simmons joins us now with more of the headlines. And I mean, it is surprising, Pippa. Like, tell us what's going on here.
Yeah, well, I see what you did there. So the offshore wind industry is really right now at a turning point because after years of falling costs, which made it competitive with other forms of energy, prices are now on the rise. So much so that some projects are no longer economically viable. The problem is that increased costs along the supply chain, that includes everything from raw materials or turbines to specialized installation, is bumping up against the rising cost of capital. As Aaron Garr from Wood Mackenzie told me, it makes a lot of projects uncompetitive. Developers are trying to renegotiate contracts, with some walking away entirely. Now, this creates a big issue over the long term because pinched profits mean companies don't necessarily have excess capital to reinvest in the supply chain. And even if they do, they might not want to jump in given an uncertain market and delayed timelines. And so we have these really ambitious goals for offshore wind, but nobody's reinvesting to build a supply chain.
Also want to ask you about shares of Hawaiian Electric. What's going on there?
So that is jumping back today, up about 13%. That comes after the company said it is not, the goal is not to restructure, but to endure as a financially strong utility. So they said they are seeking advice from experts, which is due course of action in a situation like this. This, of course, after the Wall Street Journal reported earlier this week they were seeking out restructuring advice.
Yes. By the way, sort of off topic, but Hurricane Hillary at the same time. What are you hearing in terms of the potential damage? This one could hit Sunday or Monday. It sounds like rains are going to be equal to years worth of rain in some parts of the Southwest, and maybe like Los Angeles could be, directly affected. And it seems to have come. When do we have Pacific storms?
This is the dry season.
Yeah, exactly. And this is once again the indications of dislocations in the extreme and the frequency of these types of weather events, which then threaten all of our crops. They threaten refiners out in California. And so I'm not hearing too much on that quite yet. I think there's still a lot of focus on what's going on in Hawaii right now. But I mean, all of these mega events just ruin infrastructure, ruin lives, and it's very devastating.
And you look at Hawaiian officials, we saw the resignation, obviously, of was it the fire chief that put off the sirens today. But again, when's the last time they dealt with a wildfire? Like, so when you start talking about other, when's the last time California dealt with a hurricane? I mean, there are people here. Hopefully, everyone has a disaster readiness plan for literally every possibility to think of at this point, because that's what the headlines seem to bring.
And I think the issue is that if you want to
Okay. Still trying to push higher here.
to pay higher rates. And so you are at a little bit of a difficult situation where you need all of that money to do that. That comes with consumers feeling pinched. And so the regulator, I spoke to one person who said the regulator is equally to blame here because they also play a role. And I was talking about whether or not
electric
yeah, exactly. And also, governments don't want to shoulder these things either because if there's an issue, then they don't want to be the one.
They don't want the ratepayers who are taxpayers who are voters to get angry at them for greenlighting a rate increase.
Great point.
That may ultimately be absolutely critical. Thanks. Sure. Let's get to Leslie Finger. She does it all. She does the banks. She anchors. She does she's got a news update. Here she is.
I'm going to tell you what's going on around the globe too, Tyler. Here's your news update at this hour. The Bureau of Alcohol, Tobacco, Firearms, and Explosives has deployed a team, including an electrical engineer, to investigate the origins of the catastrophic Maui wildfire. This has local power company Hawaiian Electric faces growing scrutiny of its electrical poles and whether they may have triggered the fires. U.S. officials say nearly 500,000 Ukrainian and Russian troops have been killed or wounded since the start of the war. Russia's military losses are around 120,000, while Ukrainian deaths are estimated at 70,000. Russia's military is larger than Ukraine's with 3 times as many troops, but officials warn it's difficult to estimate as Moscow undercounted war dead and Kyiv doesn't disclose official figures. And the New York Times reports former President Trump will not participate in next week's Republican debate hosted by Fox News. Instead, he plans to sit down for an online interview with former Fox News host Tucker Carlson. Tyler, I'll send it back to you.
All right. Thank you very much, Leslie. Ahead on Power Lunch, the IPO shopping cart is filling up. We've seen the NASDAQ and NYSE battle it out for listings. Now, a major IPO set to kick off the fall. That one is next.
All right, I'm here. I'm just scanning through stocks. There's not much to do. We're producing lower highs technically, but we're on a buy signal since 10:30 this morning on the 50-minute time frame. All right, we're trying to make a new high here, get through 43.71. That should do it.
Welcome back. Instacart is reportedly planning a September IPO. Finally, an they could publicly file plans as soon as next week. If we get a glimpse into those financials, been a long time coming for the grocery delivery startup. Could it crack open a window for other listings more broadly? Deirdre Bosa has the details in today's Tech Check. We've been talking about it all year, Deirdre. They've been working stuff. I feel like I've been talking about this. I've been covering this company for years and years. Always this question, will they or won't they? And keep in mind, this is a company that has been around for more than a decade. It's become a household name, and it's raised billions of dollars in venture capital. So it has taken an unusually long time to come public, as Kelly said. And if we do get the IPO filing as soon as next week, we will finally learn how the business model works. Instacart is essentially an intermediary. It connects customers with personal shoppers who shop and deliver groceries from local stores. It sounds asset light, but other public gig economy companies like Uber, DoorDash, they have proved that it's actually really hard to profit from such a model. Instacart, however, may have something that they don't, and that is an established higher margin advertising business. If you look at who's actually running the company, it's a lot of ad execs. Coach from Facebook, Fiji Simo. She was one of the highest ranking female Facebook execs, and she took over for founder of Corva Meta in 2021. Before her, they had a former Amazon ad chief in charge of all of the company's revenue. Now, Uber and Dash, they're just starting to chase this model, but investors, they like it. So will they like Instacart's lead in advertising? And more importantly, will it help separate Instacart's financials from other gig economy companies? We could soon see. On the other hand, though, competition has only intensified for Instacart, with gig companies and huge retailers like Walmart and Target vying for a piece of the grocery delivery pie. However, Wall Street responds, though, guys, to the filing, and the eventual IPO will be significant for the IPO window. Meantime, ARM could also be filing as soon as next week, and is expected to be the largest this year. It could all be happening, Kelly and Tyler, after a long freeze, a long pause. We'll see, though. NASDAQ, right, hasn't exactly been off to the races over the last few weeks, so it's interesting timing if we do get these IPOs.
Sandra, how does the advertising piece fit into the puzzle here? Why is it a cash generator for Instacart?
We don't know for sure, but let's take Amazon's advertising business, right? You could imagine a similar model. You search for things, and companies can pay to have their product listed higher above. That's how it works on Instacart as well. You're shopping for milk, and Milk Brand puts its product pays to have its product higher up on that search page. So we think it's high margin. If you look at Amazon, right, this business grew so quickly out of nowhere, but we do not know. We don't know what the margins look like, but we do know, and I've been covering this company for a very long time, that they've been ahead of this. They've been building out this business as well as an enterprise business for grocery companies, grocery retailers that don't want to run their own site. So that is something different than what we've seen from the likes of Uber and DoorDash, that we know how their model works. A lot of the money, a lot of the losses come from, their marketing and how they pay their drivers and what they charge their customers.
So let me ask you this. Did the management that you referred to, the person who came in from Facebook, was an advertising-related individual who replaced the founder? Was she brought in part to take this company public? I assume she must have been.
Yeah. The short answer, I don't know if it could say that so specifically, but it got to a point where Corva Meta, he's the one that founded the company. He was CEO for a very long time. He said that he saw the opportunity. I remember interviewing the two of them together when this change happened. He said that she's the person to lead the next leg of this journey. And, they've always said that they were going to go public. It wasn't,
All right, making new highs, pushing through the lunchtime highs.
That's very interesting. That's an interesting piece there as well. Peter, thank you as always. Good to see you. So ahead, back to school blues. The price of higher education rising to levels more than most average families can afford. That's not exactly news, but we'll reveal the latest college board figures and ways we might be able to help cover some of these astronomical costs when we return. I will be listening very carefully.
Okay, making nice progress here. Pushing through resistance levels. We're agreeing on the day. A whopping one handle on the yes. Histogram is on the 60-minute is about to cross through the 0 line, so that would turn to a cyan bar, potentially. Okay, nice follow through. Trying to break through 43.75. If we do that, that would be a nice potential follow through into end of day.
Well, Tyler, you know, the average ticket price for college has been rising, but most families don't pay the full price. Tuition fees, room and board average around $23,000 at a four-year in-state public university for the 2022-23 school year, according to the College Board. Going out of state costs almost double that amount, more than $40,000 on average. And a private college averaged over $53,000. Now, that doesn't even include books, transportation, and other expenses. At some private
This stream is sponsored by To The Tip. Get free daily book points, Fibonacci, and market prep levels by signing up at tothetip.com.
Actually spent on college costs last year was about $28,000, up 11% though from the year before. Families took out loans and borrowed money to cover about 21% of the cost. About 29% of college costs were covered by scholarships and grants, free money. And meanwhile, parents and students' income and savings covered about half. Tapping 529 college savings plans, leveraging private scholarships, and appealing for more financial relief if needed are some ways that can help families pay for the rising cost of income.
Why are the costs rising? So you just cited a number that said that the average family is paying 11% more year from year, just in 1 year. Right now, inflation's 5%, 4%, whatever it is. Why is that?
I think in some cases, what the financial aid experts are telling me is that the colleges are not having as great an endowment. They're not having as much money there coming in. And so that is something that is impacting them.
Because the markets have hurt them, or because donorship is not?
Well, I think it's a combination of both, and I think they're going elsewhere to find people who can full pay, and that's why we're seeing a rise in international students in a lot of universities. They need students who are going to be able to pay the full sticker price, but most American families think they don't have to. I think the idea of paying from out of pocket from your own savings and such is something that people say that they don't want to do, but they're also not doing things that are tax advantage ways for them to save. We talk about 529 plans a lot, and only 30% of families use 529 plans to pay for college, and less than $8,000 on average. So there's not a lot of money going into some of
Tesla continues.
Final quick question. Maybe many colleges are space missions, but couldn't they help their finances if they expanded their admissions in order to let more kids in, particularly if in the case of state school and out of state?
Okay, rejected one more time right at the area where we closed yesterday. And the morning, right around 11:30, we topped out right in this area, 11:45. Once again, rejected.
Not the same. Not the same. Yeah.
Talk about a false start. Gina Sanchez and the Blind Name Duel are getting dragged down in our CNBC stock draft standings by their top pick this year, which was PayPal. Does she want a do-over, or is she standing by the pick? We'll ask Gina in an extended free stock lunch right after the break.
Okay, so they're selling it up against this level. All right, looking like they're going to try one more time to push through this level. You hear that, Frano? Bit of an odd move.
It jumped 7% that day, so possibly coming down from that. Secondly, Microsoft announced in July it would expand its cybersecurity offerings, which won't affect this current quarter for Palo Alto, but could have longer-term ramifications. Lastly, competitor Fortinet
key metric for the cybersecurity firms. So that kind of setting the tone for Palo Alto. But maybe all of this negativity is overblown. In Palo Alto's press release, they did say they would provide full year or fiscal year 2024 guidance and update medium-term financial goals through 2026. So maybe they're being considerate to analysts, giving them time to update their models and get great publicity, since we keep talking about it. It's true. Christina, thanks. It's time for today's three-stock lunch now, and here with our trades is Gina Sanchez, Chief Market Strategist at Lido Advisors and a CNBC contributor. Gina, welcome. Let's start with Palo Alto. Picking up on Christina's report, would you step in front of this much valued earnings report tonight? So, she really hit the nail on all the really big issues for Palo Alto Networks. This is one that Lido Advisors owns in their strategies, one that we've held for a long time. And the fire in the ointment for Palo Alto is that it is more overpriced than other stocks. So but it is also a leader in its space. And yes, Microsoft has definitely shown some massive growth on their side, and they have a distribution network that you don't want to mess with. So I think that that's going to be something for the future that Palo Alto Networks will have to contend with. They're also contending with competition from Fortnite, from CrowdStrike, and their other competitive landscape. But they do still remain the leader. They are expected to slow. That is expected, and so I think that the secular play here is still there. Cybersecurity is not going away. If anything, is getting the demand for it is going up, and will probably continue to go up as we continue to build out more and more cloud-based apps and infrastructure. And I think that it will just moderate at some point. And so what really has to kind of start to find a space is the valuation, and that's the fly in the ointment. But it's still a strong long-term trend. All right, let's see if they can climb that multiple wall, so to speak. In a quick program, Palo Alto Network CEO Nikesh Arora will sit down with Jim Cramer on Mad Money on Monday at 6 p.m. Eastern. We're looking forward to it.
All right, next up, let's go to Deere. Despite beating the street's earnings estimates earlier this morning, the stock is down 5% today on questions over how long the farm boom can last. What's the trade on Deere?
All right, we got rejected again twice at this level in the last 15 minutes.
It has been riding off of sort of the loosening of the supply chain crunch that they've had. So they were able to fulfill more orders, and that is showing up with really strong growth. For 2024 is going to be a different year for them. So I think that this is a shorter term play right now, and you do have there is some caution in the long run. All right, let's move on then to Ross Stores. That stock jumping after beating earnings Thursday night after the bell, showing that all price retailers, TJX, Ross, they're looking pretty good right now. Would you still buy it after this pop? So I think that this is still a play right now, because I think the slowdown is going to continue. I mean, we talked about TJX last week, and I like this one as much as I like TJX, and they're about value about the same. This one's a 21 times forward earnings. I think that is reasonable right now, and I think that the demand for low-priced goods is going to remain as we continue to see soften. But we are still seeing consumption, so I think it's a good play.
All right, let's turn our attention, Gina, to some of the stock draft picks. We have first NVIDIA. That was the first pick by WWE superstar Charlotte Flair. It's put her in first place. The stock is up more than 50% since the draft. It reports results next week. What do you think of NVIDIA?
Well, so NVIDIA was high on our list. Remember, we were the number 10 draft. So by the time we got to us, NVIDIA was long gone. This is a stock that has been, everybody has loved this stock as the cloud has continued to build out. They got this second boom with the generative AI craze, which also actually spurred real demand. So I think that this stock has a secular story that's not going away, but it has definitely gotten ahead of itself. I think that the multiple here could be at risk, but sometimes expensive stocks stay expensive for a very long time in secular plays. So you do have to, if you're riding this stock, keep riding it.
So that brings us to PayPal. Are you going to keep riding it? It was y'all's first pick, Dynamic Duo with Diamond Shield, down about 18%.
That was our second pick.
Oh, second pick. Thank you for clarifying. This was the leftover. You wanted it, but it wasn't there. What would you do with it now?
Well, to be fair, the reason that we chose Google as our first pick, and that was really a story about continuing ad demand and strong play with the high multiple stocks while still having that defensive story. about getting a cheap.
All right, don't think we're going to get through 4370 unless something happens in the next hour.
This year they're expected to turn in 90% growth, and that's with margins that are continuing to get hit because they're having more and more flow on Venmo, which is a lower margin business. And I think a lot of folks are really punishing them for that. But their forward earnings are 11 times for 90% growth. And I think that is I still think that by the time we get to the end of the year, right, by the time we head into the Super Bowl, which is when this time horizon ends, we will possibly have seen another rate hike. We certainly will be at the end of rate hike, and we won't be seeing any kind of meaningful rate cuts by that point. So I think that the high valuation stocks are going to be vulnerable, and this is one that's going to continue to deliver despite Apple Pay, competition, and despite margins. They're still going to turn in 18 to 19% profit growth 11 times. Believe me, they're going to be investors that are going to sit up and take notice.
All right. Gina, thank you very much. Have a great weekend. Gina Sanchez. Appreciate it. There's so many stories we'd still like to get to, but so little time left. We will power through as many as we can in closing time.
All right, so looks like a printing a higher low. Higher low printing. Got plenty of time to run this higher. Pretty slow this evening. Volume really trickling to a slow crawl.
Welcome back. Just under 3 minutes to go, and several more stories we want to highlight today. So let's get right to it. We're tracking the Category 4 storm that's heading towards Southern California. Hurricane Hillary is expected to weaken before it reaches landfall, but will likely bring severe rains and flooding to the region this weekend and into early next week. If it somehow reaches California as a tropical storm, it would be a rarity. The last time that happened, Tyler, 19
Yeah, this is usually the drier season in California. You think of California getting wet sort of November, February, whatever, but this would be a very, very much an anomaly.
I don't, in my memory, think of a Pacific hurricane.
No.
And so, in Los Angeles could experience, and this is, I think, Sunday into Monday.
Hawaii has had them, some of the southern Mexican coast has had them, but not.
The only thing I would say, officials in this region, I don't know how to define this. Be well prepared.
Yeah.
I don't know what that means. I don't know what that looks like, but here's the warning if it's going to be bad. Here it comes.
All right.
time, perhaps the only time congestion is considered positive. The latest global traffic scorecard from analytics firm Inrix found that wait for it here, what city has the worst traffic congestion in the United States? Chicago has the worst. But analysts say that's actually a good thing, sure, because congestion signals economic activity. Boston, number 2, followed there by New York. Miami, Los Angeles, San Francisco, and Washington, D.C., where the traffic has gotten worse and worse over the years. They point out that only a couple of cities have come back above where they were some years ago. Chicago was one of them, and Miami another, where the traffic is actually worse than it was pre-pandemic.
The thing you have to remember is the population grows. By definition, traffic gets worse every year, especially once the millennials did the exodus to the suburbs thing. So you have to build more road capacity just to literally not make it worse all the time. And congestion trends in New York City,
We will see what happens.
well, how about this for globalization? First, we heard about Beyonce causing inflation over in Sweden. Now, Ozempic is causing rate cuts in Denmark. Here's why. Novo Nordisk, the Danish company behind the drug, is taking in so much US dollars, converting them to kroner, and raising the value of the Danish kroner, and affecting its peg with the euro, forcing it to now have to cut it.
One drug is making that much difference.
I love it. It's amazing. These little butterfly effects, these single actions that can have
There's articles in one in the Times this morning about how they understand that the drug is very popular. They don't really understand why it works.
Yeah, it's creepy, and yet people are talking about saving hundreds of dollars on their food bills, and the enthusiasm is out there.
Hey, everybody. On that note, thanks for watching Column.
If the Dow can stay positive, turn positive, closing bells right now.
Kelly, thank you so much. Welcome to Closing Bell. I'm Scott Walker, live from Post 9 here at the New York Stock Exchange on this Friday. This make or break hour begins with the market's lost momentum. When it might return, and the stock that now holds the key to everything, some say. Here's your scorecard with 60 minutes to go in regulation. The major averages are staring at their third straight week of declines. The Dow, well, it's posting its worst week since March. It's breached some key technical levels as well. More broadly, the S&P 500 dragged by discretionary and communication services stocks. Those are the 2 worst performing sectors over the past 5 days. NASDAQ below its 50-day. Investors are closely watching Apple and NVIDIA ahead of its critical earnings report next week. It takes us to our talk of the day, the many pressure points for stocks. Rates, earnings, China, of course the Fed too. So what's an investor to do? Well, that's Dan Greenhouse. He's Sol's alternative asset management chief strategist. Here with me at Post 9. It's a growing list of pressure points, right? We've been sort of fixated on this Apple sell-off. The rates have backed up, although at least today they're backing off, which is maybe why the market's kind of hanging in. Okay, how do you see things here?
Yeah, I mean, listen, technically, obviously, we've sliced through the 50-day moving average on a number of indices, if not all the indices. But in the context of Apple, I'll take a somewhat optimistic spin on things. Apple and those types, they were up 60-70%. Meta and NVIDIA are up 300-400% off their respective lows either earlier this year or late last year. In the context of what's happening with rates, from the bottom, and when rates bottomed earlier this year, the 10 years up, call it 100 basis points, and the NASDAQ is up the whole time, the S&P is up the whole time. I think ultimately, with all that as a backdrop, what you look at right now is it's not unusual late August, September, to have something of a seasonal pullback. I know this is something Josh Brown was talking about this afternoon.
Yeah.
September's been down 3 years in a row, 6 of the last 9, et cetera, et cetera.
Yeah, historically, it's not a great time.
It's not a great time. That's right. And when you have to run up that you have into something like that, you have no catalyst right now. Jackson Hole is probably not going to be much of anything. And so you're sort of on hold, at least in NVIDIA next week and then beyond.
Okay, so all that said, then, if we have a little swoon here, which, some said was due anyway, are we still set up for a trend that's intact for the rest of this year to be constructive on stocks?
So I think on balance, the answer is yes. I want to add one more data point or one more observation, what I call the Terra Nova observation. All right, something he's been talking about is the distance the S&P, where the index got from its 200-day moving average. The NASDAQ got almost 22% away from its 200-day moving average, a level that's basically only been exceeded 5% of the time over the last 40 years or so. So again, within the context of a correction, you were pretty extended in that sense, and Joe's been hitting that point, I think, correctly so. In terms of the rest of the year, listen, I think the bottom bias is for no recession right now. And again, for context for the viewers, I'm someone who was arguing much of last year for a recession sometime around the middle of this year. Obviously, that is not going to be the case. And if anything, ironically, the economy appears to be accelerating. I know that you're aware of the Atlanta Fed GDP now number that everyone's talking, right? It's not going to be 5.8. Even if it's a point less, even if it's 2 points, it's going to be about 3%. But let's say it's 3%. Yeah, that's still an acceleration from Q2, which itself was an acceleration from Q1. So conversely, again, not only we're not having a recession, we appear to be accelerating.
But it also appears as though we've entered a phase of the market where good news is bad news.
I think that's right.
Again, yeah. Right? If you put a print that's too hot, or you have a metric that's too hot, a report that comes out, it's too hot, that's not good now. Whereas before, it was okay, soft landing, hey, maybe even no landing. Now it's like soft landing good, no landing bad.
Well, listen, again, I think we've been talking about this forever, but it bears repeating ad nauseum. We're not really talking about meaningful additional rate hikes on the part of the Federal Reserve. What the good news,
well, you better hope not. The bulls better hope not, right? Yeah. Well, we've convinced ourselves that, okay, September's going to be a nothing burger, and then, okay, maybe November, yep. And then that's it. If it's more than that, is that a problem?
No, I don't know if one more hike is necessarily a problem, although I will say we know that the headline CPI accelerated last month. I'm not sure that everyone is aware that in the upcoming report, it'll probably accelerate again, perhaps meaningfully so, at least at the headline. And so you're going to have somewhat of a jitter, so to speak, around 2 consecutive months where headline CPI has gone up. But on the part of the Fed, again, and I can't say stress this enough for investors at home, it's not how many additional rate hikes, it's how long you leave rates up at these elevated levels. It's considerably more consequential for the economy and I think for your investment.
Well, it's also the speed at which rates have gone up. That's part of the issue with the unsettled nature of this edgy market is, the 10-year has gone up a fair amount in a reasonably short period of time. It's made people nervous. Now, as I said, it's backed off today. But over the last couple of weeks where the uncertainty started to really creep into the picture, that's been the case.
Yeah, well, again, the issue is how do you want to view the backup in rates? So I mentioned before, I'll repeat, the 10 years, I'll call it 100 basis points or so in the last few months. It's a pretty rapid move. But is it going up because the economy appears to be accelerating, as I mentioned? In which case, interest rates should be in Japan, where the higher level of issuance, or perhaps people are getting more nervous about inflation. That tells you a lot from your own viewpoint about what you think about the investment landscape.
Goldman's Tony Pasquarello, frequent guest on this program, had a pretty good read on exactly what the environment looks like right now in his latest note, which I read earlier. Quote, liquidity ebbing, price action skittish, tactical nerves are suddenly a bit frayed. That makes sense, right?
Yeah, I think that sums it up very nicely. But again, outside of the seasonally weak period in which we find ourselves, what you have to wrestle with as an investor beyond the next few weeks, let's say through the end of the year, as you mentioned, is do you think there's going to be a problem on the earnings front, or do you think there's going to be a problem on the economic front? Because if you do, you're making one of two arguments. On the earnings front, it's obviously earnings. On the economic front, perhaps I don't want to pay 20 times for the market anymore, although a lot of that is tech. In which case, one of those two levers, so to speak, is going to get the market lower. If you don't have those concerns, then you're probably just going to drift higher into your end, which is typically what happens.
The other problem, as long as rates remain up, if you want to consider it a problem, in quotes, for stocks, as the Wall Street Journal says today, investors keep piling into money market funds. Such funds drew almost $36 billion over the past week. That's the largest haul since May. In other words, there's still good competition elsewhere for stocks. And until you get out of that dynamic, we're going to keep having these conversations, whether it's fixed income or money markets at 5%. You get where I'm going.
No, of course. And admittedly, you don't have the same thrust behind the equity market if some of that money is diverted into money funds or to treasuries. And admittedly, when you build a portfolio.
So Blue Apron had a nice day today. I think, Cayman, you're in this, right? Blue Apron. Nice rally.
Does that mean the equity market can't go up? I would argue no, and we just need to look at the first 6 months of the year. The money markets and the stock market went up the whole time.
Well, because you've got, Bryn Talkington, by the way, who's going to join us now, a CNBC contributor, Requisite Capital. Of course, Bryn, you had more than a year's worth of gains in the Magnificent Seven, as we were calling them. So forgive people for taking some profits off the table if the environment looks a little scattered.
Yeah, I think we've had like 5 years of returns in those stocks in the first 6 months. So I think there are certain things that the investors really need to know. And I want to talk about bonds because you know, you and Dan just talked about it, that you've seen 100 basis point move, but the 10 years moved, I believe, 50 basis points in about 21 days. So that really overrides and really it really correlates with the sell-off in stocks. And so if you think about this, is that when you have an inverted yield curve, what that's telling you is that a recession is on the horizon. We've had an extremely inverted yield curve. Well, guess what? The bond market has been at odds with stocks, but stocks are saying we're going to have a soft landing, and actually economic growth is accelerating. So to me, what I'm seeing is you're starting to see an uninversion of the yield curve, because as economic data improves, you actually get a steepening, meaning the long end goes higher. So that's just like bond 101. But then you add on top of that, we have all of this continued fiscal spending from CHIPS, from IRA, and then you have quantitative tightening. And so I think we have these ingredients that were in somewhat uncharted water that if we actually, I just can't imagine the Atlanta Fed numbers are even remotely correct. But let's just say directionally it's in that way.
What she's talking about right now is the inversion is now reversing.
That will absolutely put cold water on stocks. It just will. And so right now we're bumping up against that technical resistance of October of 2022 for the 10-year. And
Low tick alert -800.
Okay, we're backing off now.
But I will say though, you know, July is one of the best months in the market. September's the worst. And don't forget that by October 1st, Congress has to have a resolution on 12 budget. I mean, to not have a partial shutdown. And so I'm quite sure the political theatrics are going to kick up, especially from, you know, the fiscally conservative Congress people that just don't want to continue to spend. So I think September you're going to continue to see volatility up for a number of reasons.
So how much more do you think the correction legitimately has to go if we're in this period of consolidation?
Yeah, I mean, I think that, like, from a technical perspective, that 43, maybe it's a 43.20, you know, you really haven't seen, the NASDAQ doesn't look great if you look at the weekly moving averages. You definitely have seen some damage. And so I think outside of NVIDIA next week, which I have no idea what type of animal spirits people are actually looking for NVIDIA to have. And so that could be a little bit of a short-term move, one or the other. But I would say 43.20 on the S&P is good support. And I'm not good at saying how far are we going to go down. I just look at the technicals and see what that tells us. But I do know that September, to me, is setting up to be a consistently 4 months with volatility. And so that's where, you know, we've had covered calls and a big portion of our portfolio this year, which has been a drag. But I think as the VIX goes higher, as stocks chop around, having that call premium kick up will actually be a tailwind to our portfolio in a September, October type environment.
Yeah, with the caveat that I think the government shutdown, which is almost 100% probability, is completely irrelevant. I will add to Bryn's list that the UAW is almost surely going to strike in the middle of September. And I don't know that that means the market's going to sell off in an immediate sense, but it does add to some of the near-term negative headlines, if you will, that'll pop up.
What's the significance, Dan, do you think, of watching the loss of leadership?
All right, so we're fading more.
Which is having a bad month.
Low tick alert -800.
Over the month, but all of those names are down by some degree. It's just Apple's the steepest decline, but then NVIDIA is also too. Something pick up the slack. Leadership.
So listen, the Fannie Plus Index, which includes a couple of other names, is off called
10-year yield been flat since 2 o'clock. Looking for that to roll back down.
For the moment, leadership is in question. But I would add, when you look beneath the headline, beyond the tech plus name, so to speak, look at the things I've been talking about for a couple of months now, if not a year, the consumer areas, the hotels, the cruise lines, the movie theaters, the casinos. To varying degrees, the performance of those stocks, particularly hotels, has been exceptionally strong. And I think it speaks to something that's going on in the economy where obviously the consumer is spending on leisure and not goods, et cetera, et cetera. But
Yeah, Marriott, we were looking at that beginning of the week. Marriott's back down to the 21-day.
But it doesn't mean that underneath the headline you can't find in the industrial space. I'm rambling a second here, but in the industrial space, the charts are a little off the highs because the market's selling off. But look at infrastructure-related names, United Rentals and Eaton and and Quanta take a peek of like there's a lot of stuff going on in the industrial space that's incredibly attractive. Although I'm not arguing that anyone should buy any one of them.
So, Bryn, you mentioned NVIDIA, and we're going to get set up.
Yeah, Quanta looks pretty good. Nice
Is
bounce.
it overstating it to suggest that at this very moment, just given how unsettled things feel, particularly in the NASDAQ and with some of these mega cap names, it's a $1 trillion company after all, that it's the key to the market right now? It's the key to whether this correction indeed has further to go, or whether, mega cap in and of itself can stabilize and at least stop some of the bleeding.
No, I think it's key to semis for sure. But I mean, everyone I've listened to, everyone I've talked to has said that you cannot get the NVIDIA chips till at least Q1 of 2024. And so the demand is there. I don't think it's the key to the whole tech market even remotely.
Yeah, I would agree. I don't know why Scott Wapner thinks this.
The hyperscalers, like who are the buyers of the semiconductor chips? It's the hyperscalers like NVIDIA, Google, etc., that have already spent their capex. So I don't think it's the key to the market or tech as a whole, but definitely within semis, I think it can either cool off that area, which has really just been phenomenal, just incredibly strong. But if you look back 20 years, NVIDIA has had, I believe, 8 or 9 years where it's been up over 100%. So this is not that unique for NVIDIA to have this kind of year because it's just a powerhouse name.
Yeah, but I guess I would push back only in the sense it may not be unique for it to have this kind of year, but given the reason why it's had this kind of year, as the point Josh Brown was making on halftime earlier today, is because the AI story has fueled all of the excitement within tech. So, because the earnings are next week, that story in and of itself, the point Josh was making, needs to stay intact, right? It's been the whole show in mega cap for the most part. You can't start losing it now.
Yeah, but that's the thing about this. How many people are investors in NVIDIA that owned NVIDIA prior to 2023, and how many are traders that got into it afterwards? And so I think you could flesh some of that out, right? But for these long-term investors in NVIDIA, they're going to have a great quarter. Is it going to be great enough? I have no idea. There is so much hype in this name, and so I agree to that. In the short term, it could cool things off.
She's smart. I like Bryn.
It's a very specific name, Scott, and the only company that we're sure that is capitalizing and monetizing AI is NVIDIA. That's it. In the publicly traded space, everyone else is spending to buy NVIDIA chips. So that's why I just don't think they're all put together, because they are the direct recipient of what everybody else is spending.
Yeah, part of the point though is you can't afford to lose NVIDIA. Certainly not at the current time. I mean, Chris Harvey over at Wells suggests today, quote, next week's NVIDIA reports and an AI sell the news reaction may help mark the near-term equity bottom. So if you're looking for signals of when some of the selling can stop in mega cap tech, do you need a sell the news thing in NVIDIA to clean it out a little bit?
Maybe. But my inclination is opposite Bryn's. I think that this is a crucially important earnings report, and I think you can make a case one of the most important earnings reports we've seen in quite some time.
Sure, that's why we ask the question, is it right now, the most important stock in the market?
I think for sure. And listen, part of why I disagree with Bryn is we know the rest of the semi space is a disaster. We know that chips and PCs, et cetera, are not obviously doing what they once were.
And some are not. Broadcom obviously is benefiting from
the
AI too. It's one of those power players.
There's a company like ONSemi, which makes auto and industrial chips, which is doing okay. But yes, I think given its size, given its importance, and given how much it shifted the narrative earlier this year, I would argue a disappointment out of them. That's not to say that if they missed by a penny or something like that. I mean, some sort of disappointing commentary about the level of spend is I think, near-term problematic.
Yeah, Bryn, how about that? I mean, right? Let's be honest. I mean, markets move on fundamentals. They move on all sorts of things, and they certainly move on narratives. Right? That's what fueled the whole.
He definitely wants to get her to say that, yeah, it's going to be NVIDIA next week.
For the most part, from what AI is going to deliver for these companies, but the narrative is that we will.
His narrative, CNBC's narrative.
We have to pay up today for these earnings that are going to come down the road because of AI.
Yeah, I mean, I totally agree. That's what I'm saying. The only company that's actually realizing money right now is NVIDIA. I don't know how Salesforce monetizes AI, except just charge more for your product, right? So I think there's so much hype around this. I don't think NVIDIA is going to disappoint, though. And that's where maybe the expectations are just like outlandish. And I think some of the smaller players in like that are like the smaller, like the Unities of the world, maybe those sell off because they're not making money at this point. But I just don't think they're going to disappoint because everything I read is like they're booked out to Q1 of 2024. And so, I don't know. I think it's going to be a good number. Is it good enough? I don't know. And so I think it's clearly important, especially there's no more earnings left. I just don't think it's going to be bad. And so that's where I don't think it's going to be some watershed event that all of a sudden tech just falls out of bed because NVIDIA is not going to miss. Like that doesn't make sense to me. I could be wrong. I'm wrong all the time, but in this case, I don't think I am.
Beat miss, it doesn't maybe matter as much as guide, and I think we learned that last quarter. The guide was so out of the water, outrageous, that the stock took off, and then everything else followed suit. Before I let you go, Brandon, your position is somewhat hedged, I think. In what way, and how can people who are in NVIDIA maybe questioning what is really going to happen if Chris Harvey is right? How can they protect themselves and their position?
Well, we're big fans of cover calls. So, in my personal position, when NVIDIA last quarter, after they released earnings, when it was around 420, I sold the September 450 calls and collected $23. So,
Wow, that's nice.
Easily get called away from me if it's September 15th, it's at 450, but I collected $23 because the volatility is so high, and I'm very happy with that position.
Yeah, I would be too. You hear what you just said? She collected $23 for selling the 450s after the last earnings. That's great. Great trade.
We're going to leave it there. Britt, thank you so much. Dan Greenhouse, thanks to you as well. Good to see you here at Post Time. Good weekend to you both. That brings us to our question of the day. We want to know, will NVIDIA earnings be a sell the news event? And at CNBC Closing Bell on X, formerly known as Twitter, to vote. The results later on in the hour. Let's get a check now on some top stocks to watch as we head toward this Friday close. Christina Personel with us here with that. Christina.
Well, it's been a tough week for Chinese tech stocks, and it's not going to be for your Tuesday. JD.com, Alibaba, PDD Holdings, all in the red right now. You have the KWEB ETF that tracks many of those names. It's on pace for its worst week in 2 months as concerns over a slowing Chinese economy weighs on the group. So KWEB is down about.
All right, S&P is trying to bounce higher or low.
And the EV makers haven't been
40 minutes to go, 39 minutes to go.
And Li Auto all tracking for sharp weekly declines. NIO is on pace for its worst week since January 22. Get this, down 17%. And XPeng, which is making matters worse today after posting its biggest quarterly loss since going public in 2020, those shares down about 5%. Scott.
Christina, we'll talk to you soon. Thank you, Christina Personel. We're just getting started here. Up next, a disaster timing move for the ages, quote unquote. That is what star analyst Dan Ives is calling Palo Alto's rare Friday night quarterly earnings release. He'll join us after the break with what he is expecting, maybe what he's fearing from this oddly timed release, I think we can call it. We're live from the New York Stock Exchange. You're watching Closing Bell.
He's so smug. There's something about him that I don't like. Just don't like it. All right, so maybe we do have a decline next week with NVIDIA earnings. NVIDIA beats and guides, and people sell the news. It doesn't gap up again. A lot of tech would most likely move lower. So if you still have your hedges on, in particular SQQQ or QID, you're probably happy with that. QID going into next week. Okay. QID on the weekly, this is the third week higher as the markets move lower. QID. Okay, it's gained about 20%, about 5% this week. It's moved from 12 up to 14, $2. Do we continue over the next few weeks? Well, we've seen what the August before an election year, presidential election year, the August before, seasonality over since 1999. The maximum has been about 18.5%, and the least was in 2019, 20, 7.4%, something like that, 7.5%. So we know the ranges that we can expect in the short term. Once we start to see signs of a base, that's when we'll start getting active. All right, so the 100 period, the 200 period, 6.7% down to the 100 period moving average, 10%, 10.3% down, roughly down to the 200 day. We're currently at the low today. We're off 5.9%, let's say 6%. Last election, the year before, 2020 was the election year. 2019, we had the 7.2% drawdown from the July high into the August low, and then we finished higher. In 2015-16, much greater pullback, 11.5% from the July into August level. If you take it from up here, it's about 15%. 2011, that was the greatest, or the most, about 18.5% in August. So we know what the range is with 6% so far, 5.9%.
I think 70 to 80% of it is because of this Friday night after the market in the summer earnings call. I think it's a debacle of epic proportions to do something like this. Lack of emotional intelligence from Palo Alto, the intention of the board. And I can tell you, investors, they've been running for the elevators in these situations. Just it's stunning.
And you call it, quote, head scratching, one of the biggest PR disasters, black eyes, et cetera, et cetera. And what do you think's at play here? What are you fearing most?
I think the medium-term guidance, it could be off, call it 100, 200 bits. The reality, if this wasn't this Friday night special disaster, stocks may be off a bit. We're looking at $230, $240 stock here. And now I think the bug will be worse than the fight. Our long-term thesis remains here on Palo Alto. I continue to think they're one of the best players in cybersecurity. And I think it's really about medium-term guidance. And I think that's really the issue at play here. But I think it's the timing here that in my opinion, this is a case study for investor relations for years to come.
Well, sorry to interrupt you. It's been a monster stock, one that you yourself, sitting right to my left, have suggested was a table pounder, right? Those are the words you use to describe a stock that you love. Do you love it today as much as you did in the past?
Yeah, we still love it. It's still one of our top picks. I think it's a stock that ultimately a year from now is probably close to $300. But ultimately, in the near term, we didn't take it off top picks list, over the last week or two, just because the uncertainty from this, what could be in this twilight zone situation on Friday night, I think that's really the near-term sort of situation. I do think it's a stock that ultimately moves much higher over the coming months and year. But at least in the near term, this is ultimately a self-inflicted wound.
You think it's, I don't know. Do you think it's really that bizarre? Are we making more of it than should be made? It makes for a nice headline in the words that you put in some of your notes, but maybe it's much ado about nothing.
Yeah, and Scott, we've probably heard 60, 70 investors in the last week or two on this. The point is, this is something that has really alerted and really been a red flag in the investor community.
Okay, nice little rally here with 32 minutes left to go. 32 minutes left to go.
Something I haven't seen 23 years covering tech stocks, 89 public companies that I've covered, and they are still the gold standard for cybersecurity. Now, if you look Fortinet at softness, that's caused some fears here as well. And then it's surprising for a company that I think is normally has high emotional intelligence.
I mean, CrowdStrike's down 12.5% since the August 2nd announcement that we were going to have today after the bell. Fortinet's down 26.5. You know, some of the other cloud type stocks have fallen hard too. So maybe it's nothing more than just a space that got a little overheated, needed to come back to earth a bit.
Yeah, look, I think across the board, we've seen that across tech in terms of the stuff. Cybersecurity, I think, is going to be more the beneficiary as we go into more and more cloud spend.
Okay, we're starting to come off the low pretty quick here.
More and more consolidation. But when you look at what's happened here, I do think as a barometer for the sector, not just public but private, I mean, it's been a shock opera. Talk of the town since they did this the last few weeks. Now it's rip the Band-Aid off, get this over with, and I think this stock is probably up on Monday.
Hey, how concerned are you about Apple? Just to switch you to that before I let you run. Stock hasn't traded well, down 11.5% this month. You know, got some technical ugliness to it as well. Give us your, I know your big picture view. I don't necessarily want to hear that, but give me your tactical view, if you could, over the next few weeks. What you're looking for?
Tactical is, I think this is, I'll use a table calendar term in terms of my view of this going to an iPhone 15 cycle. Mid-September when they launch, we believe 25% of the install base have been upgraded in 4+ years. Our checks out of Asia, even as in the last day or two,
This stream is sponsored by TicketTick. It's free daily points, Fibonacci, and market profile levels.
So Scott, I get the ultimate pullback on tech, and obviously Apple is a barometer. But I believe I view this as a golden buying opportunity rather than time to sell this game tactically into the next, call it 45, 60 days.
How critical, before I let you go, also NVIDIA? You know, we've made the case in some respects that right now it could be the most critical stock in the entire stock market.
Yeah, and no doubt. I mean, Jensen, that will be the guy to turn around the world next week. But we're expecting strength. Everything we're seeing at even, we're looking at ultimately things that are almost sold out through 2Q, 3Q next year. And I actually think this just speaks to, I know we were talking about before, the reality of what we're seeing with AI spend. This is not hype, it's real. It's a 1995 moment, nothing we've seen since the start of the internet. And that's our view in terms of as this all plays out. Next week will be guidance for around the world in a positive.
Appreciate you sharing your news with us. Dan, enjoy the weekend. We'll see you soon. Up next, the major averages heading towards weekly losses yet again. But John Spallanzani of the Miller family office is still seeing some serious upside for stocks as we wrap the summer. He'll make his case next. Closing bell right back after this.
Looking for a higher high now. We got to get above 43.72 to get any kind of run. 43.75 would be a next level. making a higher high. Need to get above 43.75.
All right, we're back on the Bell Summer Seasonality, hitting stocks again this week. The S&P 500 closing in on its longest weekly losing streak since February. But our next guest believes the bull thesis is still intact. He's right here at Post 9 to make the case. John Spallanzani, the Miller Family Office. Good to see you. Welcome back. Thanks. There's a lot of uncertainty in the market suddenly. Tell me why the bull thesis is still good.
Yeah, I think that the market was a little overbought, obviously, as we got into August, and we see this correction that was kind of foreshadowed. It's never one thing. I think we had the Fitch downgrade. Obviously, we have Jackson Hole coming up. We had some
Backup in rates.
well, backup in rates, yeah. I think that's kind of almost run its course, just because if you look at the yield curves around the world, right, we have bonds at 2.6%. We have Switzerland 1%. You have Portugal 3.9%. So, and then you have Japan. Everybody said people were going to sell treasuries. Same thing with China. But why would they do that when their currencies are weakening? So, if anything, if your currency is being devalued, you want to get the money out of the country and probably into treasuries, not out of treasuries. So I think there's an underlying bid for treasuries over 4%, obviously. I think the Fed continues to talk tough, but they'll pivot on a dime once they see employment or any other indicators.
There are some who are trying to make, if we're talking about the bullish thesis, that what was the thesis that, soft landing or no landing has suddenly turned into a bearish thesis that no landing is no good anymore because it's going to keep rates elevated for longer. And who knows what the Fed's going to do, but at the very least, you're going to keep rates at these elevated levels, and that's going to put a cap on valuations and stocks.
I think people forget how bad 2022 was. It was one of the worst years for bonds, equities, and just about every other asset class since the 1930s. So we have this recency bias where everything was really bad last year, and now we're just kind of coming out of it a little bit. And I'm with Laszlo Barini, who says, the bull market in NASDAQ started probably around the time that SVB, and we had the regional banking crisis. And then the actual bull market, we're going to take 20% from the low for the S&P, probably started in June. So this is a little bit of a correction. If we look out, we have student loans coming due. We have China blowing up. We have gas prices back over. I paid $4.50 today for a gallon of gas. So we have all these drags going into an election year. Powell already made the transitory mistake where he said inflation was transitory. Is he going to want to make another mistake and have a major recession on his hands going in? So again, I hear people talking about, well, the market's pricing 5 rate cuts for next year and all these ridiculous assumptions. But the fact of the matter is,
Rejected again.
Rates, you hike at 25-point increments, right? 25 basis points. When you cut, they can cut 50 and 50. That's 100 basis points real quick. So do we consider that 4 cuts?
Lower high.
2 cuts? So
We're still dealing with the 1-to-1 up-down ratio. Doji day.
The market yields have backed up. We have mortgage resets coming, which are going to be big. We have student loan debt. So there's a lot of
Spinning top
he's kind of treading
on the market.
And those are the reasons.
Wouldn't be too bad to come down to 4,300 and bounce, start to base around this area. That would be very helpful. The 9 EMAs crossed down through the 50, and we got the 21 day about to cross through the 50, probably by Wednesday next week. So that's short-term bearish.
The AI story is also disinflationary. So we saw UPS and UAW, 2 unions, had very big contracts, and that kind of scared a lot of people. But remember, most of the workers in the United States are not union workers. They're going to be fired, God forbid, if there's a downturn in the economy. And that's the last thing Jay Powell wants. We already have unemployment tipping up a little bit, claims almost at 250. The last non-farm payroll was, pretty much in line, but almost in that 100,000, under 100,000. They start seeing non-farm payroll employment print under 100,000. They're going to be in the easy camp pretty quick.
Do you need mega cap tech to stop going down, stabilize, or you say it doesn't matter as much because there's something else to pick up the slack? How do you view that?
Yeah,
It's undeniably one of the reasons why we're even having this conversation, why the S&P is down 5.5% this month.
And the Nasdaq's down 6-7%. Tesla's down 22%. I mean, that's a big move in 1 month, right? Well, Apple's down 11.5.
Yeah, right? These stocks matter a lot. They matter on the way up. Yeah. They sure as heck matter on the way down.
Yeah, well, we have, the last 13 years, we had Dan Lowe pile into AI-related stocks. David Tepper went all in as well. So I think that's a longer-term story that's going to play out, not just till the end of the year. That's going to play out over the next, 5 years, 10 years. And that's a major story that I don't think.
Okay, I've got a higher high.
Those stocks obviously were kind of.
S&P higher high.
They've come off, and I think that.
Let's blast through 43.71 and 43.75.
Up next, we're tracking the biggest movers as we head into the close on this Friday. Christina Partinello is standing by with that. Christina.
Outback Steakhouse catching the eye of not only some steak lovers, but an activist investor who believes the parent company's shares are undervalued. Stay tuned to chew on. It's Friday.
All right, nice rally here. S&P going. There goes the S&P with 19 minutes to go. Nice little pop back up to the resistance level that we don't seem to be able to surmount. 43.71, 43.72. That area is giving us trouble. Put holders have 35 more minutes before the S&P options pit closes. S&P closes right at the close, right at 4 o'clock. SPY continues to trade until 4:15, and the Qs continue to trade until 4:15. Thank you, Corey. Microsoft high of the day. Okay, here goes the S&P on the move. Nice work, Corey. Thank you. Okay, here we go. S&P trying to break through 43.75. We're up 350 on the day.
Well, I'm watching Deere right now because it seems
estimates on both earnings per share and revenue. The farm equipment maker also raised its full year guidance and said its order books remain robust, but the stock is down on concerns that sales could be slower going forward, especially as used equipment inventories rise. Deere shares are down 5.5% right now. And Outback Steakhouse parent Blooming Brands is higher today as activist firm Starboard Value revealed that it has taken a nearly 10% stake in the company. Starboard's filing didn't really include any details on what they're pushing for at the company, but sources tell CNBC that the fund views Blooming Brands shares as undervalued.
High tick alert plus 800.
Okay, we're running here.
Get a free trial at tickstrike.com.
Thank you. Last chance to weigh in on our question of the day. We asked, will NVIDIA earnings be a sell the news event like some suggest it could? And at CNBC closing bell on X, the results are just after this break.
All right, we just broke through resistance. Nice. We got a level over here. $43.78. Looking pretty good. A lot of stocks are moving off the low.
Extreme high tick alert.
Okay, so probably shorts
Extreme
covering.
high tick alert.
Some scalpers end of day. We've got the market getting a little jiggy here. Into this OPEX. We got 12 minutes to go for a regular session. SPY and the Qs trade until 4:15 p.m. With 12 minutes left to go.
I want to show the markets here because we are green across the board, including the NASDAQ. Look at that, down at the bottom of your screen. Now positive, albeit slightly, but it's been red all day. And now the Dow Jones Industrial Average is at pretty much its highs of the day, up 83, 0.25%. S&P 500 is green as well. Now the results of our question of the day. We want to know, will NVIDIA earnings be a sell the news event? The majority of you said yes, so maybe sentiment's turned a bit. About one of the biggest stocks in the market, 57.5% of you say yes, it will. Well, we shall see. Up next, speaking of earnings, your earnings set up for Palo Alto. That Friday night earnings report. It's just a few minutes away. We'll give you a rundown of what to expect, and it's another big week of earnings ahead. Retail is front and center once again. We'll tell you the key names you need to be watching, what's at stake for that sector and the markets at large. We'll do it after the break. That and much more when we take you inside the market zone.
Ten minutes to go. 10 minutes to go, folks. All right, we got rejected. So much for that. That was a nice little rally there to exit some of your XPX calls if you had them. Mm-hmm.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down the crucial moments of the trading day. Plus, Courtney Reagan on two retail movers today and what to expect from another busy week of retail earnings in the week ahead.
Okay, we're dropping back into that 4378, 4375, 4371 zone.
Mike Santoli, how about this move late in the day? Getting a little green across the board.
At least a sense out there, a belief that it's not one of these daily self-reinforcing sell-offs. You still very firmly have, this multi-week downtrend in place. Today didn't do a lot to change that, but it shows a little bit of calm in the bond market. It goes a relatively long way after we've gotten just slightly oversold in stocks. Still not the broadest rally, but I do think it makes sense that we're able to at least find a little bit of footing. We do have options expiration today. Maybe that does clean up positioning a little bit going into next week.
All right, and Courtney Reagan, speaking of next week, what about the two retail movers today? Give me that first, and then we can look ahead to what's at stake next week.
Yeah, so two retail movers with very different businesses moving in
Okay,
very
we just
different
went
directions.
red again on the day.
The results after the bell. So today was the first day of trading and we got to react to it. And really, it was very strong across the board. This is an off-price retailer, so it has a model like a TJX, and it reported much stronger than expected results. It upped its guidance, but a number of analysts actually think it might even be conservative with its guidance. And it just goes to show you that sometimes you can sell discretionary goods if you've got them at a value proposition and consumers will be interested. On the flip side, you've got shares of Farfetch absolutely tanking. So this is an online marketplace for luxury goods. You want to see profitability in any company that you invest in, right? And so that bar has gotten higher and higher and higher for some of these online e-commerce used to be formerly sort of startup names. They were not able to put up profitability. Their revenue projections going forward are dour to say the least. Analysts are even a little confused on the business model, even as the executives are talking about making things more efficient going forward. Obviously, investors just are not convinced today.
Yeah. So let's take from today to next week. What should we be watching for most, do you think, next week?
Oh my gosh, Scott, we have so many names reporting next week, and so many of them lean heavily in apparel, in these discretionary goods that have been soft for companies that have lots of different categories. And so I think the way that you operate, the way that you execute is really going to define the winners from the losers, because we know that you've got to give consumers an awful lot of incentive to buy these type of goods right now. And so I'm really watching to see if any of these players can do that. I'm talking about Nordstrom and Kohl's and Macy's and Abercrombie, Dick's Sporting Goods and Foot Locker. Little different businesses, of course, there. We also had Lowe's, and we heard from Home Depot. I expect to see a somewhat similar quarter, sort of some moderating consumer spending when it comes to the home. Focus on smaller projects, less on those tackling those really big, expensive projects in the home space as rates obviously continue to move higher. So we'll see what we get.
I guess we will.
4 minutes, less than 4 minutes.
All right, what will we get from Palo Alto Networks? Christina Partsinevelos, that is the biggest wild card question of this day.
Which is great, because that means people are going to be tuning into CNBC and us breaking the earnings. But let's talk about the stock. It was down, roughly 18% since announcing a Friday afternoon session on August 2nd. And also, don't forget, a 2-hour earnings conference call and a one-on-one sell-side chat if any of these analysts need clarification. Of course, there is speculation that the company could be hiding something that, since attention tends to dissipate on Friday, summer afternoon, but not today, folks. There are other factors, though, that could be at play in the recent stock drop. Firstly, Palo Alto was added to the S&P 500 on June 20th, replacing Dish. It jumped 7% that day, so maybe it's coming down from that. Secondly, Microsoft announced it would expand its cybersecurity offerings, which won't really affect this quarter. Or
Haven't done much today. Just selling some covered calls on Apple, Kava, Kohl's, Acadia Pharmaceuticals, and Unity Software. I just sold some covered calls, and that's it. All right, can we close this green? We got 3 minutes to do this. Let's rally back up.
So maybe they're being considerate to analysts, giving them some time to update their models.
Well, I can't wait. I cannot wait to go overtime to find out exactly what this is.
Okay, so what we're watching for next week, we're looking for a base in this area. We want to see 2 or 3 candles like this over here. That doesn't make a new low, that moves back to the upside, and we want to see volume come in. Okay, so volume, a bounce, and a base. Volume, a bounce, and a base. That's what I'm looking for in this area. If we make a new low and it's a red candle on Monday, that's a different story. Got 1 minute left to go. 1 minute left.
Just fine numbers. There was really nothing wrong with the earnings, and yet they both traded terribly off. So this is when the market will show its hand as to whether it has too many eggs in that one basket of Nvidia, and we'll see how it breaks from there. I don't think that people are as far out on a a lens, super bullish in the short term on the stock as they had been a little while ago. So one of the jobs of this pullback has been to moderate sentiment, get valuations off the nosebleed levels. It started to happen, so we'll see how that if that continues. So we're going to look ahead, Mike. 6 o'clock tonight, of course, you and Josh Brown are hosting your special, Taking Stock.
All right, that's the closing bell, and we just went green at the closing bell.
What should we be expecting? I mean, stocks and bonds both on the move, and actually multiple interpretations of what the message is of all these moves. We're also going to be sort of ranking.
All right, folks. Hope you have a great weekend. Sit back, relax. We're probably going to be fine. Short term. All right, folks. Have a great evening. Take care. And we'll see you in the Sunday video around 2 p.m. on Sunday.